a sense of disinflation just based on the year-over-year composition of the way that the data is drawn up. How do you then get confidence? How do you give confidence that there's going to be a stickier inflation later in the year when all anecdotal evidence is speaking to the other?
Yeah, well, we think that it's going to keep coming down on a year-over-year basis. As you point out, you've got those base effects. We just don't think it's ever going to really come back down to what we saw between the global financial crisis and the COVID pandemic. We've got higher inflation on a trend basis now, between 2.5% and 3.5% on a multi-year basis going out. It could dip pretty low in the middle of this year. We know what's going on with shelter. And even if we just see the shelter numbers flatline, that would imply some very low inflation numbers. Wilmington Trust were much more focused on 9 and 12 and 24 months out. And those higher inflation numbers are going to keep rates higher and actually offer some opportunities for investors. So it's not a whole lot of confidence, Lisa, about what the month over month or even to the middle of this year has a lot more to do with that longer term trajectory. We see those challenges. We also think they're navigatable.
Well, navigatable, which really speaks to the Torsten Slok no landing kind of scenario at a time when a lot of people are pushing out potentially even for years any type of recession. Are you among those?
Yeah, it could go out or it could happen this year. You know, we've got basically a 50-50 chance, we think, of a soft landing versus a mild recession. It's going to come back to employers. We know that employers are dealing with higher borrowing costs, a little bit of softening in demand. If they keep hiring, then, you know, you've got consumers, you've got job growth, you've got wage growth, and that'll keep the economy's head above water in the middle of this year. If companies get spooked and those higher borrowing costs hit their capex and their hiring decisions, well, that's going to lead to recession. I actually think it's going to have a lot more to do with the lagged effects and all of the hikes that were last year, much more important than whether the Fed stops at 5 or 5.1, you know, 1 or 2 more hikes here and there. Businesses are reevaluating those capex decisions now.
Luke, you earned your stripes at the Philadelphia Fed, which has one of the most interesting research capabilities, given the terrain, given the geography as well. And to me, it really harkens back to the study of the core American economy, which I'm going to call domestic final sales. When you take out the foreign dynamics, the inventory dynamics, and you just look at this thing, domestic final sales, is it half full or half empty?
We've definitely seen the slowdown, and that's our preferred measure. It's a little bit like looking at core CPI, right? You strip out the international. We actually go with private final sales to strip out the government as well. And what we've seen there is an appreciable slowdown in the economy. I mean, it was just barely positive for the most recent GDP report, I think 0.2%. And what we see there is a natural slowdown that was going to happen anyway from COVID, but it's also the impacts of the Federal Reserve's policy. We know that residential investment has been hit very hard, and this is exactly what they're trying to do, is to engineer that slowdown in the economy. And Powell referred to this just the other day, the final sales numbers, because what we do see is that slowdown that should help to bring inflation down. And of course, we need to wait to see which way that breaks.
Luke Tilley, thank you so much with Wilmington Trust this morning. Lisa, it's a stunning chart, and you know, you have a pandemic collapse to negative 9% on final sales to private domestic types, which Mr. Tilley talks about. And then up we go to the stimulus boom of a positive 15% statistic. That was for a cup of Tang. And then we come right down, and we're settling right now on a moving average basis, on any form of annualized basis, actually below where we were for 8-9 years.
And what's behind it, right? And actually, Justin Fox, a Bloomberg opinion contributor, wrote a column that's fascinating about how manufacturing jobs really are coming back to the United States in a way that they really hadn't for decades. You see certain areas of industries where the landscape has shifted, right? You could talk about globalization. You could talk about, you know, the durability, the sort of, you know, safety, the security of trying to diversify your supply chain. But that's what's perhaps underpinning some of the resilience in a labor market that isn't weakening.
And the view forward, and this falls back into the Credit Suisse soap opera, is the financialization of the elites in America, which is away from prosaic things like manufacturing, is now within a regime of higher interest rates, whereas Winnie Caesar said money actually costs something. Well, and it's a whole new world. You know, let's go to Disney. It's a whole new world after all.
Which really goes to the Mike Wilson view of things. Can you get an economy that's resilient, a no landing, and still get a rationalization in valuations based on money costing something? Valuations in the equity markets. And that's, I think, one of the questions. You get a reversal of some of that financialization of the U.S. economy that perhaps is getting unwound just a bit.
I talked about today, early morning, I talked about what I looked at first thing Monday, which was the value line geometric growth fund, and it gives you this ambiguity right now. It's actually behaving in a very constructive trend up basis with futures up 30, NASDAQ up 1.2%. I don't have my radar on Dow 35,000. I mean, John Farrow does.
Oh yeah, he's all into that.
He has the hat. Like extrapolating out to 35,000. He's probably got the hat from the last time it was in there.
Yes, absolutely.
Coming up, Catherine Rooney Vera, a chief market strategist. We'll do this at Bulltech Capital Markets. Stay with us. This is Bloomberg again. Futures advance up 30 points.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Ukraine's President Volodymyr Zelensky is in Brussels, the third stop on his quick trip to Western Europe. As he did in London and Paris, Zelensky is seeking more military aid for the war with Russia. European Parliament President Roberta Metsola said allies should consider sending long-range missile systems and fighter jets to Ukraine. Rescue crews continue to pull survivors from under the rubble of collapsed buildings in Turkey, but hopes are starting to fade more than 3 days after two massive earthquakes killed nearly 18,000 people in the country and Syria. The U.S. has positioned an aircraft carrier in the area for some assistance. President Biden is dismissing questions about his age ahead of what's expected to be a re-election campaign. In an interview on PBS, the president was asked about concerns some Democratic voters may have about his health and fitness. His response, quote, "Watch me, it's all I can say." President Biden is 80, the oldest president in U.S. history. British billionaire Jim Ratcliffe has hired J.P. Morgan Chase and Goldman Sachs to advise him on a bid for Manchester United. The English Premier League club has drawn takeover interest from Qatar. Manchester United is one of the biggest brands in global football. There's one estimate that it will sell for more than $4.9 billion. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
We're investing in a lot of different capabilities and features that makes the in-store shopping experience that much easier, that much more compelling, whether it's price check, browsing inventory in this store, so that we can really make that experience as convenient and as simple as possible.
Convenient, simple, that's sort of what people have needed in the age of COVID. Is that here to stay, or do we go back when finally we all hope that the pandemic will be behind us in some way? Do our changing shopping habits go back again?
What's really interesting about retail in my 20-plus experience is that convenience never reverts itself. Now, the form of convenience has shifted, whereas, say, in 2000 to 2010, a lot of convenience was driven by more stores nearby. Now it's stores in addition to digital. Yeah. There's nothing closer than the phone in your hand.
How did Jeff Bezos realize you could sell anything on the internet?
The web was growing at something like 2,300% a year. Anything growing that fast is gonna be big.
Why did Bill Gates create Control-Alt-Delete?
Kind of become the poster child of, hey, couldn't you have made this stuff a little simpler?
And what inspired Diane von Furstenberg to create the wrap dress?
The wrap dress created me.
On the David Rubenstein Show, I uncover the untold stories of the world's most successful leaders, right here on Bloomberg.
When innovation strikes, Bloomberg Technology is there with the news and analysis you need. Every weekday, only on Bloomberg.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia.
This is Countdown to the Close.
Welcome to Bloomberg Crypto.
There's not yet much evidence, in my judgment, that the rate hikes that we've done so far are having much effect on the labor market. And we need to bring the labor market into balance. So that tells me we need to do more
Neil Kashkari with maybe the best understanding of Delta T at the Fed, the aerospace guy out of Illinois. He's always been interesting and is really focused on the X-axis. He's been supple. Can we say it's Kashkari the Hawk? Can we go there?
Kashkari the extreme.
Yeah.
Kashkari I think that's a Kashkari on the edges. Maybe
One of the comments that we saw there was 14 Fed speakers. Today's not as stupid, right? Am I right?
We're not getting as many Fed speakers. I'm not going to play into that, Tom. Really? You're going to try to put that in my mouth?
Lisa Bramwitz and Tom Keene here, getting into trouble. John Farrow preparing for the next hour as he's
avoiding trouble.
To do. Yes, futures advanced. Can we just say that there's an oomph to the market here at 846? I mean, maybe it's claims. I don't know. I got a, there it is. I've got a negative 85 basis points, 2-cent spread. We are not back to December 7th, but this is new 2023 inversion.
The reason why I think that the equity lift today is interesting is because it comes after the 1.7% decline yesterday in the NASDAQ. Have we reached the point where people are not in the let's just make it rally kind of mode or not? And this move that we're seeing ahead of today suggests people are still looking to buy more than they are looking to double down.
It has to do with the earnings as well. This is a joy. Right now, we're going to go down memory lane, which was that long ago and far away with a guy named David Malpass, who's got a job in Washington right now holding up a bank. There was, at Bear Stearns, absolutely definitive emerging market coverage. There was something about it in the air, in the pixie dust, and Catherine Rooney Vera was part of that. She's chief market strategist, head of global macro research at Bolta Capital. I've got to go back to Emmy Shio and David Malpass and all of it. What was it like as Bear Stearns literally, in my opinion, invented EM coverage on Wall Street?
Well, thank you for that kind introduction, Tom. And Bear Stearns was fun. It was a great place to work. And really, I miss it. But EM was a strong point. David Malpass, John Riding, Emmy Shio, as you mentioned, some of the heavy hitters. I was in emerging market fixed income research.
Yeah, okay.
And so enjoyed that time, yes.
But, it was a different battle, but then it was EM connected to the central, as Bill Rhodes would say, the central banker to the world. Is Jerome Powell right now the central banker to Emmy Shio's Latin America or the Pacific Rim? What's the power of our central bank leader now?
Well, emerging markets do very poorly in a Federal Reserve hiking cycle with the dollar appreciating in value. So that's why we saw emerging markets get devastated last year. And I think, Tom and Lisa, that's why we've seen emerging markets be the new darling year to date. It was one of the worst performers in 2022, and it's one of the top performers this year, precisely because it seems the Fed is maybe going to stop pretty soon. I still think it's a bit early to jump into that trade. I think that the momentum could carry us higher for the next month or so. But the Fed could do more, and more than the market is currently anticipating, as your guests have ad nauseum mentioned. But there's a certain euphoria, I think, right now for the riskiest paper and for the mean reversion trade.
Euphoria. Can you build on that? What is driving the euphoria other than just, I guess, positioning squeeze?
Yeah. I was talking with your previous guest in the green room, Winnie, and she called it, everyone's jazzed about the China reopening trade. And that's fantastic for emerging markets. China is a very important trade partner for Latin America, and it's very important as well for Asia, ex-China, right? So as China reopens, the surrounding areas, Malaysia, Thailand, those areas are going to get a bounce in tourism, and Latin America is also going to benefit. So I think there's that aspect. A weakening dollar is very favorable for emerging markets. Economic growth this year is going to be stellar in emerging markets. India, more than 6% growth. China is going to lead the growth. And that's going to be positive versus the developed markets. We're here in the U.S., in my view, we're going to be flat at best.
Well, but so do you think that, just to sort of put something concrete around this, do you think that right now the China reopening has been fully priced and even overpriced when it comes to how it's been represented in emerging markets, just riskier assets in general?
Yes, and I think that before I recommend going long on a sustainable fashion to institutional or even retail investors, we do have to see a pullback, a correction in risk assets. I think the U.S. recession is not priced in, particularly in the equity markets, and we have not seen difficulties with financing. There's a lot of names in the emerging space, as well as in high yield, that have not had those financing difficulties that I do expect to come to the fore as we feel the repercussions and the ramifications of 500 basis points in tightening in more than a year.
Two things right now, very important. You're lecturing at the University of Miami, and you're going to tell them we just had a new depth of inversion on the 2-10 spread, negative 85.298 points. The 3-month 30 is at 107. It's not through to new depth yet, but there's the vanilla spread. What is the signal of new deep, substantial inversion?
Yeah, it's been really fun to be an adjunct professor at teaching global economics, especially, Tom, in this time in our lifetimes. Look, I'll go back to emerging markets again. They did their homework. Brazil increased rates more than 1,000 basis points last year alone. So I think that's part of the euphoria, plowing into these countries, these names, these geographies, these asset classes that are very juicy in yield.
Okay, I've got to ask Lisa. Lisa asked for me as well. Both of us tried to price a condo in Miami the other day and fell off our chair. You're living it. You're living the Florida boom.
I'm a beneficiary of it.
You're a beneficiary of it. Okay. Give all of our listeners and viewers worldwide a snapshot into the sustainability of the Florida boom. Can it continue?
The good news is that we have diversity both in, the diaspora from New York, New Jersey, and from Latin America. So all those people are coming. So it's not just the New Yorkers that certainly have bid up, not just my house price, Tom, which has jumped significantly in value, but also the wait list to get into schools. It's very difficult now to get into the private schools because of this influx. I think it is diverse. I think the mayor and the politicians there have done a fantastic job of enticing capital, and it's diverse in nature. So I don't envy you looking at real estate in Miami. I'm one of the New Yorkers that moved down, but thankfully 15 years ago,
Lisa,
when Bear
4
Stearns
bedrooms,
went under.
3 baths, there's grass coming up through the driveway.
Yeah, we have a yard.
2.5 million.
Basically, the most interesting thing that you've said in the, not Florida real estate. I'm still looking at the 210 spread, which shows you how much of a nerd or whatever you want to call me. But I'm watching right now equities rally, continue to extend the rally, even though people pile into 10-year treasuries at a time when they're expecting more rate hikes. This doesn't add up. No, do you understand this, Catherine?
No, and I think Victoria Fernandez said it very well. It doesn't add up. And so that's why I like T-bills. I've been saying this for an extended period of time. In fact, here on Bloomberg a couple months ago, 4.7%, 3-month, 6-month T-bills. It makes sense to me. I think it's a good idea to be in cash and cash equivalents. Some of my top picks in the equity space last year I continue to like, which are staples, underperformed this year, utility, energies, and healthcare in the equity space. And I think we do need to remain defensive under the expectation that this can't continue, right? We can't have record low unemployment in 53 years, productivity really kind of dismal, and labor costs still rising with the Fed getting to its 2% inflation target.
We're going to have to see. Thank you so much. Catherine Rooney-Vera with us at Baltic Capital Markets, joining from Miami. It's good to have the Miami view. I mean, are you and I going to be the last 2 people here? Farrow's, I think, destined for Miami.
What, you think so? You think he's a Miami person?
Yeah, he's like, he's cut and chiseled, and he'd be.
Are you going to wear like a short sleeve polo with a bow tie?
It's not me. I went, I've been down a couple times, and
you're not a beach kind of guy.
No, it's not the beach kind of guy. It's just the Florida thing. I'm trying.
Yeah, and a lot of it's been some of the tax shift that they're doing too. I want to build on what you were talking about, the 210 spread.
I agree.
I think that's notable.
Seriously, folks, this is an historic moment right now that we're having.
What you're seeing is the deepest inversion there going back decades. We now reached a new low, not on an intraday basis, but on a closing basis, just to give you a sense. But what this indicates is that people are willing to accept that much lower of a yield to invest for 10 years than in the short term. Again, why is tech rallying in the face of this?
Yeah.
Is it just that valuations still make sense? And maybe they do. I'm not saying they're not, but it raises a question.
I'm going to go back to Peter Fisher of Dartmouth and his public service to the nation, which is it's a four-box prisoner's dilemma in that the 10s are moving, the 2s are moving. You can have up, all down, or moving like this. On radio, this is really working out. But the answer is the ambiguity here is massive, Lisa.
Although the Fed's going to have to keep raising rates, and that has been the conclusion pretty broadly from the bond market.
Into the morning, into the next hour, futures up 34. This is Bloomberg Surveillance.
So now you've been at JP Morgan for about 25 years?
Yes.
Okay, so, and now you run one of the most important parts of JP Morgan, which is, I say, is the asset and wealth management business. What actually is wealth management, and how is that different than asset management?
Great question. The two are often used interchangeably, but they have distinctions. The asset management business is where we manage money on behalf of individuals, institutions, sovereign wealth funds, pension funds. We manage them in mutual funds, we manage them in ETFs, we manage them in single stocks, single bonds, hedge funds, private equity, and the like. And that is the heart of the fiduciary business that we run here at JP Morgan. Wealth management is that plus understanding someone's entire balance sheet. So for the individuals where we manage money, we also help them with their mortgage. We help them with a loan that they might need. We help them with their basic credit card. And so wealth management is trying to help someone with their entire life, both their assets and their liabilities, their planning, their gifting, the legacy that they want to leave for their families, the 529 plans they need to prepare to get their kids to go through college. And it's a great insight into people's, entire journey.
For parents and anyone out there who still doesn't quite understand, what exactly are kids doing on Roblox?
Kids on Roblox aren't just playing, they're learning, they're hanging out together. When they can't be together in real life, they're hanging out on Roblox. They could be playing hide and go seek. They could be pretending they're running a store or a pizza parlor. They could be making the next big game or adventure. So it's really a wide range of things, and it involves doing things together, pretending you're together.
Everybody's talking about the metaverse as something that's going to happen in the future, but there's an argument to be made that Roblox has already built a metaverse. What do you think?
I think we've started. There's still so much innovation to be done, and there's so much invention to be done in this category that it's mind-boggling.
This is Bloomberg.
The difference between a 2-year and a 10-year yield right now, negative 85 basis points, the biggest spread, the most deeply inverted yield curve we've seen going back to the early 1980s. Equity futures still elevated on the S&P, up 0.9%. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
From New York, coming up, President Biden expects the U.S. to avoid recession. Credit Suisse flagging substantial losses in 2023. And Disney cutting 7,000 jobs as Bob Iger looks for savings. We begin with the big issue. Corporate discipline returns.
Obviously, you're seeing some margin pressure here.
The recent layoffs.
You're seeing the cost cutting.
As companies are trying to figure out, how do I manage my balance sheet?
Companies are going to lay off workers when there's margin pressure.
They're focusing on the cost cutting.
Look, they're doing what they need to do to maintain profitability.
The Band-Aid ripped off.
The primary lever that they have to pull to defend their margins is reducing their labor footprint by reducing their employee expenses.
Protect free cash flow.
What I see is just broad-based margin pressure.
Margin pressures are going to be a significant headwind.
The cost cuts can only get you so far.
This is all about execution now.
Two key words right now, disconnect and discipline. Kroll's Megan Green joins us, Jim Bianco of Bianco Research. Megan, first to you. Let's talk about a disconnect. Do you see a disconnect at the moment between what you hear from the C-suite in America and what you see in the economic data?
Yeah, absolutely. Clearly, with the last jobs data being so incredibly strong, there's also a disconnect with headlines, right? We hear a lot about layoffs in the media, but it's not particularly broadly based. I do agree, though, that it could turn on a dime. So I do think that the labor market has held up so well, in part because there is a lot of labor hoarding. We don't really know how to measure it, right? It's anecdata more than anything else, but we do know that it's happening. And so it is possible that as corporate earnings fall because rates continue to go up, companies decide they're not going to hang on to those workers until the other side of this. They may capitulate, lay people off, and then I think we would get a broad-based downturn. In fact, that's what I think would push us into a recession, even more so than household savings being whittled down. If people start losing their jobs or their friends start losing their jobs, that's when they really retrench, and consumption is about 70% of our GDP. So I think that would be the real spark. It's just impossible to guess when it might actually happen because we haven't gone through this kind of labor hoarding before.
Looking at the numbers for jobless claims, and that's where you'd look for signs of weakness. 196,000 is the print. Just to come to you on that, Jim Bianco, that's the first pickup in about 6 weeks, but still, sub 200K. There's some pretty stellar numbers, aren't they?
Yeah, those numbers are very good. You would not associate any kind of a slowdown or recession with the claims numbers being that low. And as far as the layoffs go, for right now, the layoffs are really concentrated in tech and other high growth industries. After last year, I think a lot of these companies are being told it's time now that you start showing profitability or a path to profitability, and you just can't keep hiring people and losing money or not making a whole lot of money and promising us that down the road, many years from now, you will make money. We want to see it now. And keep in mind, too, with a lot of the layoffs that we're seeing, these are announcements, and we're going to lay off 7,000 people at Disney, but that could be through attrition. It could take a couple of years. It's not going to happen all in 1 month. And so this will not really show up as some giant spurt in the claims numbers.
So, Jim, that's good news for some of these equities, and maybe Meta, Facebook's a decent example of that. Discipline returns, the stock rallies. Lisa Shannon of Morgan Stanley said there was a massive disconnect in this equity market. She said history is not kind to these kinds of massive disconnects. Can you relate to that?
Yes, I can, because when you see the market switch on a dime and tell companies that we're high growth companies, don't worry about your profitability or your margins right now. We want to see big growth in the future. And now we're going to turn and say, okay, you need a new business plan. You need to start making money right away. That's easy to say. That's almost impossible for a lot of these companies to do. The managers, the culture has always been about trying to figure out a way to make money in 5 years or in 10 years, not to make money in the next 3 or 4 quarters. So it's going to be quite an adjustment for some of these companies.
The other disconnect might be what's developing in the bond market and what's happening in equities right now. We've got a 2-year, 10-year spread at negative 85 basis points. As I mentioned at the top of the show, that is the widest spread, the most deeply inverted yield curve going back to the early 1980s. Megan Green, what kind of signal can you take away from what's happening in the bond market right now?
Yeah, I mean, a yield curve is an indicator that a recession is coming, but it doesn't give us any indication of what the choreography is, what the timing is, how deep it is. So just because the yield curve is even more inverted now, I wouldn't take that much from that. I think a better indication actually is the labor market. It's a better indicator than any economist or the yield curve in terms of predicting a recession. If we see a jump in unemployment of a certain amount over a certain period, that's the best indicator for a recession. And as we've just mentioned, we're not seeing that. We're not seeing a deterioration in the labor market. And so, the chances of a recession have gone down a little bit. That being said, I think we will see it as the Fed continues to ratchet up rates, and also continues to shrink its balance sheet, which most people have kind of forgotten is happening in the background, but that is a significant tightening as well. So I wouldn't worry so much about the yield curve. I would worry more about the labor market.
We have hardly talked about QT. They wanted it to operate in the background, and maybe that's the way it's going, at least for now. Jim, I've always thought that if I'm willing to accept a yield that is 85 basis points lower on a bond with a maturity that is 8 years longer, that there must be some kind of signal the market's sending to me. What kind of signal is it sending to you?
Well, yeah, I mean, historically, as Megan said, the signal is that a recession or a downturn is coming, and that could still be mid-24. It could be as far as 18 months out in the future. And also, as Megan kind of alluded to too, is that the more inverted the curve gets doesn't mean the worst recession. It's kind of all the same kind of signal, whether it's 20 basis points or minus 200 basis points. It doesn't signal that it's worse because it's more inverted. It does suggest a broad-based slowdown will be coming. That's what the market is anticipating. But I think what Wall Street's mistake is they think that's March or April. But it might be March or April of 24, or it might be June of 24. And I'm not so sure that Wall Street has the patience to see that the recession is going to maybe unfold a little bit slower and longer than they think.
Well, corporate America's making a move. Disney, the latest, putting their cards on the table. We're looking at 7,000 jobs to go, $5.5 billion in cost savings, and the stock, Katie Lines, is rallying by 6.5%.
Yeah, investors rewarding this in a huge way, John. It is so interesting to see these companies going from grow, whatever the cost, to shrink your costs as fast as you can. That kind of seems to be how the tide has shifted for corporate America. Now, for Disney in particular, as you said, $5.5 billion in cuts in total. $3 billion of that is coming from slicing their TV and movie budgets. Remember, this is a company that invested billions of dollars into streaming, trying to grow that business during the pandemic. And now Bob Iger is throttling back in a massive way, trying to focus instead on profitability and expanding those margins, because we have not seen Disney's net income keep up with the rebound they've seen in sales, which is what is evidenced by this chart here. And this really is just a case of not trying to be a growth stock like Netflix, which initially was the ambition if you look back a few years ago. And we have seen these growth-oriented companies really across the board making these kinds of changes. That's evidenced by the slew of layoff announcements we have gotten from the tech sector, trying to cut costs, capture more profit, because we know companies universally are feeling that margin squeeze. Demand is slowing down in many areas, and costs from labor and beyond still remain elevated. So we have seen that margin contraction happening in the fourth quarter results that we've been getting, about 12.1% on average for S&P 500 companies. They're expected to stay tight in the current period. And yes, there is forecasted fattening to come later on this year, John. But if you do want to expand those margins, you want that to happen, you kind of got to make some changes.
These companies just aren't being rewarded to chase growth, to chase subscribers like they were in the last couple of years. Katie, thank you. They're being rewarded to cut costs, to protect margins. Apollo's Torsten Slock had this to say earlier this week, and we caught up with Apollo's Jim Zelter and talked to him about this market environment. This is what Torsten had to say. From hard landing to a no landing. I want to explore that theme. From hard landing to a no landing, investors have been underperforming their benchmarks because they entered 23 underweight equities, expecting a slowdown that still hasn't happened. Megan, we've talked about a hard landing. You and I have gone over a soft landing a million times. What do you make of this theme, this phrase, no landing?
Yeah, so I mean, I think what he means by that is just, significant amounts of uncertainty. So as Jim alluded to, I think investors have expected a recession to come sooner than later. That was never going to happen given the huge cash cushion among households and corporates in the U.S. economy. So, I think there is a lot of uncertainty. Are we going into recession? Are we not? Have we already been in recession? This is an academic debate that mostly economists care about. I think for most regular people, whether you're growing a little bit or contracting a little bit, it all feels the same. So, I think this idea that we would have any landing at all in the first half of this year was always wrong. We might be in recession in the second half of this year. As I said before, I think that depends entirely on the labor market and also how the Fed responds to the labor market and to inflation. It's possible it's being pushed off a bit further. There's also a scenario where different sectors of the economy go into recession at different times. So it's kind of a rolling recession. So we've already seen it in manufacturing. Maybe we're seeing it in tech. Services will eventually be hit. In a way, that's a great scenario because the overall economy doesn't go into contraction. So we don't have an overall recession, but actually inflation is brought down. So to some degree, that may be what the Fed is actually hoping for. But again, for regular people in those sectors, it's an academic debate, it's still pretty painful for them.
For everyone else trying to follow us, enough to make your head spin. Julian Emmanuel of Evercore was on the program in the last 24 hours. He said, if you're not confused right now, you're not paying attention. Jim, are you confused?
Well, yeah, I mean, this is a post-COVID economy, as I like to call it. It has different traits and it has different characteristics to anything that we haven't seen before. You know, and the labor market is probably front and center, you know, the most confusing of them all. The data that we see, whether we're talking about claims or payrolls or the 3.4% unemployment or even ISM employment, is confounding people because it's not showing any signs at all that the market is slowing. So that and a lot of other things about labor hoarding, as Megan talked about, that's a new concept that's mostly anecdotal and we're still trying to figure it out. Yeah, it's been very confusing because it's been so unlike anything we've seen before.
A phrase we keep going back to on this program, you can't fire what you couldn't hire. We're still trying to process the post-pandemic realities in the labor market, and then just to make everything even more confusing, China reopening. This is what Evan Brown and Luke Cower have got to say over at UBS. Evidence of economic reacceleration from US, China, and Europe is a more powerful catalyst for markets going forward. Cyclical areas of the equity market have more room to run. That's the equity call from Cower and the team over at UBS with Evan Brown. Megan, your thoughts on this too? It's not just the post-pandemic labor market realities we still need to make sense of, but also the fact China's reopening and what kind of growth impulse will we be importing from China?
Yeah, and I don't think it's just the growth impulse, it's the inflation impulse from China as well. But I would highlight that this reopening for China, this resumption of growth, it will look different than previous ones. In the past, they've been investment driven. So that's driven a lot of demand for capital goods from China's trading partners. This time around, it's consumption driven, and it's less that there's a massive stimulus and more that Chinese authorities have gotten rid of very restrictive policies. So you're not seeing a huge imbalance between supply and demand, I don't think, emerging in the Chinese economy. And again, it's consumption driven, so it will be domestic services driven. So in the past, when China's accelerated, it's really boomed for the rest of us. This time around, I don't think we'll get that kind of boom. I think China will accelerate from around 3% growth last year to over 5% growth this year. It might be mildly inflationary for the rest of us, but we won't get the growth impetus or the inflation boost from China reopening that we've had in previous Chinese booms.
Jim, final word on that.
No, I agree with that. And in fact, if you look at the commodities markets, the idea was when China reopened, they would suck up all these commodities and out the other side would come a burst of finished goods. Well, the commodities markets aren't really responding. It's been now almost 2 months, 2.5 months since the reopening was announced, and we're not seeing booming commodity prices. So as Megan was talking about, it may be more services, but we're not definitely seeing the, some big pull into the process of making a lot of capital goods to go out the other side. So it's very different than I think a lot of people expected just 2 months ago.
Can I just say my new favorite thing is anecdata instead of anecdotal evidence? I just think that's brilliant. Megan, did you make that up?
No, I didn't. I wish.
I think that's brilliant. Where's that from?
I'm not sure. It's just a
now.
concept we're using a lot now.
It's yours now.
Thank you. But it's the data's weird, and so we're having to rely on sentiment and ideas, and we don't know how to measure that stuff.
Megan, stick with us alongside Jim Bianco. Equity futures right now up 0.75%. Coming up on the program, President Biden throwing the R word out the window.
Do you think there's going to be a recession this year?
No.
That conversation up next.
The innovation agenda is going full speed on mitigation. That's where,
There's 100 companies Breakthrough Energy's funded. There's
by mitigation, you mean mostly energy. You mean everything to do with energy. You mean generation of energy. You mean batteries. You mean transport. You mean all of the new, and there's some renewables that are already traditional, but more that need to come on. So that's the package that you're talking about mitigation?
Yeah.
Or are you also talking about agriculture as mitigation?
Yeah, so every area of emissions, the world tends to focus on passenger cars and electricity. That's not a third of emissions. And so the focus on the easiest third, now 4% of new cars are electric, so that's the field that we're furthest along. About 4% of energy generation is wind and solar.
Good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets. China open.
This is Bloomberg Technology.
To our television and radio audiences worldwide, welcome now to Balance of Power. This is Bloomberg.
Yes, we were told I wasn't going to be able to pass the Inflation Reduction Act or the chip. We passed them all. People don't understandably don't realize all of our passed back in June, July, August to September. They're only coming to fruition now.
Do you think there's going to be a recession this year?
No, or next year. From the moment I got elected, how many of the experts are saying within the next 6 months there's going to be a recession?
President Biden doubling down on his State of the Union address, reiterating his confidence in the U.S. economy and even name-checking Xi.
Can you think of any other world leader in trade places with Xi Jinping? Not a joke. Can you think of any? Who would? I can't think of one. This man has enormous problems. He has also great potential. But so far, he has an economy that's not functioning very well.
China's government didn't like it. The foreign ministry calling the remarks, quote, highly irresponsible and a violation of basic diplomatic protocols. They went on to say, we are firmly opposed to that and condemn it. Bloomberg's Anne-Marie down in D.C. AMH, what do you make of that?
Well, the president is once again, Jonathan, taking aim not directly at China, but at Xi Jinping himself. This is basically a follow-on of what he said at the State of the Union, which was an ad lib. This was something he said off the cuff. It wasn't his prepared remarks saying, name me one leader who wants to trade places with Xi Jinping. And then in this interview, he talks about what he calls, quote, enormous problem Xi Jinping is facing. He looks at the domestic concerns of the economic complex in China right now, coming out of what many are calling a failed COVID-0 policy. What is China facing? Very high unemployment rate when it comes to the youth. They're facing a downturn in the housing market. There's a number of issues this economy is facing, and I think the president is trying to get that across to the American people, because a lot of the times what we see Xi Jinping and the Chinese Communist Party do is placate to nationalists and talk tough on the United States. But Biden's trying to point out that it's not all rainbows and butterflies over there in China.
That's the international story. Let's talk about the domestic issues as well. AMH, the president has been baiting Republicans over one single issue. How have Republicans been responding to it?
Yeah, this is Social Security and this is Medicare, and the president's going to do it once again today, Jonathan, because he is going to Florida. And of course, it is the senator from Florida, Senator Rick Scott, who first put this proposal about potentially sunsetting these entitlement programs. Republicans do not like it because Speaker McCarthy said that he's come out and said that these issues, Social Security and Medicare, are not on the issue. So they are saying that the White House is playing politics with not even, and the president, to his point, the State of the Union said he doesn't even think it's the majority of Republicans, but there are some members who brought this up. So they really want to make sure that they are taking this message to the American people, especially as the president is thinking about when he's going to announce his 2024 run.
Looking forward to it. When are we going to get that announcement? Anytime soon?
Maybe March, maybe April.
Maybe May, maybe June. AMH down in Washington. Anne-Marie, thank you. As always, Megan Green, Jim Bianco back with us. Now, drum roll, please, because every time I do this, people often reply with nothing. You said this, Megan Green, in your latest column in the FT. You said, forget Groundhog Day vibes on the debt ceiling. This time it's different. Why is it different this time?
Look, I think this time is different because we have a very clear destination. We need to lift the debt ceiling and absolutely no clear path to get there. So I actually think the risk of not lifting the debt ceiling is much higher this time. I would put the probability at around 15%, which is shockingly high for such a catastrophic event.
You also said
so I think it's
must,
very different this time.
Sorry, Megan, just to jump in, but you also said that investors must focus on it now. What should they focus on?
They should focus on the risk of a debt default. I mean, the longer investors are sanguine about it and just assume that politicians will stop dithering and you know, figure this out and raise the debt ceiling, the less pressure there is on politicians to do it. You see a lot of glib comments, particularly out of the right wing of the Republican Party, saying, well, it's fine, we can just prioritize Treasury payments. It's not clear we actually can do that, or even that it's legal. You know, there are a lot of things that the Fed might be able to do. Never mind that Jay Powell has called some of those mitigation efforts, you know, loathsome if we have to pull them out. So there's kind of a glib attitude among some of the politicians that we could just, you know, default. It's not a huge deal. And actually, given that, you know, we have the biggest, most liquid asset class in the world, and that the Treasury is a benchmark for a lot of other bonds, it would really roil U.S. and global markets. So I do think it's going to require market discipline to focus minds and get politicians to agree on this. And that's not going to happen as long as investors aren't really worried about it and just assume that we'll end up with a best case scenario.
Jim, do you agree?
I'm going to take the other side of that. I think this is politics as usual. I think as long as the perception is one side loses on this debate, the Republicans, that there'll be a lot of histrionics, and like all politics, you know, when we get to, if June 5th remains the date, it'll be a couple of hours into June 6th when they'll have a deal or something along those lines. But I don't think that right now that there is any heightened concern from investors, nor should there be. You know, you've had Rick Reeder on the show, and he says Wall Street's most concerned about the shark closest to the boat. And this is a shark that's well away from the boat right now. So if we're going to see investor discipline kind of forced it on the market, it probably won't happen until late May.
And this is the issue. And I guess this is the essence of your message, Megan, is that the market doesn't really care right now. You see that in the amount of guests that come on this program and say, same story, witnessed this a million times. And ultimately, won't they carry on pushing the issue down in Washington until the market cares?
Yeah, you know, unfortunately, I think that's right. And so this would be the mother of all own goals. I said I think that there's a 15% probability that we won't lift the debt ceiling and we'll have some kind of default, either on our treasuries or on the government's other payment obligations, you know, Social Security, firemen's salaries, soldiers' salaries. Either way, that's a shockingly high probability for such a catastrophic event. We cannot worry about it until all of a sudden it really is a big deal. But I do think it would be better for the markets ultimately if actually investors focused on this now, put some pressure on politicians to go ahead and figure out a deal. I'm not confident that that's going to happen, or I'm not optimistic that that's going to happen. I'm pretty confident that it won't.
Yeah, you don't sound that optimistic at all. Megan Green, thank you, as always. Just brilliant to have you back on the program alongside the fantastic Jim Bianco there of Bianco Research. Coming up, morning calls and later, tech giants squaring off as the AI race heats up. It's Google versus Microsoft. Plus, we'll catch up with Canaccord's Tony Dwyer.
And says, I want to be Ari Emanuel when I grow up. What should somebody do to get into the talent agency business or the business you're in?
Well, it's hopefully what I've taught my kids. You got to be intellectually curious. You got to be, you got to show up. And you know this like I know this. I got on a lot of planes. You just, even though that voice in your head is saying, oh God, I'm so tired, I don't want to do this. You got to show up. You got to be charmingly relentless. You have to build emotional endurance, because there's no straight line to success. It's kind of all over the place, and you have to just be able to work through those things. And then I think one of the things that I do every week is I try to create serendipity.
On the David Rubenstein Show, peer-to-peer conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
Equities up 0.8%. Let's get you some morning calls. First up, Roth MKM downgrading DraftKings to sell, expecting upcoming results to show weaker profitability. Barclays upgrading the New York Times to equal weight, seeing potential upside to long-term margins. And finally, KBW downgrading Bank of America to underperform, saying these stock trades at an unwarranted premium to its peers. First stock down 0.4%. Coming up, Canaccord's Tony Dwyer says it's all about recession, looking for a soft landing before getting more aggressive in markets. That conversation still ahead.
Amazon acquired Zoox back in January 2020 for what reports suggested was $1.2 billion. Since then, the company has revealed its Zoox vehicle. This is, I think, a rectangular passenger-focused vehicle with no driver's seat or steering wheel. How would you describe it?
We describe it as a purpose-built vehicle, but it's really a robo-taxi. That's its purpose. And essentially, it's about transporting people from point A to point B on demand in the most effective, cleanest, and most enjoyable way.
So why won't you call it a car?
Because a car is, there's an inference that there is a driver. Whereas in our robotaxi, there is no manual driving. A human cannot really drive it to transport passengers. So we want to make sure that that mindset, that shift, that distinction is clear.
The top names in business are on Bloomberg.
Different countries are at very different places, so you actually cannot speak in generalities. We expect to see a rolling series of country recessions, but the vulnerabilities that amplified previous recessions around the world are not present. That omens well for a mild recessions when they come.
Nobody covers business like Bloomberg, your global business authority. When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers jobs day like Bloomberg.
23 seconds away from the opening bout this morning. Good morning to you. Equity futures elevated by 0.9% on the S&P. The Nasdaq flying again, up by 1.4%. On equity futures coming into Thursday after the close on Wednesday, down about 0.5%. No real drama. There's your opening bout. Switch up the board and get to the bond market. Yields look a little something like this, down 3 basis points on a 10-year, sub 360, 358 on a 2-year. Started the year, or rather ended the year in 22 at about 442. Your 2-year right now, guess what? 442. Round trip. Euro dollar 107.87, positive 0.7%. The euro showing some strength. German CPI a week late comes in with a bit of a downside surprise. Whatever you want to read into that, it's come down from 10 to 9. I think the Germans still view that as a problem. Crude right now has had a massive run recently. Brent and WTI put together a 3-day rally worth $5, more than 6% over the previous 3 days. This morning we come lower by about 1.2% to $77.51. About 40 seconds into the session, we advanced 0.9% on the S&P. On the Nasdaq, up by 1.3%. One stock to watch. It's Disney announcing a massive restructuring plan, 7,000 job cuts. The CEO, Bob Iger, saying, we're going to take a really hard look at the cost for everything we make because things in a very competitive world have just simply gotten more expensive. Abby has more. Hey, Abby.
Hey, John. Yeah, and this is one quarterly report where it's less about the numbers and more about the color, of course, from returning CEO Bob Iger. And bottom line, it's all about that restructuring you were talking about. In fact, he said literally it's time for another transformation. So it means this cost cutting, $5.5 billion worth of cost cutting with a $3 billion trim to their movie and TV business. They're also eliminating about 7,000 jobs, many of those coming from a division created by the old CEO, Bob Chapek. In fact, right now we have Bob Iger doing an interview with a competitor talking about the idea that his structure, Chapek's structure, was a mistake, created a huge divide. So he's trying to correct that. As for the actual numbers, earnings did beat 99 cents by beating by 30%. Revenues basically in line. Subscribers, though, not so much. They posted 161.8 million subscribers, missed the mark of 164 with declines in each of the different areas. ESPN is now really a huge priority, but there was a decline there even. Overall, though, John, it really may just be a matter of confidence. This stock down more than 40% over the last 2 years. Bob Iger is back. He's really promising this transformation. One person right now that might be pretty pleased, Nelson Peltz, of course, the activist investors. He's asking for a seat on the board, but he's also asking for cost cutting. So it seems that he and other investors have had that. He also, John, is asking for reinstatement of the dividend. Bob Iger did say he's going to go to the board and ask for the approval of a modest dividend reinstatement. Perhaps that will help that stock turn around. Certainly that's happening today on the morning.
Abby, thank you. Disney up by 4%. Another sector to watch at the open. Casinos win. MGM results beating estimates as travelers return to Vegas and Macau. The MGM CEO saying there is strong momentum in our business and our 23 outlook remains bright. Kaylee has more. Hey, Kaylee.
Hey, John. Yeah, both of these stocks up 6% or more here in the first few minutes of trading after, as you said, they topped expectations. Revenue coming in ahead of estimates. Mind you, they both still reported losses per share. So this is a recovery we're talking about. We aren't fully there yet. But specifically in China, the picture is getting a lot better because remember, Macau, the gambling enclave, made up a huge portion of these companies' revenues pre-pandemic. That meant they really struggled in this market when China was locked down. But with the reopening of China at the tail end of last year, you really saw that recovery taking shape. Wynn's Macau mass table drop, for example, has reached 95% of 2019 levels, hotel occupancy at 96%, and MGM's VIP gaming tripled in the fourth quarter from the levels seen the quarter prior. Then the Lunar New Year holiday guidance also coming in quite strong. The daily EBITDA for both of these names during that holiday last month seen in the millions. 4 million for MGM China, 5 million a day for Wynn Macau. So the gamblers are back there in a big way. This is why we've seen a massive rally in these and other Macau casino stocks. We've seen them more than double off their lows of last year. A BI index that tracks these names is up 124% since the end of October. So only a 3.5-month period. Plus here in the U.S., as you alluded to, John, this isn't just a Macau story. Las Vegas is going strong. One analyst over at Jefferies, when looking at results today, said Las Vegas is starting to sizzle, which sounds pretty fun.
Some of those moves have been phenomenal. Katie, that does sound fun. Katie Lyons, thank you. Let's turn to tech. The race for AI heating up. Microsoft challenging Google in a massive way. Quote of the week to the Financial Times. Satya Nadella, the CEO of Microsoft, said this: from now on, the gross margin of search is going to drop forever. There is such margin in search, which for us is incremental. For Google, it's not. They have to defend it all. Ed Bluntland on the West Coast with more. Ed, this message is pretty simple. Your margins are opportunity.
Yeah, and it's why the market's watching every single development when it comes to Google's efforts around AI to boost search. The share's down 1% adding to the declines we saw yesterday, which was the biggest single-day drop since October. What's so fascinating about this story, the market responded to reports about a video that Google had posted Monday, 48 hours earlier, in which they demonstrated or gave an example of what their AI-powered Bard search could do. In the video, which Google posted themselves, a question was posed, and one of the answers given was inaccurate. We can go over that another time, John, on the specifics. 48 hours later, the media, to be fair, and the market noticed, and there was a severe sell-off in Google shares. The point of it is the intense interest in what this does for the search market. You can see in this Bloomberg Terminal chart the complete ramp up in coverage of stories generated about AI in recent weeks since the start of 2023. The fact of the matter is this: Alphabet and Google dominate anywhere from 80 to 90% of the search market, depending on various third-party data sets. For Bing, Microsoft's search engine, that's around 9%. But they've got first-mover advantage. They've played their hand in terms of what their investment in OpenAI and ChatGPT can do to improve their search offering. Now, look at this chart. These seem like spectacular gains. There is some speculative diving in here on anything AI-related in the equity markets. One thing I point out to you, John, on those names, which the chart doesn't show, the thing they have in common, they all went public via a SPAC, and they're nowhere near their post-de-SPAC highs. So there is an element of speculation here in the markets around artificial intelligence.
And as Mandeep Singh has said previously, in fact, in the last week, Google quite literally is a verb. How's Microsoft really going to challenge this? I understand the excitement around the story, but it's pretty early days, isn't it?
Yeah, it's interesting. I mean, if you look at the breakdown of Microsoft's financial results from last year, search broadly generated $12 billion of revenue. Most of the street and the market doesn't see actually a huge boost to the top line by investing in Bing. But there is this idea they can claw back some market search. Google is by far and away the dominant player. But as Nadella alluded to, I think what they're fighting over is an increasingly lower margin business where you bring in eyeballs and advertisers based on the competence and the uniqueness of your AI offering. That's what the street's looking at.
Interesting. Ed, you and I are going to talk about this for a long time. Can already see it.
Can't wait.
Ed Ludlow, thank you, buddy. As always, when was the last time you saw someone like Satya Nadella call out their competition so directly like that? Just absolutely amazing. Alphabet down another 2%, Microsoft up another 1.5%. You brought a market up 0.75% on the S&P, on the Nasdaq up about 1 full percentage point. Tony Dwyer of Canaccord Genuity saying it's too soon to call the recession off, says the following: despite the strong labour market reinforcing the soft landing, the Treasury yield curve and leading indicators have only served to reinforce the recession call. It will take more time to disprove a recession. Tony, I'm pleased to say, good friend of ours, joins us now. Tony, wonderful to have you with us. Here's your line: using a slow cooker in a microwave market. Can you translate that for me?
But I don't even know why you're having me on. All you got to do is chat GPT. What is the market going to do? And then you don't need people.
It's that
like
simple.
Me.
Rule out of a job, Tony.
No, so using a slow cooker in a microwave market, there's times, as you know, John, when the market signals on a very near-term basis can be wrong. We're having 1% moves in the currency markets. We're having big moves in, obviously, the bond market. We've had intraday moves of 1% continually in the stock market. The issue here is there is going to be one side of the trade that is going to be epically wrong in this situation. Either every single macroeconomic indicator that has served to show a recession is going to be wrong this time. Not just the yield curve, not just the Conference Board leading economic indicators. 2 days ago, the Federal Reserve released the Senior Bank Loan Officer Survey. You've never been at this level of tightening credit standards without going into a recession. So unless all of those are wrong, it's just a matter of time before you have enough duration to have the higher interest rates really impact economic output.
Tony, I know you often look to fixed income for some kind of signal to credit and try and understand what it might mean for equity. Credit spreads have been aggressively tighter to start the year. Then in sovereigns, you've got this deep curve inversion, 2s versus 10s, which has dropped to about negative 85 basis point. What kind of signal do you take, Tony, away from what's happening in sovereigns, in the Treasury curve, and what you see take place in corporate credit?
There has been an extraordinary move into risk. So, John, as you know, we we'd look for that fourth quarter rally, the year-end rally, because things had got so pessimistic in October. And we got more defensive in early December when you're up about 13.5% off of that October low. Since that time, you've seen a pretty significant easing in financial conditions. And, you know, when you see the Fed chairman, Jerome Powell, not really push back that hard on, well, there has been an easing in financial conditions, meaning tighter credit spreads, that opens up the availability of money for companies. And that's a good thing. What I find is also a little bit interesting at this point is the new buy signal somehow is we're reducing our workforce. Usually when you're coming out of an economic slowdown, whether it's a soft landing or a recession, you want to have prospects for higher growth. John, my issue here, let's say the macro stuff's totally wrong. There's no recession. You've already made the low. We're at 19.5 times my $210 estimate for this year. Let's say consensus is right. You're at 18.5 times. In a core inflation environment, let's say it comes all the way down to 3 from current 4.5. Where are you going to get the money for growth when money supply has been so negative, and when bank lending standards are the tightest they've been this cycle and in a recession level, when confidence even on an uptick is historically weak, and you're already at full employment? So even if you don't go into recession, where are you going to get the money to have meaningful growth to warrant an 18.5 times very unlikely earnings number?
Well, Tony, tell me where you think is most vulnerable right now. The S&P 500 year-to-date up 8%. Got the NASDAQ up about 15%. We can do some single names. Meta year-to-date up 54%. Off the lows of January, intraday on Tesla, I can tell you Tesla's now up since those lows by more than 100%. Tony, what's vulnerable here?
Right. I won't speak to an individual stock, but the mega cap tech stocks, when you look at the NDX versus the SPX, it's on a relative basis pretty historically overdone. So I would look for that space to come down. But John, here's an interesting thing. Coming into when we last spoke in December, I think we've spoken since then, but in December, everybody in the universe was loving energy, loving industrials, loving materials, and loving financials. Those areas and not liking tech, those areas when we had said pull back on them were definitely the favorite. They have now given back all the relative performance going back into November. And actually on the energy, you're back to the June relative performance level. So I think we've got to be very careful. And I want to be very clear here. Even if you go back to the low, I don't want to get too bearish. There's a big difference between negative on the economy and where you want to be in the stock market. The problem is if you go back there, it's going to feel so gross and it's going to be so bad that people will accelerate a negative bet. I want to be prepared for when it gets down there, so not overly defensive. I call it being light and tight. Maybe lighten exposure if you're an investment partnership or you have the opportunity to raise cash without a big negative bet, and a little bit defensive because it can all get hit, right? You're going to go down. If you have a recession, the cyclicals are going to get hit on top of the NDX companies that have led.
Light and tight sounds like a workout, Tony. You know that.
Buddy, I'm a strategist. I'm supposed to do marketing, you know?
Tony Dwyer, Tony, thank you, buddy. It's always good to catch up. It's a difficult moment. Do you really want to stand in front of this? Some of these rallies are so powerful. The move in Tesla, the move in Meta, the move in the NASDAQ. I think being short's one thing, and that's expensive. But just getting out and fading the strength, that's what JP Morgan's advocating for. It's what Mislav Matejka has said a few times, and some other people suggesting get to the front end. 4.5%, walk away. It's a confusing time. All I can say is, let's look at these numbers, and this rally is looking pretty powerful for tech so far year to date, and it was very unexpected, and that's why I know a lot of you have written in and said this is not about valuations, this is about positioning, it's about flows, it's about short covering, and it is very, very, very powerful to stand in front of. That's the move so far. I want to get you some breaking news that came in at about 10 minutes ago, down in Washington. Anne-Marie has more. Anne-Marie, what have you got?
Hey, Jonathan. Well, it does look like what China says is a research balloon in terms of climate research is inconsistent with the State Department. An official from the State Department briefing reporter says is that this was not that. What the Chinese Liberation Army was doing was collecting data across 40 countries. And what this had capabilities of on this spy balloon was actually being able to collect communication signals. So clearly the United States shot down that balloon, and they are right now doing a lot of that research on what this entails. And they are also doing research and discussing all of this with their allies, Jonathan, because right now what you are seeing is an inconsistency from Beijing, and also the fact this might trouble Xi Jinping because it may make more countries weary of China in terms of their economic policy as well as their intelligence gathering.
AMH, thank you. On the latest in Washington, about 15 minutes into the session, we advance 6 or 0.7% on the S&P. On the Nasdaq, up 0.8%. Credit Suisse down and down hard through most of today. Coming up, Credit Suisse posting a pretty grim quarter.
The results are unacceptable, obviously, and that's why we created a new strategy, transformation program to create a new Credit Suisse, much more focused, simpler, built around client needs.
That conversation still ahead.
Complicity with the international finance institutions, including particularly Goldman Sachs, is there. Otherwise, one MDB wouldn't have happened. You can't just get away and by ignoring your moral responsibility. And I think Goldman Sachs should come out clean and deal with Malaysia.
We've invested more than $10 million in our employees over the past year, and we're going to continue to invest more. We're testing 4-day work weeks to help, especially our working parents kind of juggle that balance between childcare and your work. I know I deal with that all the time. This is really a people-first company. Even in an inflationary environment, you're going to see us continue to lead with our people.
Do you worry at all about a price-wage spiral, not just here, but in the industry, in the economy?
Yes, and I think that this is something that many business leaders are focused on, and time will tell kind of how all of this lands.
I think the wage price spiral continues for quite some time, and I think we probably have been a lot less aggressive than we can be, and than many other companies have been.
In terms of raising prices?
Yes, we've taken our time. If you look at the 20-year history of pricing in this company, we've taken about 2% a year on average. We've never taken what we could. We've always taken what we should. We have to pay people more. We have been, and we'll continue to do so. We'll take a little bit of a margin compression on that as we've had to, and I think that's the right thing so that for the long term, Shake Shack continues to be what we're building, which is the next generation's burger joint.
News breaks. No one covers the world like Bloomberg.
Return to pragmatism is really that everybody's in line. The government, the enterprises, the people, in pushing this economy. It's like a cycle of renewal.
Big tech layoffs rolling in. Spotify, the latest to tighten its belt, with plans to cut 6% of its employees.
Is the economy unfolding as you thought it would?
I think the economy is responding to work that the Federal Reserve is doing.
Bloomberg, your global business authority.
The results are unacceptable, obviously, and that's why we created a new strategy, transformation program, which we, as you know, communicated end of October, to create a new Credit Suisse, much more focused, simpler, built around client needs, in the midterm very profitable, and we are executing at pace.
Not inspiring for this stock market. Credit Suisse down 12%. Credit Suisse posting a fifth straight quarterly loss. Clients pulling a record $120 billion as the bank warns of more losses this year. KBW scathing. We expect to see another wave of downgrades and see no reason to own the shares. On the story, Bloomberg's Marion Hoftemeyer joins us now in Zurich. Marion, this doesn't read well at all, does it?
This was horrible. This wasn't just a grim quarter. This is the worst annual loss the bank has had since the great financial crisis. So that really puts into context the dire circumstances they find themselves in. And what's worse, and what was arguably more shocking to investors and analysts, was this huge outflows that you mentioned, $120 billion. That is just phenomenal and unprecedented at this point. And the effect of that is, you know, you have this bank, and you heard Uli Kerner, the CEO, speaking earlier, this bank whose strategy is underpinned by being focused on the wealth business, and that very business is in jeopardy right now.
So, Marion, they've got to hold on to clients. They've also got to hold on to talent. I understand they cut the bonus pool by 50%. They're effectively communicating to their staff there's going to be no profit in 2023. We'll return to profitability in 2024. So who knows what the bonus pool looks like for the current year. Marion, how are they going to keep hold of both clients and talent simultaneously?
That's what makes this coming year so difficult on management, and arguably even more difficult than when they set out this plan in October. They are going to have to really convince clients and their own employees that the upside story is what they want to stick around for, and that means, you know, paying out vested shares that come out later, more upfront cash payments, which is what they've been doing. And for the clients, you know, Uli Kerner hinted, they have been on this nonstop on the phone, talking to every client that they can and trying to get that business back.
Marion, this was brilliant and fantastic coverage all through the morning and the day over in Switzerland. Marion Hoftemeyer there on the story, alongside Francine Lacroix, did a fantastic job with the CEO a little bit earlier on. If you can find that interview on Bloomberg.com or on the Bloomberg terminal, check it out. The job cuts, though, coming through in the finance industry. We're seeing it all over the place now. JP Morgan, AllianceBernstein joining the list of companies cutting jobs. The CEO of AllianceBernstein said this: we expect continued volatility in global financial markets as inflation and interest rates expectations evolve, with related impacts on the economy and corporate earnings. Kaylee has more. Hey, Kaylee.
Yeah, 100 employees being cut globally, firm-wide at AllianceBernstein after they saw a 17% drop in assets under management. So they're trying to reduce their headcount in order to rein in costs as that dynamic unfolds. It's a reminder that even though we've talked ad nauseum about layoffs in the tech sector, it is not limited there. It has spread to finance as well. On the point of JP Morgan, it's hundreds of employees in their mortgage business specifically, which, as we know, has been hit by the slump in housing. Mortgage origination volume slumped 60% for them last year, and we've seen other banks like Wells Fargo making similar cuts to their own respective mortgage businesses, thanks very much to the Fed hiking rates. And we know that other businesses have slowed down for these banks too. So it's not just about the employee headcount, it's also what you're paying those employees and that bonus pool, the conversation you were just having with Marion. Then within the broader finance umbrella, including fintech, look at Affirm, a buy now, pay later company, announcing a 19% cut to its workforce as it grapples with economic uncertainty. That stock is down 13% right now, John, after they missed big and cut their outlook. The CEO saying they need to focus on being leaner as revenue growth slows. So it comes back to the conversation we were having earlier. It is no longer about growth. It's about profit, John.
Is it no longer about New York? Kaylee Lyons, was that it? Is this it?
That was it for now,
over?
John. Yes, I'm heading down to Washington.
Very cool. To do what?
Be talking more about regulation. I'll still be hosting Bloomberg Crypto every Tuesday at 1 p.m. Eastern and doing more exciting work on policies.
Are you going to join us? Are you going to join us still? Can we make that happen?
I would love for that to continue to happen.
Can I just say you've been phenomenal?
Thank you.
I know the audience knows how early you wake up, but you still jump into that seat to join us and help guide us all through these markets, and we appreciate it. Kaylee, just fantastic, and I know you're going to go on to fantastic things down in DC as well. Kaylee, thank you. Coming up, the market moving events you need to know. That'll be next in our Trading Diary.
now? Why'd you do this project?
Yeah, YouTube is this kind of a sleeping giant in social media. Someone described it as like this iceberg that no one ever really talks about as much for a variety of reasons. I see YouTube as both the past and now future of social media, and it was the first company to pay online broadcasters and invented the creator economy. And now we're seeing with TikTok, Instagram, Snapchat are all moving in this direction. Social media is no longer your friends and family and your acquaintances. It is influencers. It is celebrity. It is a game built around commerce. And this is a world that YouTube very much created.
Should we be telling Odd Lots listeners to like, comment, and subscribe? Other podcasts do that.
I mean, it's an effective call to action.
All right, everyone, like, comment, and subscribe on Odd Lots wherever you find it.
25 minutes into the session, we advanced by 6 or 7/10% on the S&P, up almost 1 full percentage point on the NASDAQ. That's the price action. Let's get you the trading diary. Coming up, President Biden discusses healthcare at 1:30 Eastern Time. Lyft reporting results after the closing bell. Uber numbers earlier this week, pretty decent. More Fed speak coming from Waller, Harker on Friday. And then the UMich Consumer Sentiment Survey to close out the week and get you to the weekend. From New York City, that does it for me. Thank you very much for choosing Bloomberg TV. We'll get you to the weekend tomorrow and look ahead to CPI. And on Valentine's Day, that's the next big stop for this market. This market so far, though, looking pretty decent. Good luck for the rest of the trading day. This was the countdown to the open. This is Bloomberg.
The innovation agenda is going full speed on mitigation. That's where, there's 100 companies, Breakthrough Energy's funded. There's
by mitigation, you mean mostly energy. You mean everything to do with energy. You mean generation of energy. You mean batteries. You mean transport. You mean all of the new, and there's some renewables that are already traditional, but more that need to come out. So that's the package that you're talking about mitigation? Yeah. Or are you also talking about agriculture as mitigation?
Yeah, so every area of emissions, the world tends to focus on passenger cars and electricity. That's not a third of emissions. And so the focus on the easiest third, now 4% of new cars are electric, so that's the field that we're furthest along. About 4% of energy generation is wind and solar.
So you've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
They have.
I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
Multi-trillion-dollar industry. There's a lot of ground to cover.
Commodities got absolutely crushed.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ. Monday on Bloomberg. Why Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question.
Best question I get all night.
Bloomberg, top experts, great questions.
Pepsi's Number Fever campaign in the Philippines has probably gone down in history as one of the biggest marketing disasters in history, mainly because of a human error that led Pepsi to print more winning caps than they planned. The resulting chaos caused riots, civil unrest, and even deaths. Reporting this story took over a year, and it resulted in me flying to Manila in the Philippines to meet unlucky winners and to find out exactly what happened back then in the 1990s. My name is Jeff Maish. I'm a journalist based in Los Angeles. I wrote the story for Bloomberg Business Week about Pepsi's Number Fever campaign. The Philippines is a really interesting country. It's made up of thousands of islands, and it's also a country that's very heavily influenced by America. American culture is everywhere you look in the Philippines. They're obsessed with Frank Sinatra music, for example. They love all things America, and that extends to their love for soft drinks, Pepsi-Cola, Coca-Cola. In the 1990s, it was everywhere. Pepsi and Coca-Cola were embroiled in what is now known as the Cola Wars. It was a fierce battle for market dominance. Number Fever was already a really popular promotion. It had been rolled out in America to great success. And so Pepsi decided to roll it out internationally, particularly in Asia. They thought it was the answer to their problems. They thought it could finally help them beat their biggest competitor.
Look for the winning number in Sari stores every day, also on TV, radio, and newspapers. You could be a millionaire.
$1 million pesos, or $68,000, doesn't sound like a lot now, but in 1992, that was a phenomenal amount of money. You've got to remember that in the Philippines at the time, the average monthly income was about $100, so $1 million pesos was wealth beyond anyone's wildest imaginations. Number Fever caught fire in the Philippines. Kids were saving up their pocket money to buy a bottle of Pepsi. Parents were squirreling away all of the bottle caps in bags. You would walk down the street and people were going through trash trying to find discarded bottle caps. It was a national phenomenon. Pepsi boasted that half the population of the Philippines was playing it. Number Fever boosted Pepsi's sales every month from $10 million to $14 million. It had a huge impact on Pepsi's bottom line. Number Fever quickly became number hysteria. Maids were being jailed for stealing their employers' winning bottle caps. There was even some murders over winning bottle caps. People were fighting in the streets over these caps. There were signs that there were going to be problems with Number Fever very early. Pepsi had rolled out the competition in Chile, and a garbled fax had caused some kind of problem with the winning number. They'd announced the wrong one in Chile, causing riots. There were signs that there could be big problems ahead if they didn't keep their eye on the ball. So in 1992, Pepsi decided to extend the campaign in the Philippines, and they announced that the competition would go on for a few more weeks. One night, on the television news, they announced the latest winning number, 349. The problem was, 349 had already been allocated as a non-winning number in earlier campaigns. So there were literally hundreds of thousands of bottle caps with 349 just floating around the Philippines. Hundreds of thousands of people all across the Philippines, thousands of islands, were finding winning bottle caps. 349, 349. Some people had 10 lucky 349 bottle caps. People were dancing in the street, celebrating. They thought their problems were over. They were millionaires. It's still not certain exactly how many winners there were of Lucky 349 bottle caps, but we know that Pepsi printed over 600,000 of them. Pepsi realized very early that there was a problem. Hundreds of people started arriving at their bottling plants with their Lucky bottle caps. They realized something was seriously wrong. Pepsi tried to solve the problem by offering a small token donation to anyone that brought a Lucky bottle cap to their bottling plant. But it wasn't enough. People didn't want just a handful of pesos. People wanted their million-peso prize. Within a year, violent protests and riots outside Pepsi factories would leave dozens injured and 5 people dead. At one Pepsi factory in the Philippines, a grenade was thrown through the window. It killed 3 Pepsi employees. Anacita Rosario was a school teacher living near Manila in the Philippines. She was one of the tragic victims of this whole thing. She was walking to a nearby store to buy some rice one day when a Molotov cocktail was thrown at a Pepsi truck in a violent protest. It bounced under the truck and exploded. It killed her and an innocent bystander who was just a child and injured many others. When I was in the Philippines, I tracked down Anacita's daughter, Cindy, and her husband, Raul. It was clear to me that they were still very upset by the whole thing. You know, a family had been ripped apart by this competition. And Raul told me that he'd never remarried. He'd told me that he'd gone to meet Pepsi executives after his wife was killed. And he was angry. He said to them, you know, this wouldn't have happened if it wasn't for you, if it wasn't for Number Fever. The biggest revelation from my reporting was rumors that Pepsi was somehow involved in bombing their own trucks. I found a newspaper report with a headline that said, "Pepsi goons bomb their own trucks." And when I visited the MBI, the police department in the Philippines, they presented me with documents and interviews with people who claimed that Pepsi had paid them to cause riots and to cause trouble outside their plants in order to destabilize the situation and to frame the owners of the coalitions that were fighting them to try and curry favor. I just thought that was so shocking. And of course, Pepsi denied it, but how bizarre that a company would be accused of bombing their own trucks. The contest had sparked so much anger in the Philippines because it landed at just this really weird time in the Philippines' history. It was during a crazy election that was racked with allegations of fraud. The Philippines was in a kind of love-hate relationship with America. They loved, obviously, the American aid and finances that was pouring into the country, but at the same time, they yearned for independence. They wanted to be their own country. Vicente Del Fierro was a local preacher living in Manila, and he hated the Number Fever campaign. Del Fierro thought Pepsi's Number Fever campaign was just one of the many ways that America was asserting its dominance over a third world country. He hated seeing his fellow countrymen get ripped off, in his eyes, by this huge multinational American company. He wanted justice. Del Fierro rounded up over 800 winners of 349 bottle caps, and he got them all together to sue Pepsi for over $400 million to be divided between those holders of Lucky bottle caps. Del Fierro took money from some of the people who could afford it. They paid him 500 pesos to help with legal fees, but for people who couldn't afford the money, he would just represent them pro bono.
The alliance is to build up pressure on Pepsi. And so you see people marching in the streets. So we had mounted our own campaign, even in the U.S. He flew to America and he hired 2
consumer lawyers here in America to take on Pepsi. He had a meeting at Pepsi's headquarters to try and resolve the problem, but he said he wanted to take it all the way to the highest courts in America. When those cases were heard in America, those courts decided that this was a problem that should be heard in the Philippines, not in America. Back in the Philippines, Del Fierro continued his case in the Filipino courts. At one stage, there were arrest warrants handed out for 9 Pepsi-Cola executives, which he saw as a big victory. We don't know if those arrest warrants were ever upheld, but it made newspaper headlines across the country. Pepsi did not take kindly to Del Fierro's campaign. They tried everything to shut him down. They sued him for libel.
My father had to attend 3 times a month for a branch 145 and another hearing for the branch 113, also 3 times a month. Also, there was a time my father was hospital due to heart failure. Still, he had to attend the 2 branch hearing. Otherwise, for not attending, the judge will issue a warrant of arrest to my father. My father passed away January 13, 2010. After staying for almost 1 year in the hospital, he died of complication due to heart failure. After the death of my father, I was inspired to do the website. PepsiCo will be remembered for what they did to the consumer in the Philippines and to my father.
When I reached out to Pepsi for comment for this story, they claimed that they didn't have access to anyone who was working at Pepsi that was around in those days. They also said that during COVID-19, they didn't have access to their documents about this, but you know, they were very careful to say that they were sorry for everything that happened, and we do know that Pepsi did try everything to try and make this right. The Pepsi number fever disaster cost the company millions. We know that they paid up to $10 million in those goodwill payments, but the financial effect could be much greater. After the disaster, we know that Pepsi sales dipped. They were overtaken by Coca-Cola again. Pepsi's number fever disaster changed the legacy of that soft drink in the Philippines forever. Some people of a certain age won't touch it. For many people, Pepsi is a taboo word. A lot of the people that I spoke to were still quite traumatized by their experience, by that experience of winning $1 million pesos, losing it, and then returning to their normal life in poverty in Manila.
When the news of the bombing came out, it was a massive story in Germany.
We are following some breaking news coming to us out of Dortmund in Germany.
It was covered by all the media outlets.
3 roadside explosions triggered at the same time last night as a coach left its hotel in the south of Dortmund.
Public figures commented on it.
We should not let them affect our life, whoever it was.
The media echo went far beyond Dortmund.
I think it was front page news in every single big paper around Europe. Everyone thought of like a terrorist attack, and people were scared that throughout the city in Dortmund there was more attacks to be happening.
Unbeknownst to investigators, just after the bomb went off and the players of the team were shell-shocked, the person who had masterminded the attack was actually sitting in the hotel eating steak and sweet potatoes. My name is Thomas Rogers. I'm the journalist who wrote the article, The Get-Rich-Quick Scheme That Nearly Killed a German Soccer Team. Dortmund is a mid-sized city in the western part of Germany in a state called North Rhine-Westphalia. And it's a former industrial city that's kind of fallen on hard times in the last few decades. It was severely bombed in the war, so the center of the city is quite stark. Some of the few high points include its soccer team.
My name is Ike Henning. I'm a reporter with Bloomberg News, and I'm a great fan of Borussia Dortmund. Dortmund fans are super loyal. On all match days, the entire city is in black and yellow. It's like a religion.
I think more than most German cities, soccer does play a very large role in the identity of Dortmund. In October of 2000, the BVB became the first team in the Bundesliga to actually go public. Salaries for soccer players in the Bundesliga have gone up very dramatically. With such high prices, they thought that by going public, they would be able to compete better with big teams like Bayern Munich.
Unfortunately, that didn't go too well. Dortmund bought too many expensive players, high wages, and the club almost went bust in 2005.
The price of their shares, it has sometimes gone up, but mostly gone down since they made that decision. So on April 11th, 2017, the team was staying in a hotel on the outskirts of Dortmund.
Match days are always special in Dortmund. Everyone is looking forward to it. The team always meets in the same hotel ahead of matches.
They stayed in this hotel in order to have a kind of neutral space before games so that they could concentrate, be sort of isolated from distractions, things like that.
Everyone was pretty optimistic they had a chance to go really far, maybe into the finals. I was in the office and getting ready for match day. I was going to meet with a friend, a fellow Dortmund supporter, in a pub. As always, the fans are very excited about matches.
On that day, they were heading to play in the quarterfinal against AS Monaco at Signal Iduna Stadium, which is in the center of Dortmund. Shortly before 7 p.m., the players of the team boarded their official team bus.
When the bus took off the parking lot of the hotel and turned on the street, there were three detonations, 3 bombs that exploded and hit the bus of Dortmund.
3 explosions occurred close to the Borussia Dortmund team bus. The B team bus had just left the hotel. The explosions destroyed 2 windows in the rear part of the bus.
People screamed, people jumped to the ground.
The fellow Dortmund fan I was supposed to watch the match with, he called me and said, turn on the TV, there was an attack at the Dortmund bus. And I thought he was like, that was impossible.
Some of the players screamed at the driver to keep driving as fast as possible because they were worried that people might storm the bus.
German investigators say the explosive devices used in the attack on the Borussia Dortmund bus contained metal pins, and that one had pierced a seat headrest.
Unbeknownst to the team members, the actual mastermind behind the attack was, as they were disembarking the bus, was actually eating steak and sweet potatoes at the hotel they had just left.
Authorities are attempting to verify a letter left at the scene claiming jihadists were behind the attack.
Because there had been a series of attacks by Islamic terrorists in Germany and Europe, there was widespread suspicion in the media that this was another Islamic terror attack. 3 letters were found at the site of the bombing that took credit for the attack on behalf of Islamic State. There were, however, reasons to doubt this particular narrative.
Would actually be a surprise if ISIS were actually part of this attack. Possibly could be employed by other groups like the far right wing to try and shift the blame.
The letters had some strange qualities. They were written in a strange German that used big sophisticated words, but had basic grammar mistakes, as if someone was native German speaker but pretending to be a foreign person.
Federal investigators have detained one man suspected of links to Islamist terrorism, one of two suspects whose apartments were raided this morning.
Shortly after the bombing, a man in Austria named Rudolf, who was a big BVB fan, he noticed that something strange was going on the stock market related to the team's shares. He emailed the lawyers of BVB, who then forwarded that email on to investigators. The email stated that someone had bought 60,000 BVB put options, a wager that the value of the shares of the team would fall below a certain amount at a certain date.
Why would someone buy that ahead of a match and then 3 bombs go off? Something isn't right here.
For the person to make money off of that, it required the stock to go down quite a bit in a fairly short period of time. And it wouldn't just be the team losing a match, it would require something much bigger than that. There was another big red flag about this purchase, which is the fact that it had actually been made, number one, on the day of the bombing, but also from an IP address that had been traced to the actual hotel where the bombing had taken place.
When 3 explosions targeted the bus carrying the Borussia Dortmund footballers on April the 11th, written notes left at the scene claimed the attack was the work of ISIL. The truth, as is now alleged, is remarkable.
On April 21st, the police arrested a man in a southern German city called Tübingen. He was on his way to work, and his name was Sergei Venergold. He seemed like an unlikely suspect because he had no known connections to the Islamic terror world. He didn't seem like a far-right extremist. He didn't seem like a left-wing extremist either. He seemed to be a completely unremarkable young man.
A 28-year-old German-Russian man, named only as Sergei W., stayed in the same hotel as the players on the night before the bombing. He specifically requested an upper room overlooking the bushes where the explosive devices were hidden.
The media dissected why he would do that, what was his past.
He had been inspired by the 2015 terror attack in Paris. And he noticed that in the aftermath of the attack, the stocks of French companies went down. And he believed that if an attack took place that was directed at a specific company, that the decrease in stock price for that company would be even more dramatic.
It never occurred to anyone that someone would do that out of greed.
We now know that the suspect bought 3 different derivatives on the Borussia Dortmund shares. With all these derivatives, he bet on falling shares. The suspect bought the majority of these financial products on the 11th of April, the day of the attack.
If the plot had been completely successful and the stock had reached a value of 0, Venergold would have made up to 570,000 euros, or the equivalent of about $608,000. Ultimately, the plan completely backfired.
The attacker, Sergei Venergold, didn't make any money. In fact, he lost money.
In court, he would be extremely quiet. He usually kept his hands clasped together. One of the lawyers actually commented that he had never seen a defendant act so calmly. Venergold had served some time in the German military. From that information and from online research, he was able to figure out how to assemble remote detonated bombs that would do what he hoped to do. There were a few days of extremely emotional testimony, including the soccer players who described doubting whether or not they could ever play another game again.
It brought everything back up, and it didn't quite help them to kind of process what was going on.
Throughout it all, he sat there completely silent. The big mystery that was swirling around the trial was the question of why. He may have simply done it because he wanted to impress a woman. Rebecca is a young woman who has a very troubled home life. She ultimately sees her relationship with Venergold as an opportunity to leave that troubled home. Venergold is a Russian immigrant to Germany. He speaks with an accent. He has anxiety in large groups of Germans. She begins to resent the fact that he has these fears and feels a little bit trapped. Rebecca attempts to dump him on multiple occasions, and he threatens to commit suicide if she leaves him. Weinergold apparently told Rebecca that she would soon be seeing a surprise. After being dumped via text message, he apparently began planning for this attack in earnest. Weinergold was charged with 28 counts of attempted murder, which carried a maximum sentence in Germany of life in prison. He claimed that he had nothing to do with the attack, but as time went on, he admitted that he had actually been the person who had built the explosives and had set them off. But he claimed that he didn't want to actually kill anybody. Ultimately, Weinergold didn't receive the harshest possible sentence. He was given 14 years in prison, but it's still a considerable amount in jail in Germany.
The threat of an asteroid hitting Earth is very real. If it's big enough, it's also very final.
These are very, very infrequent events. The probability is not zero, though.
A blinding flash of light streaking across the sky.
About 100 tons of space rock falls on Earth every day. Most of it is so small it burns up in our atmosphere or lands unnoticed away from major populations. No human in the past 1,000 years is known to have been killed by a meteorite, and according to NASA, no large object is likely to strike the Earth any time in the next several hundred years. However, one thing is certain: we haven't found them all.
There are thousands out there, and we don't know where they are.
There are a lot of asteroids in our solar system. They number in the billions.
Scientists all over the world are working toward detecting and deflecting the most catastrophic of natural disasters.
The race is on to find as many of these objects as we can.
We have a way of calculating whether or not an asteroid is potentially dangerous or not.
I mean, I think it's something worth investing in. It's our existence at stake, right?
Amy, let's get this one out of the way. It's probably the question you get asked the most, but how scared should we be?
Asteroids and comets are a natural hazard that's out there like a lot of other natural hazards. These are very, very infrequent events, these collision events, where an object actually impacts the Earth. The most important thing that we need to know about asteroids is when the next impact is going to happen and how bad it will be. What we know is that an object that's about, say, a kilometer across is capable of causing very, very wide devastation across the planet, really, truly global devastation. The object that wiped out the dinosaurs was somewhere in the neighborhood of 5 to 10 kilometers across, so even bigger than that. At a kilometer, it's still going to be very bad and it will have global effects. For objects that are capable of causing what I would call sort of regional damage, kind of a large major metropolitan area, a city and its surrounding environments, sort of around 100-ish meters. It depends on the details of the composition and so forth.
By the 1980s, NASA was cataloguing near-Earth objects. In 1994, stargazers watched as comet Shoemaker-Levy 9 hit Jupiter. The resulting zone of chaos was estimated to be as large as the Earth, and the event became a turning point in the search for asteroids and comets in our solar system. In 1998, Congress tasked NASA with finding 90% of asteroids and comets 1 kilometer wide or larger. Soon after, Hollywood blockbusters Armageddon and Deep Impact brought attention and fear to the masses.
The great news is that the vast majority, more than 90% of all the really large 1 kilometer near-Earth objects have been found. The challenge now is working down to these smaller sizes that are still quite capable of causing a lot of damage, but they're just harder to spot because they're fainter, they're smaller.
Can you give us a sense of how many are out there in our solar system?
We know that there are a lot of asteroids in our solar system. They number in the billions. Most of them, however, are between Mars and Jupiter in what we call the main asteroid belt. This is a region of space where most of the asteroids in the inner part of our solar system live, and they stay there for many billions of years. There is another population, though, that kind of leaks inward and gets into the region somewhat close to the Earth, and we call these near-Earth objects. We think that there are millions and millions of near-Earth objects that are out there in the total population. As of today, we know of sort of around 20, 25,000, something like that. When we first spot an object, we really know very little about it. We just see something moving across the sky. So all you get is just sort of a handful of snapshots, just enough to be able to tell that this isn't an asteroid that we've already seen before. And then once we can calculate the distance to it, we can now start to make predictions about its true size. Is it large or is it small? So we have a lot of information that we have to get pretty quickly to really understand what's going on.
Finding asteroids is just one piece of the puzzle. Planetary scientists are extremely skilled in determining the orbits and speeds of asteroids based on relatively small amounts of data. NASA runs simulations of the trajectories asteroids could take, which is useful but time-consuming. A team of scientists in the Netherlands have found a way that could buy us more time.
Our method is very quick. So you can very quickly get an assessment of whether or not the object is dangerous or not. If you look at the classical way of determining the danger of an asteroid, it may take days of computing time on very big machines to determine this hazardousness.
The current problem is that there's just too many asteroids out there to spend a huge amount of computational power on all of them. So the neural network allows us to focus on what really could go and pose a hazard to Earth.
A neural network is a computing system that mimics the way the human brain operates to find underlying relationships in a set of data.
By training the network in this way, you train it in recognizing those objects that are most likely to hit the planet. And once it's trained, you can apply this network to all the unknown asteroids. And then you can make a selection and saying, hey, these are the ones which appear to be having orbits similar to the ones which we know are hitting the planet. That doesn't mean that they do, but it only means that they look very similar to the ones we know they do.
What else did you find? Should we be particularly concerned about anything?
One thing that we did find is that our neural network was able to go and identify a handful of asteroids which weren't considered potentially hazardous, that when we went and integrated them forward in time, they came quite close to Earth.
We find a handful which were not detected before or not considered being dangerous before, and we think they are potentially dangerous.
It's very hard to simulate kind of going forward in time an asteroid that's going to hit Earth because, well, the Earth is really small. And space is really big, and then you have to have very exact parameters to shoot an asteroid that goes and hits exactly Earth. And then Simon had the ingenious idea of not even trying to do that and just launching the asteroids from Earth's surface and integrating backwards in time.
It's very hard to make it hit. So you need a lot of calculations which all end up in nothing. And the idea was then well, let's not do that. This is basically what NASA is doing. NASA is taking an asteroid, making multiple copies of them, shooting them all forwards in time, calculating their orbits, and then see what fraction sort of gets close to Earth. Not even hitting Earth, but getting close to Earth. And that they call it a potential impactor. So you calculate the solar system forwards in time for, let's say, 1,000 years. And then you launch asteroids from the surface as if you go forwards in time, would fall on the surface. You calculate them backwards to today, and then you get your orbital parameters of today's asteroids, which you know will land on the planet. And those you can use as known impactors and compare with all the other asteroids in the solar system.
Can simulations and AI, can those things fill in the gaps where perhaps telescopes and other imaging tools can't?
Absolutely. Since the observations get more complex, the physics gets more complex. And if the physics get more complex, the mathematics becomes more complex. And at some point, you can't solve your problems analytically anymore. And then this is where the computer comes in. Now we have this trained neural network. We have a way of calculating in a fraction of a second whether or not an asteroid is potentially dangerous or not, and therefore deserves more attention or more time to spend on for really finding out if it is dangerous.
When it comes to hunting asteroids, time is critical.
What we can do about a potentially hazardous object depends a great deal on what we know about it and how much time we have before the encounter. We'd really like to find them when they're decades away, because the more time you have, the more options you have, and the less energy it takes to move an object aside.
It also means we might not have to resort to launching a nuclear warhead at an asteroid. Until recently, pretty much our only choice.
That's an option of last resort, in my opinion, yes. We have lots of options available. You can just simply bump into the object and just nudge it out of the way. That's one possibility, and that's kind of, in a way, sort of the simplest thing to think about, just nudging it off its path a little bit with, a massive object, a spacecraft, let's say. It's just kind of like bowling, if you will. If you have a long time or a long stretch of runway in the lane, just a very small twist on the bowling ball will make a big change in where it ultimately ends up. Another option would be something where you take a very big, massive spacecraft and you park it next to the object and you use the force of gravity as a towing rig. That takes longer, though, and you need to be able to send a pretty massive spacecraft, and it obviously depends a lot on how big the asteroid is. Other options start to get more and more complicated, and they range from painting one side of the object a white color and painting the other side dark, and then letting the pressure of light sort of perturb its orbit.
In a departure from the lab and computer simulations, NASA has real plans to rehearse kinetic impact deflection. In 2021, the agency will launch DART, the Double Asteroid Redirection Test mission, which will intercept a 160-meter asteroid in 2022. Better to practice now before we have to deal with an actual threat. In the meantime, discovering asteroids is our best bet. Thousands of scientists and amateur astronomers around the world make up an informal network that survey the heavens. But that may not be enough. NASA wants more resources to map our solar system and better technology.
We need to ramp up our network of sensors, and also we need to just continue to strengthen our network of international observers so that we can get follow-up, because we find these objects when they're distributed all over the night sky.
Once we get more observations, we get better data, we can make better predictions.
If you look at the big impactors we have had in the last, let's say, 20 years, or maybe 30 years, or 50 years, most of them we haven't seen coming. So the real danger, I think, comes from the objects we don't know about, and not from the objects we do know about.
This particular natural disaster, like a lot of natural disasters and like climate change, is a problem of the global commons. So the thing that we risk collectively is that it sort of then becomes nobody's problem, and nobody takes ownership over it. The asteroids are all over the sky. They just truly cross boundaries and borders with a second's notice.
I kind of imagine in the future maybe lots of small satellites around the Earth that are always going and looking outward. I mean, I think it's something worth investing in. It's our existence at stake, right?
The pandemic has affected everyone in different ways. Some passed the time by baking.
Homemade sourdough bread. Do I need to say more?
Some chose to binge watch Netflix.
It's your game.
Or maybe you started a garden oasis in your backyard.
Next, I'm going to put my lettuces in.
But for millions of others,
I'm going to be posting stocks that will boom.
They wanted to uproot the financial industry.
Let's just lock it on up and take $15,000.
Here's a stock that can change your life.
I see a stock going up and I buy it, and I just watch it until it stops going up, and then I sell it.
I have gained over $3 million.
I want some free money.
I don't think you can overstate the online communities or social media's influence on financial markets.
A large group of inexperienced investors who discuss their plans on social media platform Reddit have shaken up the stock market in a big way.
The stock that everybody's talking about right now is GameStop.
Video game retailer GameStop is set to continue their head-spinning ascent today.
The revolutionaries on Reddit are spanking Wall Street's ass.
The more these stocks go up, the more the big guys are getting creamed and losing billions of dollars.
This isn't a wealthy person's game anymore. Anyone can play it.
I took up a little bit of a new hobby, and I am interested in day trading.
As an investor nowadays, you don't have to look a specific way. You don't have to wear specific clothes. You don't have to be doing it from a trading floor on Wall Street in like a high-rise building in downtown Manhattan.
The narrative of what's driving the markets is no longer being held in secret offices in New York and Boston of privileged people talking to other privileged people. It's right out in the open. It's on Twitter, it's on Reddit.
From brokerage apps to Discord channels and subreddits to TikTok finfluencers, one of the last holdouts in the world of disruption, finance is next in line.
Investing should be as ubiquitous as shopping online.
That's Vlad Tenev, the CEO of Robinhood, the online brokerage app, talking about how he wants his app to disrupt the world of stock trading like Amazon disrupted the world of home shopping.
And I think that speaks to exactly the mission that a platform like Robinhood has, which is to democratize investing.
Robinhood was started in 2013 by Vlad Tenev and Baiju Bhatt in, where else, Silicon Valley, as an alternative to the big brokerages, but with one big difference.
As they were building the social network around finances for people, they realized that there was a gap in the market and that free trading could become something that they could bring to the markets, they could disrupt the industry.
While no-fee trading is industry standard today, it was unheard of when it was first introduced.
The online brokerage industry was really innovative when they came on the scene 10, 15 years ago, but they kind of stopped innovating where you haven't seen those commissions come down beyond $5 or $6 or $7. Robinhood think that by offering zero commission that they're going to push people onto this platform.
And on top of no-fee trading, the customers Robinhood was courting have been long overlooked in the world of finance.
So the typical customer of a Charles Schwab, for example, is putting a lot more money in that brokerage account than the typical customer at Robinhood. Even today, with all of its popularity, the median account size is about $240.
There's Fidelities and the Schwabs and the E-Trades of the world. They look down their nose at those kind of accounts. I don't want a $1,000 account. They're just a headache. I want a $100,000 account.
And this is key here, right? Because the thing about Robinhood that's different than every other single brokerage platform is how easy it is to use.
The design of the Robinhood app really has in mind a user who might be coming at this absolutely cold.
The fonts are very well sized, the shapes, the colors, all of that is something that the founders of Robinhood paid really close attention to.
And by creating an interface that catered to a newer investor, they were able to gather a pretty healthy group of customers. And by 2019, they had about 10 million customers.
Those 10 million customers were a huge success story for Robinhood, but no one could have predicted its explosion after the arrival of COVID-19.
Remain indoors to the greatest extent
and 100% of the non-essential workforce must stay home.
What we saw when the pandemic hit was the growth of Robinhood users absolutely turbocharged. And oddly, you saw this surge in interest in stock trading. Then they saw the absolute surge in 2020 in customer growth. And now, by many accounts, they have more than 20 million customers, which is pretty extraordinary. So the next step for them is to figure out how to monetize those users and how, even with their small account sizes, to get them to grow with the company and, as it releases more products, come along with them.
Robinhood would become one of the COVID economy's breakout successes. Robinhood traders, as they're called, became the shorthand explanation for the frenzy of often speculative retail investing after the pandemic lockdowns.
Kids wake up in the morning, they go on Robinhood. They're, in the shower, they check Robinhood. Kids are learning how the stock market works at 18 while they're at school, checking their phones in between classes because notifications pop up telling them what their stocks are doing that day.
With these new tools, millennials and Gen Z are investing in the market in ways their parents could have never even dreamt of.
That is sort of key when we talk about the divide between older and younger generations, is that the younger generation is exposed to so much more information and tools at their disposal to do what they want in the market.
The older generations, you never had the technology or the cost structure that you could play the markets like you can today. So you were stuck with giving your money to a professional investor and paying them a fee to do it.
When I speak to young kids, they tell me, I'm making mistakes, I'm losing money. I'm not a perfect investor, but I'm 18, and by the time I'm 30, which will be, 10 years from now, I'm gonna have interacted with the markets for a decade. And so it's a learning experience more so than anything else.
And you can look at it and you can say, wow, that's risk-taking, that's dumb, but if you could possibly shave 10, 20 years off your working life versus adding 5 years, I don't think you can fault people for that.
But Robinhood is only part of the puzzle. Sure, you can trade on it, but without research, information, and data, you're just blindly throwing darts at different stocks and hoping to strike it rich.
Wall Street forever has always run on what we now call narratives or memes. People telling rumors to each other have been around for 100 years.
On Wall Street, information is its own currency. Historically, either you had it or you didn't, and the people who had it had a huge advantage.
In the past, those narratives and memes didn't have a network effect. It would be one person telling another person over the phone. In fact, when I broke into this business in the 80s, a lot of people used to complain that they weren't on the call list to get those ideas.
Social media changed all of that.
Fast forward to 2021, that's being done on the internet now. And that's being done on Discord and Twitter and StockTwits and Reddit. And the impact is very similar, but orders and orders of magnitude larger.
As social media has played a bigger part in our lives, it's also played a bigger and kind of more important role in how people find investing ideas online and on these platforms.
How do those ideas spread? On TikTok. Yes, that TikTok.
Soon may the weatherman come to bring us sugar and tea and rum.
People aren't just going to it for sea shanty videos.
The personal finance hashtag on TikTok has garnered 3.5 billion views from its 1 billion monthly active users. By comparison, videos found under the cooking and health tips hashtag have 2.6 and 2.1 billion views respectively.
The trajectory of Robinhood and TikTok were literally on par.
What happened in the stock market this week? So the word of the week is expectations.
Absolutely essential that you guys understand the risks of shorting.
And Kayla Kilbride and Kyla Scanlon are two of those financial influencer TikTokers, also known as finfluencers.
I think people still care about fashion, they care about culture, but it's also like there's this big behemoth thing called the stock market that we really don't know a whole lot about, and it's gatekept behind the industry. And so people like want to unpack that. And so my audience is, a lot of them are younger investors who are looking to hone their skills.
Tech and right up.
Kyla and Kayla are two of the more, let's say, professional TikTok influencers.
The Tesla ARK Bitcoin Biotech Risk Cluster.
I've been trading since high school, and it was a really interesting way for me to fill out my decision-making frameworks and to think about thinking. And I think that the more that we can have people thinking about finance, the better that we're going to progress as a society. I think it's a huge gap in our educational system.
If you're going to buy an option for a stock you think is going to go up, it's a call. So think of it like this. I made the options video where I was like, options are just like shopping. Rumor has it that this pallet's about to go up in price. So if I come in tomorrow, can I still buy it at said price? And a ton of women just like attacked that video and were like, you explain things so much better than my boyfriend or my professor, or like I could sit and listen to you all day. And I was like, this is what I was looking for.
But TikTok's algorithm does not reward calm and measured videos about responsible investing. It rewards this.
Watch this video for 30 seconds and you'll be rich for the rest of your life.
I try not to say the A word, the ALGO word, because TikTok listens to us.
The algorithm does impact how you feel. You know, you do notice which videos do better versus which videos do worse.
How do you catch someone's attention in less than 60 seconds? And how do you make it something that they're like, I need this in my life? Nearly impossible to do that in 60 seconds. But the people who perfect it are the people that you're going to watch and going to stick around.
And where people are sticking around? Reddit. And its nearly countless subreddits about finance. And by far the biggest one of those is Wall Street Bets.
There's a lot of social media platforms out there, but Reddit is like the social media platform for finance. Places like Wall Street Bets is where it all goes down.
Started in January 2012, it wasn't long before Wall Street Bets adopted a 4chan-like etiquette, leading to their tagline, like 4chan found a Bloomberg terminal.
We had all these unexplained stock moves, and we would be grasping for why stock XYZ jumped 20% in a day. And you would look at Wall Street Bets, and you would see people there talking about buying options in that stock, and it sort of, squared the circle, so to speak, and started making sense. And it was at that point that it was like, wow, we have to start paying attention to this.
Some people on the platform really spend tons of time, and others are just looking for entertainment and to have a little bit of fun, effectively gambling or looking for an outlet, trying to make a little bit of money.
Then on top of all of that, there were stimulus checks. Now, clearly this money is going to people who need to use that to eat, to live, but there's a lot of people who use this money to invest in the stock market.
And it's not just stock tips. People quote-unquote YOLO their entire life savings or stimulus checks on a single stock. They post what is called gain and loss porn, screen-grabbing staggering hits and misses on stocks for the entire community to see.
I'm about to lose everything.
And while some of the people on Wall Street Bets are novice investors, the community contains multitudes.
In one respect, what it did show us among these network groups is they are very sophisticated. They're not a bunch of ignorant people talking to other ignorant people.
And this is where the pieces of the puzzle all come together to wreak havoc on Wall Street for a solid week in early 2021.
It's pretty clear that the combination of more people having retail brokerage accounts and trading apps and more people being stuck at home looking for some kind of entertainment and some kind of community online came together in this very singular way.
What came together is GameStop.
Let's go back to the beginnings of what happened with GameStop a couple of years ago. On the boards like Reddit and StockTwist, a lot of people were talking about GameStop as being attractive value.
Some of them are even, Wall Street alums who left the industry and now still have access to tools that they can use to improve their financial well-being and make very good decisions. And I think Roaring Kitty is a perfect example of that.
GameStop is one of the most compelling asymmetric opportunities in the market today. Really, I don't understand how you could disagree with that.
At the same time that this crowd was talking it up, the hedge fund institutional crowd didn't like this stock at all, and it had the largest short interest of any stock in the New York Stock Exchange going into late 2020.
Short selling is a bet that a stock price will fall, and it's a fairly simple concept. An investor borrows a stock and then sells it. The investor is betting on buying the stock back later for a lower price before returning it to the original owner, pocketing the price difference.
What a short seller would tell you is that they almost act as a policeman in financial markets, or they're at least looking for companies that aren't what they say they are. And that can range anywhere from an outright fraud that some short sellers try to expose to just a company that's not worth as much as investors think it is.
The problem is, if the stock price rises, the short seller has to come up with the money to buy the stock back. And the more it rises, the more it costs. And that's what's called a short squeeze. And the hedge fund Melvin Capital was on the wrong end of that squeeze.
Melvin Capital lost over 50% of its money in the month of January alone, just from being caught in the short squeeze of the stock.
This is where the disruption comes in.
One of the most wild stories you're ever going to see. GameStop shares absolutely going nuts.
In less than a year, the company's stock has jumped from less than $3 a share to almost $350.
Cheers, everybody!
Roaring Kitty has turned $50,000 or so investment into some $14 million.
Whoa!
Investors all over social media use the free trading app Robinhood to wreak havoc on Wall Street.
They're actually piling on into some of these stocks to really hurt the professional short sellers.
And they all used Reddit, Twitter, TikTok, and Discord to tell one another to keep buying and, quote, hold the line and not sell GameStop.
People are getting cheerleaded for jumping in, buying at the highs. They're saying, keep going.
And it was working too, until
Thursday morning, the trading app Robinhood sent out this tweet. In light of current market volatility, we are restricting transactions, including GameStop.
People were really angry.
Robinhood was supposed to allow the regular people to play the same game these big boys are playing. But instead, we were all taken for schmucks, and they screwed us.
Shares of GameStop are jumping again now that retail investors are being allowed to buy shares of the stock.
But what we learned is that when people organize online, they have the ability to disrupt the market.
And it was a big sign. The ivory walls of the institution aren't as powerful as maybe the institutions thought them to be. I don't know if pumping up GameStop was the best use of billions of dollars, but I think that as a signal to society, it was pretty interesting and powerful.
The GameStop saga was so impactful that both Vlad Tenev and Roaring Kitty were called in to testify before Congress to clarify each of their roles in the saga.
One thing that's emerged from the congressional hearings is that they're interested in how retail brokerages make money and whether they're keeping the best interest of their customers in mind, but it's pretty fuzzy as far as what they would actually do as a result.
While the frenzy around GameStop eventually subsided, it didn't take long for retail investors to find other areas to invest their money.
Take a look at Bitcoin going bananas over the weekend.
Bitcoin forms a brand new all-time high.
It was after GameStop started to drop that we saw Bitcoin really go up to over 60,000.
How much further does this rally have to run?
It's compelling to say that money shifted from one venue to the other.
While correlation doesn't equal causation, there's a chart out there showing an inverse correlation on meme stocks going down and cryptocurrencies going up.
There's definitely an aspect where people are making money on stocks and then moving, they're agnostic, they're not hedge funds. They can invest wherever the hell they want. It's a classic sort of momentum trade. They're going to wherever the winners are and they're willing to jump on and, ride it.
So whether it's meme stocks like GameStop Meme coins like Dogecoin, or entirely new ways to invest in art like NFTs, the new kind of retail investor is making its presence known.
Over the next 10, maybe 15 years, you're going to continue to see, whether by choice or by force, that baton go from older generations to younger generations. I don't think any single app is going to be the thing that disrupts. I think people are the disruptors.
How people get ideas about what to invest in has become increasingly entwined with social media. And as social media companies govern more and more of our lives, the fact that now they're tied in more intimately to people's wallets is something that we might want to understand better.
Usually what disruption, I think, means is technology comes in, whether it's blogs to the newspapers or online retailing to brick and mortar. They come in and they're in the same business, but they just do it in such a gigantic cost savings that it causes everybody to switch. Well, that's the risk that happens here, is that it's so much cheaper to just manage your own money. We're not there yet, but costs and conveniences are moving in that direction. So I'd say, Wall Street, you haven't been disrupted yet, but you could be in the coming years, and that the final chapter on this story hasn't been written.
Meet Bloomberg's own David Nicholson. Now, his happy place is out in the field, on the open road. But like the rest of the world lately, he's been working from home a lot more than he's used to. COVID-19 has prompted a massive urban exodus as professionals of every ilk yearn for more space to live and work. As a result, rural areas have exploded, and they're poised to experience a resurgence as more and more families pack up and leave the big city to try out life in the burbs. But there's one problem with that. Not all internet speeds are created equal. Anyone who might need to upload or download large files for a living may not want to pack up and move to that cabin in the woods just yet. Now, David's house isn't a cabin, but it is in the woods, and inexplicably, his internet is workable.
My internet is okay. I pay a lot for it. It's around $140 a month. The download speed's great, and the upload speed is terrible, which is really bad for my work because I have to upload these massive files. But I'm definitely one of the more lucky ones in this community. Just a few miles down the road, my buddy has awful internet.
It's usually under 2 down and under 0.2 up, so it's often unusable.
Some days it's around 1, and other times it'll drop down to about 0.2, 0.3.
I just want to be able to have internet at my house without having to go outside the normal ways of acquiring internet. It's really frustrating.
We're literally a few miles away from downtown, and it just cuts off.
This is a problem, and the solutions are not there yet, because getting high-speed internet in rural areas en masse is something our providers may simply not be ready for.
If your internet service doesn't have fast download and upload speeds, then you don't have high-speed harmony. You have.
Americans on average pay about $70 a month for internet at home. But in rural areas, it could cost a lot more for a lot less service.
So the pricing for a fixed wireless provider here can be something between $80 and $150 for about 25 megabits per second. However, gigabit service, which is 1,000 megabits per second and symmetrical, is running at about $119 a month or $130 a month.
That's John Paul. He co-owns Spiral Fiber, an internet service provider here in Nevada County, California. And for the past 10 years, he's been trying to bring an affordable fiber optic network to town. It all started when he applied to be part of the pilot program for Google's fiber service.
Across the country, civic boosters have been going to extremes, chanting, singing, and marching, trying to get the search engine giant to look at their town.
The internet these days is crucial to be in the world, to be a part of the world, and to be connected to your community.
Google ultimately went with Kansas City, Missouri, which left Paul on a mission to get funding to lay out fiber optic networks for gigabit service. Over the next several years, he would attend conferences and pitch venture capitalists and apply for grants to make his vision come to life.
One of the biggest roadblocks to building infrastructure for the internet here in the United States are the existing large providers. They have their land staked out. They would prefer that nobody come in and compete against them. In 2013, we applied for a grant. We went down and met with the commissioners at the California Public Utilities Commission. It was an arduous process to get funded, but we finally did against all odds. We got a $16 million grant, and then we went out to seek venture capital.
Then, in March of 2020, the pandemic hit the world.
Everybody got locked down, and everybody came home, and everybody started using the internet. And I remember seeing on one of the local fixed wireless providers' websites, they've said, hey, we know you're all staying home, but please don't use too much video, and please don't use too much bandwidth. And I thought, that doesn't work.
The U.S. connectivity gap is far greater compared to countries that are considered its peers economically. Some developing nations actually have better internet than rural America, like in Kenya, which has a state-of-the-art fiber optic network fed in from their coastline. The American connectivity gap does largely affect rural areas that are either outside of service coverage or simply prohibitively expensive. This is Rebecca. She and her family moved to Nevada County just a couple miles down the road from David. They took for granted that high-speed internet would just exist in the area, and it's not something they even bothered to check on before buying their house. Turns out, all they got was dial-up.
We wanted to move where we had a little more space, room for the kids to run around, just be out in the mountains a little bit more. Having come from a bigger city area where Wi-Fi is pretty readily available, we hadn't really considered that in our purchasing of the house, whether that would be an option or not. When school started, and now that we are remote learning with our children and we're doing everything from home, we didn't have the option to do that at our house. So every day when school would start, we'd have to pack the kids up and we'd go to my in-laws' home. They have a little cabin up in this area that does have Wi-Fi already.
Rebecca's situation is the norm in rural America.
According to data from the Federal Communications Commission, just 4% of urban Americans lack access to broadband internet. That's compared to almost 40% of people who live in rural areas. While that was the case, there were also racial and socioeconomic divides in terms of who had that access. In addition to that geographic difference, low-income African American students, Latino students, and first-generation college students were more likely than others to have only one device at home that's shared among multiple siblings and or lack access to that actual connection.
For most American towns, there's also a lack of competition, forcing internet prices up. And large providers like AT&T and Comcast aren't incentivized to expand service to these rural communities.
This is how Xfinity makes life simple, easy, awesome.
So in our area, we have a small imprint of Comcast, but they're not going to go out to the more rural areas. It's just not cost effective for them to do it as a large company.
In order to lay fiber cable, you're actually physically digging trenches into the ground. And for internet service providers, they're primarily focused on maximizing their profits. And so the fewer customers you have, in any square mile and the more fiber you have to lay, that's just kind of harder to pencil out from a purely economic standpoint.
AT&T released a statement on the matter, expressing the need and desire for government assistance to fund fiber optic expansion to areas deemed unprofitable. Comcast released a similar statement encouraging more public-private collaboration on this effort. Federal agencies do offer grants to help communities build broadband networks, but many have argued that there's not enough flexibility on how to use these funds. The COVID-19 relief package passed by Congress in March and signed by President Donald Trump awarded $43.3 million to 51 projects on the East Coast alone. But it also stipulated that these projects needed to be up and running by December 30th. For contractors who plan projects months and years in advance, it's a scramble to rearrange their schedules to meet that deadline.
So what we've been asking the federal government to consider is at least have, as long as the projects are getting started, knowing the projects are being put into place to expand both remote learning, working from home, and opportunities like that that are truly driven from COVID. We're moving as fast as we can regardless, but hopefully they'll give us some more time.
Talking to John Paul, it's clear that he believes broadband is something that can transform a community and should be considered a public good.
One of the first communities to come on in the United States with full-on gigabit service was Chattanooga, Tennessee. Now, they're a bigger city, but they're a city that was economically in a downturn. In the last 15 years, the city of Chattanooga has turned around in an amazing way. It's a nexus for young people to move to. It's a place where technology happens.
It's not just about logging on to Zoom, to connect with your colleagues who might be in New York City. It's also your ability as a small business, operating in the town of Nevada City or wherever it may be to, quickly upload your payroll documents or something onto the cloud, or to quickly, swipe a customer's credit card. There's just some really basic business functions and mechanics that I think people in big cities really take for granted, and that are just going to be a much bigger challenge for small business owners in rural areas.
Historically, the marginalized people, you call them as untouchables or Dalits, they have been kept away from the center of the knowledge. Once you are born into a caste, it is very difficult for you to grow beyond that. You are stuck in that identity. I think education is the best way of liberating them. So that's how I chose to work in education sector. The kind of education that we are giving to the marginalized people is going to change not just the fate of these communities in Telangana, but it is going to be the source of inspiration, source of hope for all the marginalized in this country.
Greatest blight in India is the system of caste.
For generations of Indians, the social code known as the caste system has defined how people earn a living and whom they marry. Although outlawed 7 decades ago, castes remain a significant factor in deciding everything, from family ties and cultural traditions to educational and economic opportunities. Dalits, people who are on the lowest rung of the caste system, constitute almost 1/5 of India's population of 1.3 billion. Not able to afford the high tuition of private schools, many are forced to attend government-funded institutions, which in the past have suffered from poor infrastructure, lower education standards, and high student-to-teacher ratios. But Dr. Praveen Kumar is trying to change that.
I am currently working as head of Telangana Social Welfare Residential Schools. So totally above 400 schools I manage. These are all residential schools for the students who are historically marginalized but talented and then poor. Of them, 60% are girls and then 40% are boys, because girls are more marginalized among the marginalized. Their voices are always suppressed. My approach to improve the conditions in the schools has been put your eyes and ears on the ground always. Talk to the parents, talk to the teachers, talk to the students, stay in the schools and then understand their problems, their challenges, both in classrooms and then the corridors and the dorms. Then go to the dining halls and see what kind of food they are eating, and then go to their homes and then what kind of food they are getting and what kind of challenges the parents have. One of the important changes that I brought in after I took over was to complete the transformation of mother tongue to English medium, because English medium, as I said, English is the language of emancipation, a language that connects you to the whole body of knowledge in the world. So we had to train a lot of teachers.
Refer to the dictionary also, okay, and find out the new meanings. As described about. Hey, Richita, how are you? Hi, Sindhu. Fine, thank you. And how about you? I'm fine too.
Identity is extremely important. There is a scientific evidence to prove that your sense of identity is extremely crucial to your growth as a successful human being in your life. If you accept an identity which is very humiliating, which reminds you of very painful past, I think that identity will not help you to grow. I'm not saying that you should forget your past. I'm not saying that, but that should not be the bubble in which you must live always. Sweros is an alternative identity. S stands for state, W stands for welfare, Aero, SW and then Aero is Swero. So the idea is your dreams have to be skybound. So that is what we are trying to achieve by changing the identities. Like, you say, I'm a Swero and I aim to be a doctor. I am a Swero, I aim to be a top-notch engineer. I am a Swero, I aim to be a top bureaucrat of this country. I'm a Swero, I want to be a very good actor or, a musician in this world. So these are the positive images that are associated with the identity. Just to give an example to you, in 2012, in our institution, we used to produce about 6 doctors per year. But because of our, this self-liberating ideology of Sveroism, we have, this year, we have produced about 189 doctors. This is phenomenal for any poorest of the poor people. You know how difficult it is to get into medical colleges in this country. So, but today, because of this ideology, the students have been able to achieve this, feat. Pujita has been a farm laborer, and her parents themselves are agricultural laborers. And then this girl used to sell vegetables, but thanks to the residential education institutions, she came to the Gaulidoddi campus, and then she toiled very hard for 1 year, despite many problems. And today, I'm so happy to share with you that she has joined one of the prestigious medical colleges in the state of Telangana, Usmania Medical College, and then in future, she hopes to be a gynecologist. So this is the journey our children are hoping for. Similarly, the Mount Everest expedition. Mount Everest expedition, we are very fortunate enough to place the youngest ever female in the history of this world on the peak of Mount Everest. How did this happen? It's all because of an ideology that helps you to liberate yourself. We got a lot of extracurricular activities, and most of them got institutionalized now. So, for example, music. Similarly, the games. We have so many coaching academy. We have boxing academy, we have wrestling academy, we have handball academy. So we have, kabaddi, the traditional Indian sport. We have golf. We have introduced golf also. Like golf is generally played by so-called rich people, but today even poorest of the poor people also are being trained in golf in our schools.
Wow.
So our intention has been to give all 360 degrees, type of opportunities to the students, so that whoever is interested in whatever activity, they can go and then do it. Break the barriers, break the fence, at least mentally, because poor people have been programmed to be victims, programmed to be subjugated, programmed to be on the margins, always, programmed to feel inferior. We wanted to change all that. There are certain games which are exclusive to rich people. There are certain languages which are exclusive to middle class and upper middle class in this country. To put it in one word, the sole aim of introducing all these co-curricular activities is to break the stereotypes which are recklessly imposed on these people.
They're stereotypes Dr. Kumar knows all too well. Born a Dalit, his grandparents were labourers and access to the village well was restricted. Dr. Kumar credits his parents' belief in the power of education with helping him realise his aspirations. He went on to join the Indian Police Service, attended Harvard University, and then began pursuing educational reforms back home.
I attribute whatever I am today, it's to my mother primarily. They educated me in the village, although there were no good schools. So then I stayed in social welfare hostels, the hostels which are managed by government for the poorest of the poor kids. I passed with reasonably good grades. Then I went to university, and then I faced worst form of discrimination in the universities. Like there were, in those days I'm talking about, so the bathrooms and the toilets were exclusively meant for scheduled castes and scheduled tribes. We used to fight discrimination on one hand, and then again, try to excel in academics, day in and day out. So that's how I came to education, because I deeply believe that education is the only important weapon that can really, place the poorest of the poor people from a very victimhood orbit to a prosperous orbit. I think in future, this is going to be a game changer for the marginalized in this country.
If you look at a thermal image of a city and then compare that to a map of vegetation, you'll find that where there's greenery, the temperature is lower. That's because things like asphalt, concrete, and shingled roofs absorb more heat from the sun than trees. This is the urban heat island effect, and it accounts for higher temperatures in cities, often by several degrees compared with their surroundings. It's becoming a huge risk to human health as growing urban populations exacerbate the heating effects of climate change. Heat waves kill more people than any other extreme weather event, more than tornadoes, hurricanes, and even floods. That's why urban heat island mitigation strategies are being studied in Singapore by a group of researchers. The government-backed project called Cooling Singapore is now in the process of combining everything they've learned to create a digital tool that can help cities all over the world, starting with Singapore. In Singapore, close to the equator, temperatures regularly rise above 32 degrees Celsius or 90 degrees Fahrenheit. And the city structures only make it worse.
And that is also the case for Singapore, which is basically a concrete jungle, more urbanized, more developed city. And even in Singapore, what you have is a situation whereby there's a temperature difference of 7 degrees Celsius between the more urbanized and the more rural areas.
The government has taken drastic steps to keep temperatures down. This is Gardens by the Bay, an award-winning park. And inside this greenhouse is a pleasant 24 degrees. That's because the dome, along with 24 nearby towers full of thousands of people, is chilled by what's probably the world's largest underground district cooling system. It uses a large central plant that cools water and then pipes it into banks, residential towers, an exhibition centre, shopping malls, and the city's iconic Marina Bay Sands hotel and casino complex.
So one of the biggest perks of using this system for the buildings is that they can save 40% in terms of electricity usage compared to your traditional air conditioners.
And with Singapore relying on natural gas for most of its power, this new system means emission savings equivalent to removing 10,000 cars from the city's roads. That has big implications for the rest of the world. If things stay as they are, more than a third of the world's electricity could end up being used to cool buildings and vehicles by 2050.
As the world gets hotter, gets warmer, there is a greater need for air conditioning and as well as refrigerators, for instance. And the more people are buying these household appliances, the more energy usage they use, and they release heat more, and that then exacerbates climate change.
It's a vicious circle. And so since 2017, researchers at Cooling Singapore have been identifying design solutions that reduce our need for so much cool air in the first place.
One thing many cities have in common, and that's the importance of vegetation. That's a very important measure to mitigate the urban heat because of the shading effect, of course, and the psychological effects of the vegetation, and also because of the possible evaporative cooling effect of the vegetation. Vegetation can be, of course, on the ground floor in form of trees and shrubs, and you can walk under them. This is the so-called canopy layer that the vegetation forms above us. But vegetation can also go up the facades of buildings, and it can go to the roof of the buildings.
Luckily, Singapore has been striving for the Garden City feel for quite some time. It was a vision initially introduced by then Prime Minister Lee Kuan Yew in 1967 to make life more pleasant for people. And today, Singapore is one of the world's greenest cities in terms of urban vegetation. Kampung Admiralty, a community centre that contains health facilities and social spaces, now provides more green space than the plot of land it was originally built on. It's topped by a roofscape of staggered terraces covered in local plants, which functions as a community park. And a village green in the centre that contains farm plots for residents to tend to. Park Royal on Pickering was designed as a hotel in a garden that doubled the green growing potential of its site. There's now 15,000 metres of sky gardens, reflecting pools, waterfalls, planter terraces and green walls. And the government has big plans as well.
Singapore actually has a plan to plant 1 million trees and add more green spaces over the next 10 years. It is actually a mix of wanting to reduce the urban heat island effect, but on the other hand is also to get the people to be more connected to nature.
But it's not enough. The city-state has still been warming twice as quickly as the world average over the past 6 decades. That's why Cooling Singapore has developed a catalogue of other potential heat mitigation measures.
When you try to mitigate the urban heat island effect in a city or in any building, in a village as well, the first place to start is by shading of the windows. You have to keep areas clear so that the wind can move through it. Water of a certain depth can act as a very good thermal buffer. If you have to construct heavy buildings such as high-rises, at least you can make the surface, the facade, less heavy, and you can protect it from direct sun penetration. We have to make sure that no combustion engines will be in the city in the medium to long-term range. So ideally, the electricity production is outside of the city, and you bring just the clean electricity into the city. You can at least minimize the use of energy in the city, and you can start to slowly convert the roofs, the facades of the city into production areas for renewable energy. In Singapore, unfortunately, this is a limited option, but in the long run, it could produce up to 20-25% of the energy, of the electricity needed in Singapore, if all the roofs and the areas in the buildings, on the facades would be used to do that.
With so many different ideas, Cooling Singapore is also designing a virtual model of the city to test them out. It's called a Digital Urban Climate Twin, or DUCT, that will calculate how each element of the city's design will impact the urban heat island effect.
That means we model not only the geometry of the buildings digitally, but also we model the transportation, the insulation, the temperature, the radiation coming from the sun, the weather, the local climate, the even very, very microclimate of the city, the water, the movement of people in the city. We can invent scenarios, we can design scenarios, test them before we actually build them, and if they test very well and we are sure that they will function, then we can start to build them and put them into reality.
Singapore will be using this new tool to figure out which actions it should take next. And the model can be applied to any city, whether it needs to keep heat out or keep heat in, which will ultimately save energy, slow climate change, and improve our quality of life.
So this is something that Singapore will be able to export, maybe even together with its city development systems that it already has. Singapore is one of the very few cities in the world that really combine this scientific approach with a very well-established urban redesign and urban design approach. Through its agencies and the combination of its agencies, it has achieved a lot in the past. If it keeps following the scientific path and the combination with the other knowledge in the city already, we think that it will be a very comfortable and very livable city in the future, even more than today.
Times are tough. Jobs are scarce. It's risky to be outside and around others. Seems like there's very few ways to make extra money during a pandemic. So I guess I'll just hunker down and binge social media until this all blows over. Wait, don't these people make money? How do these people make money? Streamers, YouTubers, Twitch stars. How do they make money? Is it a lot? Is it a lot of work? I know, I gotta ask somebody in the biz, and I got just the guy, Austin John Plays. This is your full-time job now, right?
As of November of last year, yes. This was always just kind of like a side thing. Like any money that I made from doing my videos and whatever else, I never touched that because I didn't really think of that as being like real money. And then it started coming in more and more. And then it was like I hit my first day that I broke $1,000 and I was like, this is actually going to be money.
How did the YouTube channel come to be?
When the game Pokemon Sun and Moon came out for the 3DS, there was like things that I learned about the game, and then I wanted to just share that information with people. And at the time, I didn't have any way to capture a screen or anything, so I found like generic footage, and I kind of put it all together with so much editing. And that video got 6 views. And then 2 days later, I made another one. And that one got 12 views. And then I just started pumping out more and more content, and people were like, this guy knows what he's talking about. It really just started building on top of itself, and then it was like, my channel really focuses on tips and tricks. So I play a straight 18 hours, and I'll finish the game or get to about the 40-hour mark, and then I'll make my first video. While I'm going through, I have a giant notepad and just scribbles everywhere, and I make these notes of like the things that stumped me, so I know the things that may stump other people.
What do you need to think about if you're building your YouTube channel? 1,
you need to do something that you're passionate about. Not that you like, not that you think you're gonna make money on, something you're passionate about. The other thing is something that other people are passionate about. It holds a special place to them. And third is, it needs to be something that people are gonna seek out information on. In order to enter into the marketplace, you either need to be better than everyone else, you either need to be faster than everyone else, or you need to be more accessible than everyone else. And you can't be more accessible because it's already on the platform. Granted, if you understand how the algorithm works, which is very similar to Google Analytics, then yeah, you can have a little bit of a head start. But if you're not doing it faster, and if you're not doing it better than everyone else, then why should anyone watch your channel? So my income as a YouTuber kind of breaks down to 3 different ways. 1, which is the bulk of it, which is ad revenue. Whenever you go and you watch a video and then there's an ad and then you wait 5 seconds and you hit the bottom right corner and then you go on to the next video, or a non-skippable ad, or the video starts immediately, you get the little banner ad at the bottom, or if you scroll down from the video, the first thing that shows there is an ad. Those are the 4 different types of ads that can appear on every single YouTube video. And all of them pay a certain amount. It varies on lots of things, like the country of the person who posts it, the country of the person who watches it, the time of year, where you are in the quarter, if there's anything going on with a reduction in ad revenue. Like, great example, COVID-19, companies weren't spending as much on advertising. So because of that, CPM went down. CPM stands for click per thousand. I'm using the Roman numeral for 1,000. And that means that for every 1,000 views, you get a certain amount of money. Now, on low ads, when I first started off, my CPM was 30 cents. So every 1,000 views, I made 30 cents. But then once I signed with an MCN and I started making more quality content and more engaging content, some of my better videos and certain times of the year, I can see CPMs as high as $12 to $14. And there's a big fluctuation between, you know, if I post a video when there's no ads being spent, like January and February, that's the reason a lot of your favorite YouTubers and also TV shows don't post new videos in that time of year because ad rates are down. Why are they going to make content then? Instead, you're recording and you're bulking up for when ad revenue is higher. The second way that a YouTuber makes income is support, crowdfunding, things like that. When I first started off, Patreon was really the only option, but then they started rolling out supporters and members for YouTube channels. So whenever I have a live stream, you can click a button and then you can become a member, and then you get special icons next to your name. I believe they're called badges. Or on any video, you can hit the join button, and that helps support the channel. And then the third aspect of that would be merch. And for me, my merch has been somewhat basic. In fact, I'm wearing one of my t-shirts from last year right now. You have to endure the times that your first video gets 6 views, that you posted on Reddit, and they say shut up, and then an auto mod bans you. You have to go through that, because until you go through that and you discover why you're doing it, you're not doing it for other people, you're doing it for yourself. If you're not loving what you do, then it's not worth it.
Huh. So make a channel about something that I'm passionate about. Oh, sweet. I guess I can make the channel about that. Now, how do I grow an audience? How do I get popular?
It's all about diversification, right? You have to have a massive Twitter following. You have to have a massive Instagram following. You have to have a massive YouTube following. Of course, you have to be on Twitch, which is the key platform. But basically, any way you can get in front of your audience, you can engage with your audience, is going to drive those clicks, which ultimately drives the advertiser revenue that you get back from all of these platforms.
It's me and Dan playing video games and talking in a funny manner over them.
They're not just people who are good at games, they're actually people who are good at online engagement, online entertainment, first and foremost.
You have the right to remain stylish. Anything you wear can and will be used against you in the court of fashion.
The streamer is either very, very talented at the game. The best player in the game is generally going to draw a crowd because people like watching people who are very good. On the other hand, they're either very, very good or funny, charismatic, whatever it is on that side.
Oh, no.
You know, it becomes more of a show where they talk about other things outside of the gaming world, and gaming becomes really just a backdrop and an excuse to engage with that audience.
There were those weird, like, Ronald McDonald, like, straight to VHS movies. You remember those?
I'm personable, I'm chatty. I would kind of, when boring things were happening in the game, I would ramble on about, movies I'd watched or books I'd read and, or conversations I'd had and stuff like that. And so I think being personable was a big part of that.
It's not just getting on and playing games. It's getting on and being an entertainer. You are putting on a show.
All right, now let me go ahead and grab the samurai sword that every gym has. Okay, he's dead.
To have a larger audience and to have that audience, I think, stay with you, you have to bring something extra. You have to find your niche. You have to find what works and what connects with the audience and what makes them laugh and what makes them keep coming back.
You gotta make it a little more exciting, all right? Throw in a hanging bishop. Have everybody in suspense for a moment.
I think the real most important thing is to just get used to being on camera. Like in any sort of performance thing, is get used to talking on camera. My first few videos were terrible, but because I sat down and did it for 6 to 8 hours a day, I just got used to talking and I got over that uncomfortable hump.
If you go into Twitch purely with the expectation that you're going to make money, make a job out of it, have all this growth, and it's going to be great, you're probably going to burn out prior to getting to that point because there's very little payoff for a long time, right? Like multiple years generally before you really start to see a payoff. And so, those first few times you're streaming, nobody is there. One person shows up every 30 minutes, says hi, maybe, and leaves, right? Like, it's very discouraging, I think, for a lot of people. And so you have to be there just loving it. You have to love talking to yourself when nobody is around. You have to love just the game that you're playing, all of that stuff, because it takes a while. And I think a majority of people burn out prior to getting to the profitable point of it.
And there you have it. My very own YouTube, Twitch, Discord, and streaming channels all ready to go live. It's a veritable social media ecosystem just on the verge of thriving. So don't forget to smash like and subscribe and visit my Patreon for perks. Also, go to my merch page. And one last thing, stay cool, my friends.
This is live stream shopping, one of the hottest trends in China. Every night, tens of millions of people watch live shows hosted by influencers like Via and buy the products they recommend. On e-commerce and social apps like Taobao and Douyin, the sister app of TikTok.
我觉得已经改变了大家的购物的方式。其实各种各样的产品，哪怕你不买，你也可以来看。当然，你看了，你就有可能会买。
It's not about, only shopping. It's about the experience. It's about having fun. You got to see 3D. You got to see in some kind of action. It's almost like a theater act.
The internet craze has taken over China. By the end of 2020, the country had almost 400 million live stream shopping users. China's live stream e-commerce market has also grown dramatically, with an estimated value of $161 billion in 2020. It's becoming popular outside China as well. So, is live streaming the future of shopping? Live streaming is not a new thing. In China, it started in 2015 with the rollout of 4G, and it was first used for entertainment and socializing. Many live streamers performed for their followers or chatted to them, making money by receiving virtual currency and gifts. In the West, live streaming is mainly the domain of avid gamers. In China, it's broken into e-commerce.
China actually has a very big e-commerce empire, so it uses these super apps, what we call that you have payment, you have search of information, you have recommendation system, and you have huge amount of goods available on the platform, and as well as a lot of consumers. So with this advantage, they merge these features of live streaming to make the influencers actually sell goods.
Here is a perfect choice: nice neutrals, beautiful print, nothing overwhelming, and the warmth and comfort of flannel. This is item.
Traditional TV shopping involves a one-way direction, whereby a host introduces a product, demonstrates certain things, and say, call this number or something. But live stream shopping is live. That in itself is a very, very big difference. It causes different psychology, and live stream shopping is a very entertaining way of actually engaging someone else.
When you shop, actually, this live streaming video will continue. It will minimize into a corner, and you can buy the items and pay all on the same app. And after that, the live streaming screen will just enlarge by itself, and the promoter will come back to screen. So it's very convenient.
Taobao, one of China's biggest e-commerce platforms owned by tech giant Alibaba, added a live streaming function in early 2016. In the following years, other e-commerce and social platforms like JD and Douyin also integrated this feature.
开头的时候还是有很多的挑战的，对画面的这个流畅，然后是否能够很真实的去还原商品，它其实在这个上面是有很高的这个门槛跟技术的这个卡口在的。不管是我们的这个用户的接受度，还是商家的这个上手的这个难度都很高，但是这几年下来，基本上难点在不断被突破的。
Over $70 billion worth of goods was sold via live stream on Taobao in the year through March 2021. Latest surveys show that over 60% of live stream users in China were watching shopping shows, and over 65% of them shopped at least once via live stream. In 2020, live stream shopping got a huge boost during the pandemic, when millions of people were in lockdown and many retailers were pushed online.
People, during the lockdown, felt like there's a need for more social interactions. This live platform creates an interesting kind of environment that gives people the sense that I'm actually interacting with you. And then live stream shopping brings in a lot more variety of things that people could buy and satisfy, the sense of like losing control, especially during the pandemic.
At the heart of this craze are the top influencers who have tens of millions of followers and sell products worth millions of dollars every night. They often use their star power to get bargains from retailers, which in turn boosts their own sales and influence.
So if you think about China's live streaming, you have to know the king and queen of the influencers. The queen of live streaming, Via, she is actually having the biggest viewership and the biggest sales volume for a long time on Taobao platform. She can sell everything from like Gucci sunglasses, lipsticks, homes and cars. One time she offered her followers to go on a Tesla ride with her, and she even, for once, sold a rocket launch in her live streaming room for 40 million yuan. The king will be Li Jiaqi, more widely known as Lipstick's brother. He used to be a cosmetic sales before he turned into live streaming e-commerce, and he knows a lot about the cosmetics. So he's the one that will actually put the lipsticks on himself when he's on the show.
Top live streamers like Via and Li Jiaqi have become celebrities in China and can earn millions of dollars a year. Although not everyone can be as popular, mid-ranking live streamers like Tiffany still earn a good income through sales commissions.
如果说单从收入方面来讲的话，那主播的收入是比普通的工作要高很多。但是呢，主播这个工作时刻对身体，包括对精神都有很大的一个考验的。就是每天需要集中精力，然后长达5-6个小时，这种状态是很累的。而且这5-6个小时的话，你是脑子是不停的，然后嘴巴是不停的，然后手也是不停的，眼睛也是不停的。像我们做主播，不是说单一的只做直播一件事情，然后还会有选品的一些工作，然后还会有一些其他的事情排在里面，其实是没有个人生活的。那我觉得增强粉丝影响力的话，不是说某一件事情。可能今天做了什么事情你就增大了影响力，而是每天不断的内容的输出，粉丝不断的可能对你的了解，慢慢的信任你。
里面有芝麻酱的味道，如果吃不习惯的话就慎买。
A lot of successful live streamers are generally very good at communication. They're very good at articulating very simply what a product does, what a product doesn't do. In order for them to sell, they need to be trustworthy and appear trustworthy, and they need to show in some ways that they're authentic, right? So for Via and Li Jiaqi, they are able to articulate that quite a bit through their body language, through what they say. For example, Li Jiaqi will also sometimes say bad things about certain products because to him that's his honest opinion, and sometimes people want to hear that. And so they seem very credible, they seem very trustworthy, and don't forget, they're also very entertaining and very interesting. If you're familiar with Li Jiaqi, he won a Guinness record for like the most lipstick applications to models in like 30 seconds. So if you're able to create a lot of buzz with interesting things that you do, people who may not want to buy lipsticks will also stream in just to watch what he does. And then from there, you might get hooked.
这就是你一般女生出门的时候涂的口红的颜色。
Live streamers also use sales techniques such as limited time or supply. This sense of scarcity can often encourage viewers to buy.
The platform in itself creates and enhances some of these things because you see it live. Something we call social proof has taken over, meaning that, hey, other people are interested, other people are joining in, other people want the same product. And they add it in the chat and they ask questions and they say, oh, I want this too. What happens then? It makes the whole product even more scarce.
But it's not just influencers. Local farmers, luxury brands, even mutual funds have also started their own live stream shows.
Working with very top-tier live streamers can be risky. It's not necessary that the benefits will end up with the brand. So we see company executives opening their own shows. And we see like P&G have their own sales room, which runs shows every day as well. We also have like local governors in like small towns to sell their agricultural products. So the live streaming is definitely transformed the way product owners can think about how to reach their consumers. And it enables a lot of players to actually sell.
Live stream shopping is going global. Merchants in Southeast Asia have embraced this trend. And in the West, Amazon has upgraded its live streaming function, adding interactive features like chat rooms. Companies, including Google and Facebook, are also developing and investing in technologies to integrate video and e-commerce.
直播电商它其实已经开始成为主流，它未来的发展空间跟潜力都是巨大的。
接下来大家会越来越依赖这种购物方式，会变成一个比较日常化、比较规范化的这么一个趋势。
If you look at the numbers alone, their numbers alone, Li Jiaqi's numbers or Via's numbers, you know that they can sell and you know that they can generate revenue. Are they able to sustain it over a long period of time? It depends on how innovative they are at changing some of the things that they do.
But you can't expect consumers one day turn into virtual shopping for good. There will be the nature of us that crave to go into the store, to touch the goods and actually wear it and see how it looks like and walk around in that with our friends. And those things wouldn't be replaceable with live streaming.
You could imagine that the oceans are actually the largest battery. We're storing huge amounts of energy in the oceans. The wave motion can be very deep. It can extend down several hundred meters. And once it gets to the near shore, from about 50 meters, the whole water column is moving backwards and forwards.
As we search for ways to reduce our reliance on fossil fuels, some are looking to a largely untapped potential source of renewable energy. In theory, waves off the coast of the United States alone could generate over 2 trillion kilowatt hours of electricity a year, enough to power more than half of the country.
Waves intensify and subside not as quickly as the wind, and that means that it can produce a smoother power generation curve. One of the potential advantages of wave energy is that it could act as a complementary source of power compared to other renewables on the grid if it were to be scaled up to commercial scale.
For decades, engineers have been trying to convert wave energy into electricity, but a host of technological and financial challenges have complicated their efforts.
In the years from around 2006 to 2015, there were a spate of bankruptcies in the sector, and this was largely because of a lack of kind of continuous proven projects out at sea with reliable electricity generation.
Since then, companies have been trying to develop the technologies at a steadier pace and with a smaller cash burn. But the same questions remain. Can companies develop devices and technologies that actually work? Is wave energy just a novelty or something that can become a major renewable energy source?
The sea is a very challenging environment within which to operate a power project. So seawater is corrosive and conditions are very rough. So this means that power projects don't have a very long lifetime, and it increases operating and maintenance costs.
Partly because of that, many early wave energy projects hit rough waters, such as the Palamas Wave Energy Converter in Portugal and the Isla Limpet project in Scotland. But that hasn't stopped others from trying.
Companies are focused on testing projects out at sea, proving their durability, trying to raise capital and bring down cost. The sector hasn't really converged around one single technology design, and companies are kind of undecided about which design works best.
Finland-based AW Energy is a veteran in the sector. The first proof of concept of the company's device was made in the 90s after diver Rauno Koivusaari observed the strong back-and-forth movement of a hatch cover in a shipwreck in the Baltic Sea.
The waves are generated far from the coastline, so the wind blows on the surface of the water, causing the water particles to rotate, and that rotation extends deep down below the surface, and the waves can be very long. They can be several hundred meters long, and as they come into the near shore, this rotational energy turns into an elliptical energy, and eventually backwards and forwards, as you probably noticed if you've been swimming on the seashore in large waves, you're pulled in and out. That's the energy that we're extracting. There's a sweet spot where we deploy, so around 10 to 15 meters of water depth. That's where there's still strong wave energy coming in.
After years of research, prototyping and testing, the company has deployed Wave Roller, a 350 kilowatt device in the waters of Portugal. Wave Roller has an 18-meter wide and 10-meter high steel panel fixed to the seabed via a floatable foundation. The panel moves back and forth with the waves, capturing the energy.
It's submerged in the depth of 15 meters, so it's protected from the extreme waves. We generate electricity by capturing the movement with hydraulic circuitry in a machine room underneath the surface. That hydraulic energy we turn to electricity with hydraulic accumulators and hydraulic motors, and also a generator.
The Wave Roller has survived large waves at sea for over a year and delivered electricity via an underwater cable to the grid in Portugal. Meanwhile, the company has won a €2.5 million grant to work on an upgraded version of the Wave Roller, aiming to increase the electricity generation capacity to 1 megawatt. The upscaled device would have a bigger panel, 2 power takeoff units, and improved software to control the energy production.
We have taken into use a wave prediction algorithm that kind of tells us what kind of waves are coming into our device. That gives us few seconds to prepare for capturing more energy, and the difference in that is significant.
Our future plans are to deliver technology around the world. So I'm hoping we can be working on delivering technology to projects in Asia and also in the American continent as well.
Meanwhile, Israeli company Eco Wave Power is taking a different approach to capturing the power of the ocean. For the company's founder, Inna Braverman, developing new sources of renewable energy is a personal mission.
I was born in Ukraine in 1996, and 2 weeks after I was born, the Chernobyl nuclear reactor exploded, causing the largest in history nuclear disaster. I was one of the babies that got hurt from the negative effects of such explosion. I had a respiratory arrest and a clinical death. Luckily, my mother, a nurse, approached my crib on time and gave me a mouth-to-mouth resuscitation, which saved my life. I got a second chance in life and decided to do something good with it.
Growing up, Inna wanted to be a politician to positively change the world. After working as a translator at a renewable energy company, she decided to change paths.
Solar and wind energy were fully commercialized. There were a lot of amazing technologies implemented everywhere. I saw that wave energy, although it's an immense source of electricity, the biggest companies in the world are trying to develop wave energy with no success. And there was kind of a race going on in the world of who is the company that is going to develop a viable wave energy solution first.
In 2011, the then 24-year-old Inna co-founded Eco Wave Power. Instead of installing devices offshore, the company's devices are attached to existing breakwaters, jetties, and piers.
Our technology is very cost efficient, especially in comparison to the offshore technologies, because we don't need any ships, divers, underwater mooring or cables. We install on existing man-made structures, and all our expensive equipment, the generator, the hydraulic conversion unit, the automation, is located on land just like a regular power station.
This is the EcoWave Power conversion unit that has been operating in Jaffa Port since 2014 until 2020. Here you can see how the technology works. Basically, the floaters are going up and down and pushing the hydro cylinders, which transmit biodegradable fluid into land-located accumulators. A pressure is being built. The higher the waves, the higher the pressure, which is used to turn the hydro motor, which is turning the generators. The whole system is controlled by a smart automation system, which you can see right here. And in case of upcoming storms, the system automatically raises the floater above the water level and keeps them in the upward position until the storm passes.
The company has been operating a 100 kilowatt grid-connected device in Gibraltar since 2016, which is enough to power 100 households. Currently, Ina and her team are working on another 100 kilowatt project at the Port of Jaffa in Tel Aviv.
The project will be also the first time in the history of Israel that wave energy will officially connect to the electrical grid. And our goal going forward is to expand it to all suitable breakwaters in the city of Tel Aviv and to supply a significant part of the city's electricity needs.
Today, engineers and entrepreneurs are still trying to crack wave energy. Globally, only a few hundred kilowatts of wave energy are deployed, compared with gigawatts of offshore wind. But the field has come a long way in recent years, and with the right engineering solutions, this new power source could eventually become competitive with more mature renewables like solar and wind.
I would have a lot more confidence in the success of wave energy companies today as opposed to like 20 years ago. But in the next few years, or maybe the next couple of decades, it will be more likely to be used in remote locations like islands that are otherwise dependent on expensive diesel power, or out at sea on gas decommissioning rigs, or for powering underwater autonomous vehicles.
So definitely, wave energy can compete with other renewable energy sources, but I personally believe that this is not a competition. In order to have a 100% renewable energy friendly world, we need all renewable energy sources to work together.
Who are all these people from? Who are all these people from?
So can you please tell me? I'm not going to... please wait.
You know, I've covered a lot of companies. I've covered a lot of Machiavellian companies where, you know, people play rough. I don't think I've ever seen anything on the scale of Nissan.
He's making you, but you act for this one. I mean, it's corrupt. The system is...
One of the most dramatic elements was Ravinder Pasi's home being raided by court officials in Yokohama.
You scared me. You scared my children. I worked in this for 16 years.
So Rav Pasi's journey into the darkest recesses of the Japanese corporate world started when he was the general counsel, the highest corporate lawyer position in the company.
In the past few minutes, Nissan has revealed that its chairman has been arrested after allegations of serious misconduct.
He was tasked with investigating Carlos Ghosn. And he was told, conduct an internal investigation and get to the heart of the matter. And then along the way, he started to notice serious conflicts of interest.
He is one of the few people who knows an extreme amount of detail regarding the alleged crimes by Carlos Ghosn. And he's now ready to tell his own story on the record about some of the events that happened.
My name is Ravinder Pasi. I'm the former Global General Counsel of Nissan Motor Co. Limited. And you could say, yes, I had a front row seat in terms of what was going on.
When Carlos Ghosn saved Nissan years ago, he was depicted in Japanese comic books as this hero, and now maybe we'll see comic books where he's the villain.
In corporate Japan, Nissan was quite an unusual company. It was led for 2 decades by a non-Japanese executive.
Well, Carlos Ghosn was a hero in the Japanese business world. If you had a global business celebrity in Japan and worldwide, it was definitely Carlos Ghosn.
In a country with few foreigners at the top, he stood out. But over the years, he saved Nissan from bankruptcy, allied with Renault and Mitsubishi, and turned the alliance into one of the most competitive in the world.
Yet as the years went on, you know, I think his ambitions changed a little bit. He started thinking about legacy plays, and one of them was to really tighten the alliance between Renault and Japan. And unbeknownst to him, there was a contingent of senior Nissan executives that were really felt threatened by that move. They really thought that they would lose complete control of the car company, and even in the government, there was probably a little bit of anxiety about a national champion in the auto industry falling under full-blown foreign control.
Carlos Ghosn was an auto industry leader, respected by many in Japan. Now he's in jail.
The arrest of Carlos Ghosn came completely out of the blue. This was in November of 2018. He was coming to Japan on Nissan's corporate jet for a regular executive meeting, and he was met on the tarmac by Japanese authorities who whisked him away to jail and charged him with financial misconduct crimes.
So what happened was that a power struggle ensued inside the company, and somewhere along the way, it was criminalized. By that I mean that there were allegations leveled at Carlos Ghosn about the way he reported his pay to Japanese authorities, the way he handled money inside the company, that in other contexts might have been a board action, might have been handled internally. A number of executives at Nissan decided to take this difference and take it over to the Tokyo prosecutor's office, and that unleashed a chain of events that would shake the entire auto industry.
So after Carlos Ghosn was arrested, Nissan launched an internal investigation into the events that led up to his arrest.
So Rav Pasi was tasked with investigating Carlos Ghosn, and he was told, get to the heart of the matter, find out what Carlos Ghosn did wrong and bring it to our shareholders.
It's really complicated because you had various things coming out of the weeds. 2018, the investigation has started, and we become aware of matters in terms of conflicts, actions by certain individuals that cause some concern because things might not quite be what they seem.
So in our story, we really took a close look at Harinada and his role in Carlos Ghosn's downfall.
Harinada is one of the most fascinating figures inside Nissan. He's also a lawyer. He's originally Malaysian. Hello, Mr. Hadi. And he had a meteoric rise through the company and became very, very close to Carlos Ghosn and other top figures. He had a front row seat at all the major strategic deliberations at the company. And when he discovered that Carlos Ghosn, as his final legacy play, was going to tighten the relationship between Renault and Nissan, he made a decision to go against Carlos Ghosn. And he became one of the key figures that decided that Carlos Ghosn had to go.
Harinada was somebody who actually recruited me into the company, so I have a long-standing relationship with him, or did have a long-standing relationship with him. For many, many years, he was a mentor. I had doubts about the credibility of the process right at the start. Harinada had a plea deal with the Tokyo prosecutors. Now, that suggests he was intrinsically involved in some of the wrongdoing, or the allegations of wrongdoing, and it just didn't smell right, just doesn't sit right.
So there was a basic conflict of interest. In other words, Harinada had to deliver results to Japanese prosecutors to avoid his own criminal liability, and he's accusing and leading the investigation of Carlos Ghosn.
Some of the people who had been involved in the original alleged crimes were also looking into the affairs themselves. Ravinder Pasi began pointing out some of these conflict of interest issues. And the reason for that is essentially his concern was for the company. If the company's own investigation into itself was compromised, that could lead to a very weak position in various lawsuits that it was dealing with across the world.
I had discussions with Harry, discussions with the statutory auditors about these conflicts, discussions with HR about some of these conflicts, because at that point, we reported into him. You know, at the time, everything was quite, as you can imagine, it was, we've got to do this, we've got to do that, we've got to move fast. But when you step back and look at some of these things, you just think, my God, what was going on here? Because me, members of my team, were being placed in immediate danger. Your chairman's been arrested, a representative director's been arrested. They both happen to be foreigners. And then now what we need to do, we're being instructed to do, is certain compliance professionals need to go into properties in Brazil, for example, and retrieve evidence. They've got to do it very carefully, because if they don't do it carefully, they're going to get convicted of criminal activities. And likewise, when a team of lawyers were commissioned to go to Lebanon, I mean, one of my immediate concerns was, why are lawyers from Nissan being sent to go to Lebanon to retrieve evidence? These are just lawyers, they're corporate lawyers from Nissan. You had revelations that a number of executives had benefited from share appreciation rights when they shouldn't have. I mean, you know, substantive amounts of money being taken by these guys when they weren't entitled to take them. And you do think, yes, how is this going to look later on? It's going to look quite concerning. So that triggered for me the sort of assessment that, well, I'm going to have to do something, because up until this point, I haven't put down on paper these conflicts and these issues.
So Rav Pasi makes a fateful move. He writes this letter to the board listing every suspicion he has in great detail, backed up by evidence, backed up by memos, of why this internal investigation had serious problems. He sends the letter to the board and it's crickets. He doesn't hear much of anything.
Nothing happened thereafter. Nothing at all. Just like it just gone into a black box.
And he began to suspect that there was a desire, even at the highest level within Nissan, to kind of sweep these conflicts of interest under the rug.
Unfortunately for me, I think, again, with hindsight, people must have thought that this is the nail that's sticking out, and we can't have this. Within 3 days of me submitting that to the board of directors, that letter to the independent board of directors, I was removed from the Ghosn Executive Conduct Matters. I was then told that I could not attend board meetings anymore. And up until that point, I had attended every single board meeting. I was then also told that after 8 years of being in Japan, I'd be going back to the UK. It eventually transpired that I'd be the VP of Projects and Transformation, managing a team of 3. So you can imagine what this feels like at this stage. Almost an arbitrary removal from Japan, where I've lived for 8 years, had 3 children there, my family has grown up, and we've been settled there, having a few months earlier been promoted to vice president at a global level, to being almost demoted.
So Pasi was essentially being reassigned to get him as far away from the internal investigation as possible, and also to a certain extent in retaliation to some of the issues that he brought up regarding the internal investigation and Harinada.
What happened to Rav Pasi can be seen as a series of corporate humiliations. I mean, first of all, his immediate responsibilities were taken away from him. Eventually, he lost, the coveted general counsel title. But it didn't stop there. Toward the end of his stay in Japan, Rav and his wife were convinced that they were being followed.
During that period, I'd noticed that whilst driving my car, I'd have other cars following me. First time I noticed this was around mid-March, and I was driving, I can't remember where I was going, but this grey van, small van, just literally started following me. And I noticed that there was somebody in the car taking pictures. And lo and behold, we were absolutely being followed either by people on foot or other individuals, 2 or 3, normally 2 burly men in a car, different cars at different times, following us around. They were following the family as well.
Connection lost.
Given I'd seen the Nissan security department behave in a very, very egregious manner with others in terms of following and surveilling, I was very concerned as to what they were doing and who they were giving this information to. Because if they're giving this information to the authorities, you do think, why? What's going on here? I mean, this is just not normal behavior.
And this all culminated in a rather dramatic event in the middle of 2020.
Who are you people?
where Nissan had hired a legal team and had obtained an unusual court order from the district court in Yokohama
to basically do a search of his home and seizure of his corporate laptop and phone and other documents.
If you don't let us in now, we have to break this key.
So it's a pretty extreme way to treat someone who'd spent 16 years at the company.
These people have all come in. We don't really know who they are, apart from the fact that I've been shown a badge that says the Yokohama Court. And they're here to recover a laptop and a mobile phone. It was even more weird because I'd highlighted to the directors that certain Nissan executives were trying to recover this laptop and this phone whilst I was still in Japan. And I was very concerned because it had evidence on there that related to misconduct matters and other forms of inappropriate conduct. It was just another form of intimidation, another form of harassment, forcing me almost to leave the company and the country. Because once they'd retained and obtained these items, we were still followed, which, again, I just couldn't understand. What is the point of doing that? This isn't a car company. This is not the KGB.
I think it's fair to say that Rav Pasi didn't have full battlefield awareness of all the intrigue going on at Nissan. I mean, Harinata is interesting because he's both charismatic and charming, and one of the most brutal corporate infighters one could ever run across.
This is a confidential company email, right? You should not have this.
If he had fallen into line, he would probably still have his job at Nissan, be paid very well, and continued his work.
A career that he spent 16 years building at Nissan is irretrievably broken. It's been smashed to smithereens. He and his family paid a huge price, certainly. But in terms of being able to sleep at night, I think, he's come out ahead.
I highlighted issues to the highest levels of the company so that they could be dealt with appropriately by those in charge. There was no response to those, and there was retaliation against me. What's really profound, like absolutely profound, is that none of your colleagues, I mean people who you have known for years, forget it.
Yeah.
You're on your own.
Yeah.
And you got to be ready for that. You've got to be ready for that. If you take it on anyway.
This is the awful truth. There's always someone in the family that's pushing it.
This lady does not deserve to be taken advantage of, especially at your age with your own grandchild.
Yeah.
My grandma is having to sue them. I'm testifying against them. Nobody's talking. They're one floor below right now. I get afraid to go on the elevator. It's sad that it had to devolve to this.
It's like a soap opera
It's
to
a very
me.
sad thing.
It's a family feud.
A family feud.
Here's a family that, on paper, you would think has the wealth that so many people seek, yet at the end of the day, it seemed to sort of rip everybody apart. My name's Tom Schoenberg. I'm a senior reporter here at Bloomberg News, cover financial enforcement. I was approached by someone close to the Schottenstein family and asked whether or not I would be interested in writing about Beverly Schottenstein and this case that she had against J.P. Morgan. And it was immediately clear that there was a great story here to be told. So I started just, assembling all sorts of documents that the family made available to me. That included a diary that Beverly had begun writing when she started having suspicions about what was actually going on with her money. Beverly obtained her wealth from the Schottenstein kind of retail empire that has at times included Big Lots, Value City, American Eagle Outfitters, DSW Shoes. Beverly's husband died, and at which point they sold off their portion of the company, bringing them an enormous amount of wealth at around 1990. Estimates of her wealth were around $90 million. She, for many years, had that pool of money being managed by outside advisors. Her grandsons in the late 2000s had both graduated and were becoming financial advisors. She gave them a little bit to work with, and over time, her grandson, Evan, became the trustee of her entire estate. Managing sort of family money is not a conflict. In fact, some ways in wealth management, it's kind of how you get your start. It's kind of the seed that you need to sort of get going in the business. But Beverly started having suspicions that something was wrong probably in around 2016.
Well, there were suspicious things, but taken separately without everyone talking about their own experiences, it was hard to really put it together.
She had written a check to her caretaker, Dawn, that bounced. So she went down to her local Chase branch to sort of find out what was going on. She wasn't getting paper statements in the mail, so she asked them to print out a number of her statements having to do with her checking account and her credit card account.
So we went to the bank and asked for the statements. And she got a whole year and going through all of them, page by page by page.
And it was there she saw all sorts of charges that she said she didn't authorize or didn't know about.
I was becoming very, very suspicious. I was starting to look in the money part, and that's what bothered me more when I saw that money was going, and I was not a big spender.
Around the same time, Dawn, she starts noticing Beverly's son, who lived in the condominium below her, came up with Evan with a shredder and started grabbing papers in her office area, including some with J.P. Morgan letterhead, and just started sitting at the kitchen table, just shredding documents over and over.
Yeah, they came in one morning.
They used to do it in the back.
Through the back door, and they brought the shredder inside. And then they went in the drawers in the office and took out all the papers, and they started doing it. I was very suspicious because I know you don't go around and destroying papers.
Beverly said that they had done this many times before.
That's when she said to me, Dawn, I'm going to write my feelings in this black book.
Diary.
And it's a diary, and she started writing. Each day she would write a little at a time.
Around the holidays of 2018, the package had arrived, a FedEx package, and in it were materials about a venture capital fund based out of the Cayman Islands. Dawn and some other family members take a look at this, and they see that Beverly is signed up for this fund to the tune of $5 million over the course of several years.
And that was really the beginning of it. That was sort of the tip of the iceberg when it became obvious that something was going on, that my grandmother really wasn't aware of this fund.
You know, Beverly started to panic. She got really upset and called, J.P. Morgan's headquarters in New York and asked for Jamie Dimon. She said she was told someone would call her back, but she says that never happened. She wrote a letter to Evan and Avi, and in there she laid out a number of things that were concerning her: unauthorized trading, the checking account. She had about $1 million worth of jewelry in a safe deposit box, and that her son Bobby had the key to that box, and that jewelry had gone missing. All this was kind of packaged in this, 5-page handwritten amendment to a will and trust.
There's such an evolving narrative about why the jewelry was taken. The only truth we really know is that the jewelry is gone. But why it happened, there have been a lot of different stories.
You just don't take your mother's wonderful things and hand it out.
And they emailed that note to J.P. Morgan to seize all activity on her account.
And it ended up setting off a firestorm after that. As soon as they got this email that there was a cease and desist and that she wanted to send her money and change brokerage firms, they were actually vacationing one floor below downstairs. They're there right now.
The next day, Beverly's in her place. The granddaughter's still in her place visiting. Dawn is there, and up comes Bobby kind of barging through the door. And he's screaming about what was sent to the J.P. Morgan. They're now investigating them. And he's furious, takes his mother and sort of puts her into a chair, gets pen and paper, and she says physically forced her to write a retraction letter.
They were pushing me around.
It was a scary time. I was really afraid, too.
I had to take her to the doctor, and she did an x-ray because she was in so much pain.
The locks had to be changed. The phone number had to be changed. I really thought we were going to have to hire guards to be outside just for protection.
Oh, it was terrible.
Horrible scene.
Beverly brought her case before the Financial Industry Regulatory Authorities, usually known as FINRA. It took several months of hearings. She sees all sorts of transactions that's going on, hundreds of them that she claims that she never knew about, never authorized, but yet were logged in J.P. Morgan's files as having been direct requests from her. That included the sale of a large amount of Apple stock worth several $1 million, as well as all her stock in Big Lots. Over the course of their time with J.P. Morgan, Evan and Avi were making all sorts of trading on her account that was generating millions of dollars in commissions for themselves and the bank, yet she was not sort of getting any of the type of gains that you would expect sort of an $80 million account in a bullish market to be able to get. They issued a ruling entirely in her favor, finding that her grandsons, as well as J.P. Morgan, they were liable for violating their fiduciary duty, misrepresenting themselves, and they also found that the bank and her grandson, Evan, were liable for elder abuse. Evan and Avi, they were fired from J.P. Morgan. They issued an award of about $19 million. I reached out for comment, and J.P. Morgan emphasized that Evan and Avi were no longer with the firm and that their actions do not represent the sort of values of the bank. I reached out to Evan and Avi, heard back from their lawyer saying that, they disagree with the law and the facts that FINRA kind of used to decide the case against them and are seeing if they can have it withdrawn. Her son, Bobby, wrote her a letter, said his sons weren't criminals, and he also admits to taking her jewelry. And he says he needed it to pay off some bad business debts he had.
They never once came up to say, I'm sorry.
If there had been an apology and some acceptance, and asking for forgiveness from my grandmother, I don't think we'd be in the position that we are now.
Since the piece came out, we've received dozens of messages from people, many of whom are telling their own sort of personal tales of, kind of financial advisors gone bad, or family members who got control of an estate and abused, those within. It seems that it's really resonated with a lot of people. I keep, hearing a lot of feedback about Beverly and how, a lot of people feel she did the right thing.
You're never too old to stand up for yourself and try to right an injustice. She was adamant that she wanted to stand up for herself, but at the end of the day, they did wrong.
It's a painful life lesson. Beverly taught them that you don't mess with grandma.
On April 20th, oil markets did something they never had before, and they crashed, went into negative territory and closed the day at minus $40. Meanwhile, in a place called Thaden Boyce in Essex, a group of 9 traders, led by a guy called Cuddles, made $660 million over the course of a couple of hours.
The price of oil has collapsed to a record low.
We've never really seen anything like it. WTI this morning down more than 35%.
People maybe wouldn't have been so surprised if the oil price had fallen to zero, but the oil price went to minus 38. It went far lower than anyone had expected. And so lots of people in the market were saying, well, hang on, something else is going on here.
A couple of months later, I started to get wind through a kind of network of sources that a tiny firm in the outskirts of London had made a huge amount of money that day and potentially had some part to play in what happened.
The information we got was that 9 traders at Vega Capital London had made in the region of $660 million in one day. As a group, I think they made as much money in one day as Apple makes from its international sales in one day. I mean, it's an insane sum of money.
Did they pull off a fantastic trade? Did they predict the way the market was moving and get it absolutely right? Or was there something else going on, and had they actually done something that breached market rules in a bid to sort of push the market? And that investigation is ongoing. So Paul Commins is a trader who cut his teeth in the pits in the 80s and 90s. When everyone had a nickname, his was Cuddles. If you can imagine, that was a very sort of cutthroat type of world where people are doing, hundreds of thousands and millions of dollar trades by shouting at each other, giving hand signals, and then sort of scrawling on scraps of paper.
The culture of the trading pits in London was very influenced by the working class guys who became traders there. They weren't like the city bankers that had gone before them. They weren't usually Oxford or Cambridge. They didn't wear Savile Row suits. They were ordinary working guys who happened to have a talent for trading. And a lot of them came from Essex.
I think it was 400 traders in the pits, and Cuddles in his oil and gas pit was described to us as amongst the top 3. Amongst that, was very successful and made very large amounts of money as a young man. But inevitably, mechanization and the arrival of electronic markets was the kind of death knell for the pits. And in 2005, the IPE closed down.
And when the pits shut down, a lot of the traders who worked there lost their jobs or quit or went to work for financial institutions. But Paul Commins decided to start his own trading collective out in Essex.
Some of them are ex-pit guys, cut from the same cloth as him. Lots of them are actually sort of in their 20s, and they're his, drinking buddy's son, or they're his own kids' friends from football. They're young lads, hungry and ambitious, and he brings them into the fold. And fairly shortly, he's got, maybe a dozen or so traders that they're independent, let's be clear, but they're all part of this collective.
Yeah, I'll let Liam deal with Essex.
I am from Essex, so I feel like I'm free to, to get into this.
Sweet, as they say.
If you were to ask someone in Britain how they would imagine a kind of Essex person, they would see someone who's maybe slightly flamboyant, with a sort of Cockney accent, a sort of Guy Ritchie-style accent. Not afraid to splash the cash, but it's probably pretty bright and has done well for themselves.
Don't even make sense, does it?
But, these guys, they drove around very nice Rolls Royces and Bentleys. They went to places like Marbella on holiday.
Baden-Boyce is a very wealthy place. You have to have considerable income to be able to afford to live in that village. It's a really nice place to live, and it's 20 minutes tube ride away from the city.
Earlier in the summer, we have this lead, which is that there's this tiny firm called Vega Capital London, and they were the biggest winners from the biggest oil crash in history. Anyone that covers markets is going to be surprised about that. You're thinking your BPs of the world or your Glencores, but it's this tiny firm.
And one of the big challenges that we had was actually finding out who worked with Vega Capital. It wasn't immediately obvious, and at first we had absolutely no idea. If you go to the Vega Capital website, it says it's under construction. If you do basic online searching, it's very difficult to find anyone who's publicly connected to the company.
So inevitably, we're incredibly curious at this point. Like, who the hell are these people?
The more reporting we did, the more it became clear that this group were connected socially as well as professionally. They went to weddings together, they played golf together, they would go on holiday together. We found out that a number of them were members of the West Ham Supporters Club in London. A few of them started companies together, so you could see all the connections between them and start to see a distinct group emerging.
And it really just was this kind of shock that, this wasn't just like a hedge fund or a firm you'd never heard of. This was actually a group of buddies who all had the same experience on this day and had all made a huge amount of money. So if you're an oil trader, there's a number of different ways you can trade, and probably the most popular is WTI futures contracts.
And it's basically a contract that says, I'm going to buy 1,000 barrels of oil from you at this point in the future, or I'm going to sell 1,000 barrels of oil to you at this point in the future.
It's actually just a financial contract to gamble on to predict whether oil is going to go up or down.
On the 20th of April in Essex, there have been signals for a while that this was going to be an exceptional day in oil markets. And we know that some of them arose early and started their trading in the early hours of the morning while it was still dark outside.
Essentially what they were doing is buying contracts that gave them an obligation to buy oil at whatever the price ended up at 2:30 p.m. So they're basically placing a bet that oil was going to fall throughout the day.
But they're simultaneously selling lots of oil as well. And whether they make a profit and how much profit they make is the difference between what they buy the oil for and what they sell the oil for. Now, of course, we now know throughout April 20th, the price dropped and dropped.
So this is going very well for them. They are committed to selling oil at these prices, and the prices are continuing to fall, which means they're going to be able to offset it and buy oil at cheaper at the end of the day. Now, once it gets to kind of 1:30, 2 p.m., that's when things start to get really interesting. Suddenly there's a kind of influx of buyers and sellers, as desperation increases in the market and trading volumes go up. Now, at 2:08 p.m. exactly, something bizarre and unprecedented happened, which is that oil passes into negative territory.
And it fell to a record level of minus $38.
We've never seen anything like it, period, in terms of the contraction of the global economy.
That huge gulf between what they were buying the oil for and what they were selling it for enabled them to make more money than they ever thought possible.
So their profit was the difference between minus 37 and all of these positive numbers on every contract they sold.
The price of crude briefly hit minus $37 a barrel. For one group of traders operating from a small office, it was a very, very profitable day.
It's important to remember this had never happened before in the history of oil trading. No one could have predicted it.
I can't think of another example of where you enter a trade and you get paid on both sides. You get paid both to sell and to buy. It's unthinkable.
One thing we know about the Cuddles Trading Arcade is that they were very comfortable taking large risks. And, you have to be clear, this was a large risk.
Yeah, we spoke to oil traders, both people that know these guys and people that don't, and they all say that this is, incredibly risky.
And that's actually what stops a lot of oil traders doing trading like this. They simply aren't willing to stomach the risk. But Cuddles and his friends were.
So when the kind of final calculations came down, the group of the 9 most profitable traders made $660 million or thereabouts between them. I mean, if you can imagine, I think 3 or 4 of them made in excess of 100 million each.
One of the astonishing things about this trade is that 2 of the individuals who made more than $100 million in a single day were in their 20s. One of them was 22 years old. Only a few years earlier, he'd been posting on his social media about doing teenage stuff with his mates in town and going to see girls and rap music. And here he is a few years later making $100 million in a single day's trading. When me and Liam discovered that, we couldn't believe it. We couldn't believe what we were seeing. Oil trading is a zero-sum game. Anytime you're making money as an oil trader, someone else is losing it.
Amongst the biggest losers were the investors in this Chinese fund, Crude Oil Treasure Fund. There were thousands of them, and they lost everything.
Lots of people had put their savings into oil funds. They lost money that day. Big banks and brokers who sort of stand in the middle of trading parties, they lost money that day.
And another interesting thing is that oil-producing countries like Kuwait or Canada, they sell oil as an average of the WTI closing price over the preceding month. So the fact that one of those numbers in that average was minus 37 meant, if you can imagine, countries like Saudi Arabia and Kuwait potentially lost a couple of dollars on every single barrel of oil they sold that month.
Vega Capital's traders made such an extraordinary sum of money that it was inevitable there would be some scrutiny of what they did. But it wasn't just the sums of money they made. In the vital half an hour before the settlement price was set, they were by far the biggest sellers of oil futures in the market, which is an incredible thing to think about when you consider that the other participants in that oil market are going to be the world's biggest banks, oil majors, BP and Shell, and here you have a group of 9 guys in Essex who are having this significant influence over a global market for oil.
I mean, I think you have to assume that if these guys had made $7 million or $10 million, they probably would be celebrating in Essex right now. But the fact that they made closer to $700 million has meant that they are facing understandable scrutiny.
We wrote individually to all the Vega traders who did exceptionally well that day, and we got a letter in response from a law firm representing the group. And the law firm was at pains to point out, number one, that they haven't been accused of any wrongdoing, that they all traded independently and separately, and they'd basically all made up their own minds that this was what was going to happen in oil markets based on publicly available knowledge, and decided to execute this trade.
What I love about these stories is there's a real variance of opinion, and some people will look at what happened and think that must be dodgy. They all traded at the end of the day. They all made a huge amount of money while all these people lost. That's shocking. But lots of people say these guys are at acute disadvantage. They're in a market that's inhabited by, huge technology-driven funds and firms and oil giants that have got all the advantages in the world, and when you get a bunch of Essex geezers who essentially beat the market and find a way to make a huge amount of money, they should get a pat on the back, really, because that's the dream. Since this happened, a lot of the guys have stopped trading the monthly settlements that they've done so well at in the past. Several of them have set up new companies. They've essentially gone very quiet. Any kind of social media presence they had is kind of closed down. By all accounts, they're, waiting this out.
It's certainly too early to try and predict how the regulatory investigations are going to pan out. We just don't know. There's a number of potential outcomes for these guys. Potential punishments if there are any findings of manipulation against Vega or anyone affiliated with it might be you could be fined, you could be banned from trading, and in the most extreme cases there have even been criminal prosecutions in the past of people who have been found to have been manipulating the settlement and misconduct related to trade at settlement. There are other outcomes too. One obvious one is going to be that they're able to walk away from this life-changing trade with all the money that they made and celebrated as heroes in the trading community. That they'll go down as legends.
It's very important, given the nature of the climate crisis right now, for the general public to have an understanding of what progress is or is not actually happening. And I think many readers right now, they'll see these hundreds and hundreds of companies making these big, bold climate claims. And they would be forgiven to think that we're well on our way to meeting the emission reduction trajectory we need to be on. And the reality of the matter is we're just not on that trajectory. And a key reason for this sort of disconnect is the use of offsets that aren't doing what they claim to be doing.
We have a massive potential for sort of willful blindness. We can convince ourselves of things regardless of what the facts are. And so that's what tends to happen in these cases. It's not that anybody is setting out to commit climate fraud. They sort of walk themselves into a situation and they convince themselves of one thing, and that allows them to convince themselves of another thing. But at the end of the day, they're doing something that makes no sense at all.
My name is Ben Elgin. I wrote the story about how the billion-dollar market for carbon offsets is setting back the fight against climate change. So one of the challenges in reporting on carbon offsets and trying to figure out what's going on is really finding good experts who have been steeped in this marketplace and are willing to candidly talk about it. One of the best people for this is a fellow named Mark Trexler, and I've been talking to him for more than a decade.
My name is Mark Trexler. I've worked in climate change for the last 30 years. I was actually hired by the World Resources Institute in Washington to work on the first carbon offset project in 1988. In terms of defining a carbon offset, one of the beauties, so to speak, of greenhouse gases, sort of the silver lining of greenhouse gases, when you put up a molecule of CO2 into the atmosphere, it can be anywhere in the planet in 7 days. And therefore, if there's an option to reduce emissions on the other side of the planet, and you can do that very cheaply as compared to doing it in your factory, for example, then why not pay that person, that factory on the other side of the planet to reduce their emissions? Then you are, in a sense, offsetting your emissions, and the atmosphere doesn't really see your emissions anymore.
So carbon offsets have been around for quite some time, and they were actually key with these international climate agreements, such as the Kyoto Protocol, which mandated the wealthiest countries reduce their greenhouse gas emissions.
The treaty was signed on the 11th of December, 1997.
Decided. The business community in general saw carbon offsets as a huge opportunity to comply with whatever policies and measures might be coming down the pike on climate change much more cost effectively.
We've seen a huge surge in companies making big proclamations about how they're going carbon neutral or zeroing out all of their carbon emissions.
We're going to reduce our carbon footprint to net zero.
Unilever is committing to net zero emissions.
We can achieve a net zero emissions world.
We began looking at these corporate claims of dramatically reduced emissions, and we noticed so many of these companies were using carbon offsets to achieve these aims. And as we began to look at the carbon offset projects themselves, what we found is that the environmental benefits claimed by these companies are not actually what they seem to be. And as we sort of saw and spotted a number of these very aggressive carbon offset projects, which appeared to be generating inflated credits or bogus credits, we saw a number of them were associated with the Nature Conservancy. This surprised us. The Nature Conservancy is the world's biggest environmental group. They have about $1 billion a year in revenues, and they've been around for 7 decades. They've preserved about 125 million acres of land, and they've done so many good works over the years, and they've been very strong in terms of working with corporate partners. The Nature Conservancy has taken a different approach, a very pragmatic and pro-business approach. They will not go out and criticize a big polluter, but they're very happy to work with them. Some might say that, well, that's selling out, but others would say, and those at the Nature Conservancy would say, these companies have deep pockets. They can help fund important preservation work, and we have absolutely no problem working with them on this stuff. So companies are very warm, and they've partnered with the Nature Conservancy for many years. And yeah, it definitely lends a sheen of credibility to these projects.
Here's 20 new reasons to visit Disney World this year. 1, 2, 3.
If you look at, for instance, Disney, that's a sprawling company with theme parks and cruise lines that burn up diesel fuel. They have office buildings and television studios that consume electricity. So these companies are trying to make major reductions in their carbon footprints, but it's very difficult to change these fundamental ways their businesses operate. So Disney has been a big buyer of carbon offsets that are orchestrated by the Nature Conservancy. One of the projects that they buy from is called Pennsylvania Ridges. And that's a plot of land. Most of the land is actually about a 3-hour drive outside of Philadelphia. Interestingly, this land, 3,000 of these acres, was actually acquired by the Nature Conservancy in the late 1990s. This land was imminently threatened. There was a pending logging contract on this land. So they do what they've done so well for all of these years, which is they go out, they raise money from local philanthropists, and they go buy this land to protect it from developers and loggers. And at the time, according to an archived version of the Nature Conservancy's website, when they were proudly announcing this deal, they said, these threats have been abated because of this acquisition by the Nature Conservancy. So it's really interesting now, fast forward 2 decades to earlier this year when they put forward this carbon project. And if you look through it, this land is a key part of that carbon project. And what they're now saying is this land is now, once again, imminently threatened. 72% of the trees are going to be cut within 5 years. Now, this is just astounding because this land is owned by the Nature Conservancy. They do not clear-cut land that they've bought through philanthropic donations. So this scenario that they've put forward to get carbon revenues is not really plausible. And what that means is when you have Disney coming in and buying these credits, when it eventually lowers its carbon footprint because of these credits, well, that won't be a credible or truthful claim by Disney. So this is an organization that truly understands the threat of the issue of climate change and is wanting to do its part to address this. However, in this situation, it just appears their drive, which they've had for decades, to increase the amount of revenues that it can use for land preservation work, Nature Conservancy and many others see that the carbon credits as a pot of money that they can tap into to further their own benevolent aims. But unfortunately, what this has resulted in is claims of climate progress that just aren't really happening. So the Nature Conservancy defends vigorously these deals, and they and others will say, look, our projects are just following the rules that these registries set up. So some would also put some of the blame on the registries themselves because they're setting up the rules which allow these vapid projects to get up and sold. So we've reached out to all of the companies we mentioned in this story, including Disney. They didn't want to be interviewed for this story, but they all told us that, look, we have to rely on the experts out there, and those experts, they say, are these carbon registries that have been set up. Most of these Nature Conservancy deals are set up and sold on this exchange. It's called the American Carbon Registry. Now, it's the oldest of these registries that allow voluntary carbon credits to be sold. They've been around since 1996. What these offset registries do is they set up rules, and any carbon offset project has to follow those rules. But there's this tension that's always there. If the rules are too strict, then it's going to be very hard for carbon offset projects to get up and running. So there's this balance going on where the registries want rules that attract projects, but they don't want it to be so strict where it will disincentivize projects from getting listed.
One of the challenges with designing carbon offset systems is that there are normally two people at the table. You have buyers and you have sellers. And to some extent, you have policymakers, but you know, the buyers and the sellers are really the ones with the expertise, with the incentive to really participate hard, make a lot of things happen. And the challenge there is that both of them sort of want the same thing, or they're both happy with the same thing. They're happy with low-cost offsets and a lot of them, because that works for their business model. You end up, though, with nobody really representing the atmosphere, so to speak. Nobody's really representing the climate in those discussions. And so the policies end up biasing the whole system, and you end up in sort of a race to the bottom, and that's what we've seen happen. You know, when it comes specifically to the topic of carbon offsets, you know, I am a fan of carbon offsets in the sense that they can help mitigate climate change. They absolutely can. But, you know, if we're not going to do it correctly in a way that actually does help mitigate climate change, then it's nothing but a distraction. And, you know, after 30 years, you have to start wondering, is it really just a distraction? And that's really unfortunate, but that's where we are. Ultimately, what needs to happen is systemic change. You know, we're sort of nibbling around the edges with some of these different things. We need to change how we produce energy. We need to change how we transport ourselves. We need to change what and how we eat. You know, we need systemic change associated with transitioning to a low carbon economy. A lot of what we're doing today is not promoting systemic change. It's sort of trying to stick your thumb in the dike to preserve the current system. And at the end of the day, that can't really work.
the Hyperloop. There's a good chance you've heard the name by now.
This is the Hyperloop system. It can take people hundreds of miles in minutes.
The Hyperloop, a series of tubes that would transport people in pods at ultra-high speeds over long distances.
It's a remarkable new form of transportation that can whisk people from city to city in a flash.
29 minutes from New York to D.C., 30 minutes from L.A. to San Francisco.
For years, we've been seeing these futuristic, utopian renderings of some cross between a spaceship and a monorail. But lately, the Hyperloop is becoming much more real.
Yes. It was surreal to be even sitting inside a Hyperloop, and just even more incredible to actually be like riding down a track in something that was nothing more than a crazy idea 6 years before.
Companies all around the world have been developing and testing the technology needed to propel passengers at speeds of over 1,000 kilometers per hour. But for many, speed is only the first step to unlocking the full transformational effects of a new mode of transportation.
Fast is what we just sort of take for granted in the Hyperloop world. It's the network effects that really deliver the benefit. And that opens up a completely different scale of economic opportunity.
We've got planes, trains, automobiles, and boats for getting around Earth. But what if there was a fifth mode? And I have a name for it, which is called the Hyperloop.
The Hyperloop?
Hyperloop, yeah.
In 2013, while riding high on the growing success of Tesla and SpaceX, entrepreneur Elon Musk released a white paper outlining the basic framework of the technology he called Hyperloop. The basic idea goes a little something like this. A tube reduces the air pressure to a near vacuum-like environment. A Hyperloop pod is then suspended in the tube, usually by magnetic levitation. The whole pod can then be propelled forward. Because there's no traditional friction sources like air resistance or rolling friction that would push back against the pod, the Hyperloop is able to move at incredibly high speeds and do so fairly efficiently. Despite its futuristic name, however, the general concept behind Hyperloop is actually pretty old. In fact, New York City's first attempt at an underground public transit system in the 1870s was based on a similar principle. The pneumatic transit system was short-lived, however, only stretching one block and topping out at a rather leisurely 10 miles per hour. While Elon would make some 21st century improvements to this concept and bestow a very 21st century name, he wouldn't end up pursuing the technology itself, instead electing to focus his efforts on something a little bit deeper, literally digging the requisite tunnels via his boring company. It would take another billionaire industrialist who dabbles in spaceflight. No, wait, not that one. Yeah, that's the one. After Richard Branson would make a large investment in the company Hyperloop One, it would be renamed to Virgin Hyperloop.
What we've always been trying to do as a company is show that this technology could work, that it could be made safe, and that ultimately it's something that's happening in the next couple of years, not the next 20 years.
Josh Geigel is the co-founder and CEO of Virgin Hyperloop. In a familiar tech startup story, he's seen the project go from a garage to a large-scale testing facility outside of Las Vegas.
So we started building the first kind of Hyperloop system in 2016. We've done a lot of work, about 500 tests that we've done on that over the last 5 years. And what we realized that we need to do is take that technology, show that it can be commercial, so drive the cost down, improve the efficiency, improve the performance. But the key thing is actually making it approachable and safe for individuals.
In order to do that, Josh, along with Virgin's head of passenger experience, Sarah Lucian, bravely volunteered to take the inaugural ride.
What her and I were realizing is we're the first two people sitting in a Hyperloop. The only type of people that have gone through this environment are in spacesuits, and there we are in just normal clothes because of the system, the safety of what we've designed.
3, 2, 1, launch.
And then once we started going, you felt a bit of acceleration. We accelerated a little bit harder than we would in commercial. It'd be like a sports car. Yes. We got to about 108 miles an hour on that test. And it's a short run. It's about 500 yards or so. And came to a stop.
The test, lasting only about 20 seconds and covering only a quarter of a mile at just over 100 miles per hour, is a long way away from a true functioning Hyperloop. But as for optics, it's a crucial step for the future of funding.
The number one question we got from investors or from project proponents or just people in general was like, is a Hyperloop safe? And what better way to show something is safe than by actually getting people on it?
But convincing investors and governments that would likely be fronting some of the construction costs for an unproven technology is no easy task. First and foremost is the question of safety.
Most people don't know how an airplane works, but yet they get on an airplane. They get on an airplane because, it's faster than driving, and most importantly, they've probably gotten off of one before, they've seen someone get off of one before. And so what we set out to do was actually show that Hyperloop could be safe with two normal people, not astronauts, not adrenaline junkies or test pilots or anything like that. Two normal people getting on a Hyperloop, and then most importantly, those two people getting off.
But beyond safety concerns, constructing Hyperloops will undoubtedly require a significant capital investment to the estimated tune of around $60 million per kilometer of track. So a track from San Francisco to Los Angeles, for example, is likely to come with a price tag over $10 billion. And before large governments are willing to come in and front those costs, investors who are funding Hyperloop development must accept it as a long-term mixture of technology and infrastructure investing.
Investors that are used to short returns because you're developing apps or something to that effect, those aren't the investors that really get excited about Hyperloop. What you start to see is the people that are looking at platform technologies, right? So this idea that because the smartphone existed, Uber could exist, right? So who are like the Vanderbilts of this century? And that's the part where you're going to get a lot more no's than yeses. But those people that have the ability, the fortitude to stick it out, to see the game-changing platform here, those are the people that we're looking for. And since we've done that passenger test, there has been a lot of interest that's really, this is a lot sooner than I thought.
Envisioning the ripple effects of what Hyperloop could achieve, though, is fairly challenging at this stage of development. It's fast, yes, but for point-to-point travel, traditional maglev trains can move pretty fast as well. And outside of China, South Korea, and Japan, even those haven't seen much adoption elsewhere due to the high costs and questionable profitability. The Shanghai line in China, for example, loses around $100 million every year. Hyperloop companies, however, believe they can offer something different than traditional railway lines.
My name's Alan James, and as far as I know, I'm the only guy on the planet who's written a government-level business case for 300 kmh conventional high-speed rail, 500 kmh maglev, and 1,000 kmh Hyperloop. It's fundamentally about moving people from where they are to where they want to go, when they want to make those journeys, and doing it in much smaller numbers. So pod designs for Hyperloop range from 12 to 28 seats, typically. Why are they small? It's because small enables the network to operate flexibly. And a great example of that is the east-west strategic route across the north of England, from Liverpool to Manchester to Leeds. So to get from Liverpool via Manchester to Leeds by train is just short of 2 hours today. It'll probably take you 2 hours driving as well in average traffic conditions. Net result is those three city regions remain three separate entities: Liverpool, Manchester, Leeds. There's very little commuting traffic between those urban areas. Hyperloop absolutely changes that from the ground up. Liverpool to Manchester is a 5 or 6 minute journey. Manchester to Leeds is also a 5 or 6 minute journey. What that effectively does is create a single supercity economy.
In this vision, the Hyperloop acts a little more like a highway, where pods have fixed destinations and don't need to stop along the way. Meaning you can travel on a Hyperloop network from, say, Liverpool to Leeds, while the pod behind you travels from Liverpool to Manchester. And if that metro Hyperloop network is connected to other networks from the same location, you could travel from Liverpool to Paris or Liverpool to Amsterdam, all without making a single stop.
For passengers, for business, for leisure, that is utterly transformational. For high-value freight and logistics, it's equally transformational. But critically, if you do a Hyperloop network at scale, you begin to deliver massively significant carbon savings too.
A multi-regional Hyperloop network could become a replacement for both short-haul passenger and cargo flights and traditional ground transportation, both of which are significant carbon producers.
One Hyperloop-connected distribution hub, perhaps at an airport that is predominantly used for international air freight, replacing maybe 10, 12, 15 distributed road hubs. It takes a lot of polluting and inefficient truck haulage off the roads. That itself means roads gain extra capacity.
Hyperloops will still need to use electricity to both move pods and maintain the near-vacuum environment in the tube. Proponents of the technology believe that this can be done by using renewable sources, including a combination of solar panels and battery technology that could be used along the Hyperloop itself. But even with all multipliers of time and carbon emission savings that a Hyperloop network may provide, the investment capital required to actually build such a network becomes even more economically and politically daunting.
Committing doesn't mean spending billions on day one. Committing means, how do we phase it?
One company in the Netherlands is working to develop that technology, and perhaps more importantly, the international coalition needed to make the Hyperloop network a reality.
So we are here in Europe's first full-scale Hyperloop test facility, where we can already prove every conceptual technology of the Hyperloop.
This is Tim Houter, a co-founder and CEO of Hart Hyperloop, headquartered in the city of Delft. And while this testing tube might not seem as large as others, inside is a key technology to create the on- and off-ramp type infrastructure of a Hyperloop network. That is, a lane switch.
That's something we can already test here. You can actually see it here, that the track is diverging from one track into two. That makes it possible to eventually split up the Hyperloop track in two sections. And in that sense, you can create a complete Hyperloop network that in the end will make it possible to travel, for example, over a whole continent. Take Europe, for example, with the same ease as you can now travel with a metro in a city.
The nice thing about this magnetic levitation system that we've developed is that there's absolutely zero moving components in the track. So for example, if you have to do a lane switch, all you do is that the tube basically splits up, and statically the tracks also split up. And whenever the vehicle enters a switch, it either pulls itself to the right with its magnets, or it pulls itself to the left with its magnets.
Lane switching on traditional rail requires the physical movement of the rail. Even modern magnetic levitation tracks use lane switching techniques in order to transfer trains from one track to another.
And this is a very crucial element, because this is the thing that limits the capacity and, in the end, the usefulness of the rail network. Because the moment that a track is switching, that means that at that moment you are creating an unsafe environment for the trains behind it. So you need a lot of space between trains. But in a Hyperloop, because you have no moving components in the track, all the vehicles can be much closer to each other. You can achieve a very high frequency and basically have your vehicles moving and merging in and out of the network very much like a highway.
For now, though, Hart's physical testing has been limited by the size of their tube. Because the test track is only 30 meters long, they haven't tested this lane switch at speeds greater than 20 kilometers per hour. However, the company is working to build a new test site where it plans to increase that testing speed to 300 kilometers per hour.
We're now in a phase where we have proven most of the most important technologies in the test facilities that we already have. And we have also demonstrated the viability and the feasibility of a network. If you look at all the subsystems that it consists of, most of those are proven systems, already demonstrated in lab conditions. So we don't really believe that the technology itself is going to be the biggest challenge.
Because for all Hyperloop companies out there, actually building a Hyperloop system requires more than just a good product.
We're talking about the safety aspects, we're talking about integration into the environment, we're talking about the social aspects. Do people feel comfortable traveling in such a system? So it's about all these different aspects, and the complexity is really getting all the different stakeholders that are relevant and that do need to contribute to bring this to market, to get them all following the same roadmap.
In order to help build this coalition of private and public interest in Hyperloop development, HART in 2018 partnered with other Hyperloop companies from Europe and Canada. The goal was to define, establish, and standardize the framework to regulate Hyperloop systems.
Right now we are working with all the Hyperloop developers together in setting up the first, let's say, structure for starting the standards drafting.
One of the most important goals for HART is interoperability, which is essentially making sure that different systems can communicate with each other.
Interoperability is so important because what we want to achieve is actually have this seamless travel experience. So you don't want to end up, for example, going from Madrid to Paris and then switching because you need to use a different technology to get, for example, to Amsterdam.
The idea being that as companies around Europe create the first commercial Hyperloop tracks between individual cities, one day those can all be connected to a larger network.
Everyone that believes that Hyperloop is a future transport system also realizes that there is a need to have this network because that's where Hyperloop thrives.
Hyperloop is such a huge project. It's definitely not something that you can do on your own or as a single company. So you need to do it with a lot of other companies. You need to have the governments. I think in that sense, the biggest challenge that we've encountered is to really get all the required parties together to take the steps in development and in commercial implementation.
HART's next plan is to build the European Hyperloop Center, an open testing facility which will include a 2.6-kilometer test track. And the company hopes to test travel speeds there at up to 700 kilometers per hour. Virgin Hyperloop is also racing to construct the first commercial Hyperloop route, with projects in various states of development in India, Saudi Arabia, and the United States. Recently, the company announced plans to build a Hyperloop certification center in West Virginia, which will include a 6-mile-long test track. Proving the technology here will be crucial if Hyperloop networks can find a home among infrastructure investments that the Biden administration hopes to make.
The idea that there's multiple Hyperloop companies, I think, is a redeeming aspect in the business. People really want to see something happen, so having multiple people move forward is good for that.
I was struck when Josh and Sarah rode the pod. 2 or 3 of the major outlets used the phrase, "We now have a new mode of transport." And although all of that technology had existed before those 2 human beings rode it, it was the moment at which those 2 human beings traveled that short distance down the tube that in popular imagination, Hyperloop became a mode of transport.
The metaphor I use with my team is that, the Wright brothers were first, but none of us fly on Wright Brothers Airlines anymore. If you don't continue to innovate, you're not going to be around, and so we'll continue to be at the forefront of building Hyperloop.
Back in 2013, Elon had an idea. I think the difference now in 2021 is some brilliant engineers have spent real time grinding out the details. And I thoroughly expect the next 3 to 5 years to be decisive.
This week, how hydrogen can transform our energy usage. We'll look at why the universe's most abundant element could be a game changer in the climate revolution.
Hydrogen technologies are not new. They are used in other sectors. We use them in space, on our rockets, and we don't need the laws of physics to change to be able to use hydrogen on our planes.
From iron ore to green hydrogen, one of Australia's richest men tells us about his pivot to sustainable energy.
Let's take action. It's practical, it's implementable. Let's do it now.
Plus, the hydrogen revolution. We'll speak with the CEO of Italian utilities firm Snam about his new book and how green hydrogen could be competitive within 5 years.
Costs are coming down and people are waking up to the fact that it's the only way to decarbonize certain sectors.
From Bloomberg's global headquarters in New York, I'm Kaylee Lyons, and this is Bloomberg Green. It's a new year, so here at Bloomberg Green, we're highlighting new solutions in the fight against climate change. And one of those is as old as the universe itself, hydrogen. It's the simplest element around, but could well be a game changer when it comes to turning around our dependence on fossil fuels. Today, hydrogen is used in the chemicals industry to produce petroleum products. It's also starting to be used in steel production, an industry under a lot of pressure to decarbonize. But it has far more uses as well, from powering cars to heating our homes. And Bloomberg New Energy Finance sees a seismic shift in the sector in the next 10 years as green hydrogen squeezes out dirtier alternatives. So-called gray hydrogen dominates today. But as renewable electricity gets cheaper and more accessible, so will green hydrogen. In this week's edition of Bloomberg Green, we'll explore what this push into hydrogen means for tackling climate change. We'll hear from Australian billionaire Twiggy Forrest about his pivot from iron ore to hydrogen, and we'll also speak with the CEO of Italian utility company Snam about his book, The Hydrogen Revolution. But first, what are we using hydrogen for? And why does it actually matter? Christine Lee Edwards explains.
Hydrogen, the most plentiful element in the universe.
On Earth, we find it mostly bonded to oxygen in the form of water, or in other gases known as hydrocarbons. Hydrogen gas, H2, burns hot and clean, making it an attractive tool in the race to net zero. But isolating hydrogen from other elements is no easy task. Today, the cheapest way to do this is via chemical processes that break up natural gas. This releases a lot of carbon dioxide. Another method is to use electricity to split water molecules in a process called electrolysis. Although there is no carbon byproduct, a lot of electricity is needed. And if this power comes from burning coal or gas, it negates the zero emissions goals of using hydrogen to begin with. Hydrogen produced in this way, powered by fossil fuels, is called gray hydrogen. If carbon capture and storage is used together with fossil fuels, then it becomes blue hydrogen. If nuclear power is used, it's called pink. And finally, green hydrogen is when it's produced via electrolysis and powered from renewable sources. This method is considered emissions-free. It's predicted that by the early 2030s, H2 made from renewables will be cheaper than that made from fossil fuels. But that hinges on the cost of electrolysis declining, which will be achieved through larger projects and an expansion of manufacturing. To be clear, vast amounts of H2 are already used today. Global production in 2018 totaled 117 million metric tons. This hydrogen is mostly used for its chemical properties, not as a source of energy, and very little of it is clean. Some sectors like steel could start using hydrogen for these chemical properties, replacing coal. Industries like cement and glass may also use hydrogen as a source of heat. Another advantage is its energy storage potential. It can be stored over long periods of time and used when more power needs to be added to the grid. It also could hold an advantage over batteries in heavy transport and shipping. The promise of hydrogen for energy has been around since at least 1874, when Jules Verne wrote about it in his book, The Mysterious Island. But the future of hydrogen will depend on policy. Countries with net zero targets, carbon pricing, and hydrogen strategies with investment mechanisms are likely to see the highest H2 demand.
That was Bloomberg's Christine Lee Edwards explaining what hydrogen means for the energy transition. But how are businesses approaching the sector? Well, one of Australia's richest men is making a big play into hydrogen. Andrew Forrest, better known as Twiggy, made his fortune from iron ore, being the chairman, former CEO, and major shareholder in Fortescue Metals, one of the world's biggest miners. But after having made over $10 billion in profit from the metal in the last fiscal year, Twiggy wants to transform Fortescue into a clean energy company. He's been scouring the planet in search of investment opportunities in hydrogen and renewables. The firm plans to allocate up to 10% of its annual profits for green energy investments and is exploring projects across the globe, from Indonesia to Argentina. Francine Lacqua caught up with Twiggy Forrest.
There's only one type of clean hydrogen, all the rest is dirty.
Yeah.
That is green. If you just say green hydrogen is clean, the rest is dirty, then you've actually nailed it. And, you know, anyone else who produces any other rubbish, any other argument, just look them there and say, why is global warming accelerating if anything you're saying is true?
Connection lost.
Then you'll know, actually, it's greenwashing.
Yeah, but there's a lot of greenwashing because I keep on being told it's a transition. We can't just, make the transition at a click of a finger. So what are we doing wrong? What can we do better?
I don't remember the personal computer having to transition the typewriter. I really don't remember that. I don't remember the smartphone having to transition the pocket calculator and the old landline. You know, its transition line is complete rubbish. The lie got put to it 2 days ago when JCB, a really loved British company, every right for the country to be proud of JCB, and Fortescue, holding a bit of a similar reputation, fantastic track record, everyone's been super well from Fortescue, huge balance sheet, super strong. When those two companies got together and agreed a $7 to $9 billion US agreement per annum, right, then that's a real wake-up call to say, hang on, green hydrogen is obviously commercial now. You know, every other form of fossil fuel hydrogen, you know, it can compete with it on price, it can probably lose on price, but what we know, it is cooking the planet. And only green hydrogen zero methane, zero carbon in the supply chain. Don't worry about the molecules in the supply chain.
But at the moment, we're not even phasing out coal, if you look at the G20 communique. So we have a long way to go to talk about only using green hydrogen.
Yeah, so look, I have a call, which I'd like to make now, that the world should not fund any more coal-fired power stations, coal mining projects, ever. We should wind them down as quickly as possible because they are cooking the planet just like grey and blue hydrogen is cooking the planet.
Yeah.
You know, hydrogen, which is not made from renewable electricity, is releasing 10 to 16 times more carbon, let alone the methane, which is worse, than it is hydrogen. So we've just got to stop doing things which are self-harming under the guise of greenwashing.
So why are leaders so slow? Even if you look at the appetite for ESG investments, they're growing exponentially, so are emissions. So where are we allocating capital?
Okay, so take the recent G20. There's probably a reason why there wasn't strong action coming out of the G20 because people were not aware that major transactions between large companies were taking place now on green hydrogen, that actually this pollution-free all the way through the supply chain fuel is now being transacted at multi-billion-dollar scale. If they'd known that, I don't believe any sovereign leader or any energy minister or climate change minister could not take ultra seriously that green hydrogen is now here to stay. It's broken through. History has been made. It will never go back.
Okay, what is the one thing that you would tell leaders today and business leaders? How do we transition faster than what we are now because we're at real risk of missing our targets?
Oh, so that's really simple. You stop funding, you stop subsidizing, you stop using money into fossil fuels. It could be carbon sequestration, it could be fuel rebates, it could be anything. Hundreds of billions of dollars getting ashed while we ash the planet on fossil fuel subsidies. Because we haven't had that renewable electricity, we haven't had that green hydrogen, we've kind of been pushed down. It's all sorts of excuses. Oh, it'll never be commercial. It'll never be supplied in the quantities we need it. You know, blah, blah, blah. Now we know, let's take action. It's practical. It's implementable. Let's do it now.
Okay, if we do it now, is there going to be a shock to the energy system? Is there going to be a shock actually to economically? And is it worth, not talking about transition, just going from A to B?
Yeah, it's a fantastic question. A to B is the solution. Let fossil fuels do what fossil fuels do. Just burn their coal, burn their oil, burn the gas. At least they're pumping up carbon and methane into the atmosphere, honestly. Well, not that honest because they don't measure methane, which is 90 times worse than carbon. But at least the carbon is being done honestly. Encourage the green hydrogen sector to come in really fast. Okay, it's there. There's renewable power all over the world. We now know how to make electrolyzers much cheaper, like 25% of the original cost. We know how to do that now. We don't have an excuse to get into it.
Does it need to be cheaper than oil and fossil fuel for it to be viable worldwide?
Well, right now it is. Okay, so let's just swallow that bit of financial data. Right now it is cheaper, and it's getting more cheap. It's the only fuel you know of which is declining in value.
You don't have enough of it, right, to power the world.
Yes. That's only because we haven't had policies to support it. If we had policies to support it 5-10 years ago, it would be everywhere. You'd see the global warming budget start to come down. Now, we've got 5 or 10 years to make a huge difference. I need policy leaders all over the world to appreciate now, okay, big business is transacting with green hydrogen in multi-billion-dollar agreements. We now know it's here and it's here to stay. Let's spread it everywhere.
Coming up on the program, the hydrogen revolution. We'll speak with the CEO of Italian utility firm Snam about his new book and why he thinks green hydrogen will be competitive in just 5 years. Plus, how are airlines working to become more sustainable? We'll look at how Airbus plans to step up in the climate fight. This is Bloomberg Green. Bloomberg's world headquarters in New York, I'm Kaylee Lyons, and this is Bloomberg Green. What will the world look like in 2050? Will global temperatures have stabilized, electric vehicles be abundant, and solar and wind power homes around the world? According to Marco Alvera, the CEO of Italian energy company Snam, that vision of the future could be a reality. And he says that hydrogen will pave its way. As he tells it in his new book, The Hydrogen Revolution, Alvera's moment of reckoning came in November 2018 when he tasked the Snam Scenarios team with studying how Europe could reduce its CO2 emissions to zero by 2050. Looking through the results of the study, Alvera said he was struck by how much hydrogen was in Europe's energy mix by that year. Beyond the abundance of hydrogen, the SNAM model also predicted that it would be the cheapest form of decarbonized energy for many sectors, and that it could be cheaper than today's prices for oil, coal, and nuclear power. Our Maria Tadeo spoke with Alvera at COP26.
It's happening all very fast. We see the cost of hydrogen coming down a lot. Hydrogen will play a big role in the energy mix. I don't know if it's going to be 15 or 25% of a fully decarbonized energy system, but it's going to be big. Costs are coming down, and people are waking up to the fact that it's the only way to decarbonize certain sectors, so-called hard-to-abate sectors.
And you say it's the only way and the costs are coming down. Where do you see prices moving? Because a lot of the reticence at times has to do with the pricing, that some argue, well, it's still not the cheapest option on the market.
So when I was first working in hydrogen in 2004, it was costing $1,000 per megawatt hour. 2010, $600. Today, $100, and we see it going down to $50 in 5 years' time, and to going down to $25 per megawatt hour in the next 10 years or so, which is a quarter of where it is today. That's really because renewable energy, and we're talking green hydrogen here, renewable energy costs are falling, but the cost of making the electrolyzer, which is the kit that you use to convert solar or wind energy and water into hydrogen, the cost of this kit is falling a lot because it doesn't really exist on an industrial scale. So as we build up capacity, we industrialize it, we standardize it, and we squeeze costs out. That's really the cost trajectory.
And for that, of course, you need demand, however, for governments and also institutions to kind of buy into this idea that it is the future and we want to invest and create infrastructure. What are they telling you? When you speak to governments, when you speak to officials, are they keen on this?
They're very keen. So the Department of Energy shares our view in the States of getting to below $1 a kilo, which is $25 a megawatt hour. The European Union has a hydrogen strategy, which is very clear, and several member states have the same. Chile wants to export a lot of hydrogen. China's big on hydrogen. Australia's very big on hydrogen. Japan is blending already hydrogen. So I would say the world is now really focused on this because it's the only way to store energy for a long period of time economically is to convert it into either a liquid or a gas.
And of course, you talk about the price, but the other big component is the volume. You know, how big can you go? Where do you see that on a time scale?
So wherever it's sunny or windy, you can produce very cheap hydrogen eventually. And so compared to oil and gas, which are concentrated in few parts of the world, it's going to be very democratic from that point of view. So every sunny place, every desert, every ocean wind can be turned into hydrogen that we can put on ships, in pipes, and really start trading it around the world. So it's going to happen a lot faster than a lot of people think.
So, and when you say a lot faster, what is that in time?
As I said, $50, which is essentially oil parity within 5 years. And then, depending on how quickly we ramp it up after that, we could get to $25, which is coal parity before the end of the decade.
And in big scale.
In big scale, because once you get to coal parity, that's the only way we're going to get China and India to stop burning new coal. We have businesses in China and in India, and I see a lot of hydrogen development, a lot of renewable development in both countries. The India announcement was incredibly strong on 2030. Some people were upset about the 2017 net zero deadline, but when it comes to 30, he announced a big commitment to get to 50% renewables.
Were you surprised by it?
I was surprised that they would make it so explicit, and even the net zero is a big thing for them. And so I think it will happen faster than 2070 because of the falling cost of renewable and hydrogen. India's burning 80 gigawatt of oil, of diesel, to keep the lights on. So there's an immediate opportunity there, and we're very interested in working that country.
And with regards to China, perhaps the fact that we haven't really seen them active, I guess the diplomats are working on this, but we haven't really seen the leadership.
It's going to be technology, it's going to be industry. I think China has committed to a net zero, which is very important. At the G20, China was clearly behind the 1.5 degrees. So I think a lot has been achieved between the G20 and COP. And I think what's really important is to see in the coming years how quick it's in our hands to make part of this happen in 5 years, or it could otherwise happen in 15, 20 years. It's about building the project. The capital is there. We saw how many trillions of dollars are already committed. What's missing is really the projects, and that's where companies like us step in.
Marco Alvera, CEO of SNAM there, speaking with our Maria Tadeo. Let's turn now to the aviation industry. It's a big contributor to global greenhouse gas emissions, and it's under pressure to change that. In October, the International Air Transport Association, a trade body representing airlines, approved a target of achieving net zero emissions by 2050. To achieve that, many airlines in the US and Europe are looking to buy sustainable aviation fuel made from renewable sources like used vegetable oil. Initiatives like these are pushing plane makers to come up with some radical new aircraft that will eventually cater to our growing appetite for travel without hurting the environment. We took a look at how Airbus, the world's #2 aircraft manufacturer, is stepping up to the challenge.
How long until we can fly emission-free? Airbus says it's more confident by the day it can be done by its 2035 target. Airbus's CEO spoke about its ambitions for hydrogen-powered planes at the company's summit in France.
The physics works. Hydrogen technologies are not new. They are used in other sectors. We use them in space on our rockets, and we don't need the laws of physics to change to be able to use hydrogen on our planes. So every day we become more confident, but we think we need to have a plane, we need to have the right fuels, the hydrogen available in the right quantity at the right place at the right time, and we need the regulations to be ready. So we really need the work and the collaboration of many people around the globe to make it happen on time.
But it could be a long wait until green passenger jets go mainstream. Larger aircraft with more than 150 seats are not expected to feature globally until about 2050. That means manufacturers and airlines today are under growing pressure to ramp up short-term innovations to cut their carbon. In the long term, meeting the ambitious plans for so-called green hydrogen means building a giant industry almost from scratch. To make that happen, British airline EasyJet is among those saying governments need to get involved and fast. Aviation's emissions over the last 3 decades leading up to the pandemic grew by about 80% to over 1 gigaton, and that's projected to double by 2050. According to Bloomberg NEF, about half of the airlines with the largest global market share have set net zero targets by that same date, nearly 3 decades away.
Coming up, from blue sky projects to the bottom line. We'll speak with our Bloomberg NEF expert Meredith Annex and dig into their models about how hydrogen fits into the future energy mix. This is Bloomberg Green. Bloomberg's world headquarters in New York, I'm Kaylee Lyons, and this is Bloomberg Green. Now let's bring in Meredith Annex, our Bloomberg NEF hydrogen specialist, to talk more about how hydrogen could change the energy landscape. So Meredith, what place do you think hydrogen is likely to have in the future energy mix globally?
Hydrogen's this incredible solution for us as we look to decarbonize because it's a perfect solution in areas that are hard to electrify. So where we like to think about hydrogen playing a role, it's in things like heavy industry, especially where you need a feedstock as well as energy source, and in things like dispatchable power, long-haul transport, maybe even shipping and aviation.
That sounds great that it can be used for such diverse industries. At the end of the day, though, how much is this going to cost?
Well, that's the amazing thing about hydrogen, because depending on how you make it, it can actually see significant cost declines in the future. So when we're talking about clean hydrogen, we usually mean green hydrogen produced from renewable electricity. And in that case, your hydrogen is almost as cheap as the renewables that are used to make it. So if you're in a place with really good renewable resources, you'll be able to have cheaper hydrogen. But even in places with less good resources, we think that hydrogen can be cheaper than $1 per kilogram, which is the price of unabated hydrogen today, and around $8 per million BTUs for those who prefer to think in energy units. And that can be achieved anywhere in the world by 2050, we believe.
All right, so let's talk about kind of the pros and cons list. I don't know where cost fits into that, but what are the advantages to hydrogen over other renewables, and then what are the drawbacks?
Yeah, main advantage is the fact that hydrogen can serve roles that electrons struggle with. And that's things like seasonal storage, for instance, or just anything where you need storability, where electrons are harder to store, hydrogen is going to be easier. That also leads to a downside, though, because hydrogen is less energy dense than the usual things that we use for storable energy today, like coal or oil or natural gas. So you will need more volume of storage to handle the same amount of energy.
Let's talk about the viability as well and how it may differ in different geographies. What is your view on that?
Yeah, so for green hydrogen, again, from renewable electricity, really places with the best renewable resources, things like Latin America or the Middle East, even Southern Europe, have really, really good potential for producing hydrogen. And then when you're looking at blue hydrogen, which is produced from natural gas or coal with carbon capture and storage, we do see that becoming more expensive than green hydrogen in the future, especially as renewable electricity costs come down. But that can be a viable option in places like the US Gulf Coast or Russia, where you've got good geological storage for the carbon, as well as ample natural gas that's quite cheap.
All right, great breakdown. Thank you so much to our Meredith Annex, our Bloomberg NEF hydrogen specialist. And of course, you can get more from the Bloomberg NEF team on the terminal and online. And they've recently done a podcast called Hydrogen 101 as part of its Switched On series. So from iron ore titans pivoting to cleaner energy to talk of a hydrogen revolution, that's it from this week's edition of Bloomberg Green. We'll be back next week with a deep dive into the state of electric vehicles. And you can keep the conversation going by following us on YouTube, Instagram, and Twitter @Climate. I'm Kaylee Lyons from Bloomberg's world headquarters in New York, and this is Bloomberg Green.
This is Bloomberg Business Week. Insight from the reporters and editors who bring you America's most trusted business magazine. Plus, global business, finance, and tech news as it happens. Bloomberg Business Week with Carol Masser and Tim Stenivek on Bloomberg Radio.
And a very good afternoon, everybody. Live from the Bloomberg Interactive Broker Studio, streaming on YouTube and on Bloomberg Originals. It is Friday's Eve, otherwise known as Thursday, February 9th, 2022. I'm Carol Masser, my co-host, as you know, Tim Stenivek. On leave, recession, it's a real worry. Just check out the trade today. We'll have more on the markets and the economic and Fed backdrop in just a moment. Also ahead, the magic, it's back in the Magic Kingdom. We saw shares of Disney really take off last night after earnings and news of a major cost savings program and a lot of other things. We'll get to that in just a moment. Plus, why we're probably all wrong about interest rates. I'm curious. Mike McKee, who's settling in the studio, see if he has something to say about that. This week's cover story of Bloomberg Business Week on the little research firm that took on India's richest man. We've been obsessed with this story over the last couple of weeks. Also, little political news. Republican donors seeking to choke off a 2024 bid for the White House by former President Donald Trump. And then we've got the goods on the SoftBank-backed company that's cracked the code to making it big as a social media influencer. So all of you would-bes, stick around. You're going to want to hear that story. All right, let's get a check on that trading day. Here is Charlie Pellet.
Hi, thank you very much. And here's what's going on, Carol Master. Let's begin with the Walt Disney Company because that's stock up now by 1.4%. However, the Dow, the S&P, NASDAQ, they are all trading lower. In fact, they have given up earlier gains. Right now, we have got the S&P bouncing along the bottom. Stocks erase gains amid recession signals from the Treasury market, hawkish Fed speak, and a surge in equity bullishness among U.S. retail investors that's often seen by many as a contrarian indicator. Also, keep in mind, the S&P wiped out a gain that approached 1% at one point, now lower by 0.3%. The S&P down 11 now at 4106. The Dow down 85, drop there of 0.3%. NASDAQ down 32, a decline of 0.3%. 10-year yield 3.66% with the 2-year 4.50% right now. Spot gold down 0.5%, 18.66 the ounce, and West Texas Intermediate crude down 0.5%, 78.08 right now for a barrel of WTI. Disney, the big earnings story right now. Disney, as I mentioned, up 1.5%. Trian Partners founding partner Nelson Pelt says his proxy battle with Disney is over. You recall the activist investor announced in January he would be seeking a board seat of the company to try to initiate change, but now he is telling CNBC that now that plans for dramatic restructuring have been announced at Disney, he is now ending his proxy battle. Bob Iger's plans for Disney include 7,000 job cuts and $5.5 billion in cost savings. As for where those savings will come from, Geetha Raghunatham is a media analyst with Bloomberg Intelligence.
So right now, Disney is spending about $30 billion, just upwards of about $30 billion every year on content. Of that, about 10 to 11 billion is on sports rights, so there's really not a whole lot of flexibility there. But on the remaining 20 billion, that's where they're looking to cut about 3 billion, so about 15% of those content costs are what they're looking to trim. So it's really more in the general entertainment kind of division.
And again, Disney up now by 1.5%. After earnings, MGM Resorts and Wynn Resorts leading a rally in casino operators. MGM up 7.2%. Wynn right now up by 5.4%. Recapping stocks lower, S&P down 0.4, and that, Carol Masser, is a Bloomberg Business Flash.
All right, Charlie, thank you so much. It is time to get to the Market Drivers Report. Let's set the Business Week agenda. We got a lot of conversations going on in the studio, around the newsroom, everywhere. We've got a great duo, though, to talk about the market trade today. Kriti Gupta, anchor and markets correspondent at Bloomberg, here in our Bloomberg Interactive Broker Studio, along with Michael McKee, international economics and policy correspondent at Bloomberg News. All right, first up, Kriti, we're actually seeing some selling here today.
We are, and this is absolutely not how we started the day off. And I have to say, we started off the day in the pre-market, futures were flying high, up about 0.9%, and a complete turnaround at the open. You can see it's kind of a slow fade, bit by bit. I don't think there's any news assigned to this, to be completely honest, because if you actually look at this from a bond market perspective, or even the dollar,
you want a reason?
I mean, I know sometimes. I mean, as my mentor and teacher Cameron Kreis, better known for being macro man and the writer, but for me, he'll always be a mentor. He says sometimes traders just trade because they trade. And I think that's kind of one of the things happening today, because every single kind of rally you've seen today, or this week, I should say, has been faded. So it kind of feels like it's just a pullback from the 5-week rally we saw beforehand. And a lot of it is concentrated in the very stocks that took us higher in the last 5 weeks. So a lot of tech specificness, even though if you look at the bond market, the 10-year yield only higher by 5 basis points. Put that in the context of what we've seen in the last couple of months, this is nothing.
Yields have moved up today, though, huh?
Right, but only by 5 basis points.
All right, so come on in, Mike McKee. Got a little bit of economic news. Anything of note?
Not particularly. We had the jobless claims numbers come in below 200,000 again. It's still maybe too early to pick up what might be going on in the labor market. But also, we've been talking about this today, the number of layoffs, we got a lot of announcements, but the total number of layoffs is very small compared to the normal churn in the markets. There's a website that tracks layoffs in the tech industry, and they have 245,000 some odd from 2022 to today. And the number of people who lost their job last month was 1.5 million almost. And then, people find jobs. It's just this ongoing churn in the labor market. So it's not really registering yet.
Every CEO I talk to just says, our biggest concern is getting workers. So it's interesting to hear that narrative, and yet you also kind of have to cross that with, it feels like every hour, every day, we're seeing layoffs.
Well, what's interesting is in most of these calls, analyst calls, or even in the earnings announcements, they're saying not, we see a recession ahead, so we're cutting back to batten down the hatches. They're saying we're using this opportunity to restructure, which is what Bob Iger said last night. We're going to take those businesses that are not making money, and we're going to get rid of those, and we're going to concentrate on businesses that we think will make money. And what they don't say is we're going to get rid of these businesses and 7,000 people around the world. It doesn't mean all in the United States, but they're going to, these jobs are going to go away. May not be filled jobs, but there's openings. But they don't say we may hire more people in these businesses that are making money. So a year from, unless we go into recession, a year from now, it'll be interesting to see what these companies' total headcount is, whether it's the same as it is now.
Well, and I would say as an investor, right, this is what you kind of want to see from a company to adapt to changes in the marketplace, which is what I think Bob Iger and others are doing. Perhaps Meta, we'll see. Time will tell whether this pivot is the right thing. But that is certainly playing out.
Yeah, it is playing out. And look, to your point, everyone is talking about the labor market, but they're also talking about the Federal Reserve because it's a moving target still. I mean, look, if you look at the bond market, I mean, we've been talking about this for days on end, this trading range that you're seeing in the bond market, although I did just see a headline, the 2-year yield at about 450, so which I believe is the highest going back to the end of November. It's slowly seeping up.
4.4904 right
there
now.
You go. Very specific. Thank you for that. But one of the conversations in the market that really kind of caught my eye, and I think I talked to Mike about this earlier this morning, was, is 6% the new 5%? And people keep asking that question. So it's interesting for me to see this bond market move because it feels like it's almost being taken seriously. We kind of were like, oh, maybe it'll go to 6%, maybe it'll go to 7%. Now it's like, wait a second, what if it is actually 6%? And I think Jamie Dimon made comments to that effect. He didn't say that was his base case, but he said it could potentially happen. He really cushioned it. But I'm hearing that from more and more people. They're like, wait, what if we're wrong?
Well, it's a lot of...
We're going to talk to Allison Schrager about that.
Pessimists out there in the world. We know.
We can't all be the ray of
people in the
sunshine
bond market. People in the bond... Well, as somebody said the other day, the market is waiting for its opportunity to overreact to the Fed. And, I mean, the Fed has not changed its view on anything. The Fed has said exactly the same thing. Jay Powell said exactly the same thing last Wednesday as he said on Tuesday. And it's the market that's moved. And so maybe this is the opportunity for the market to overreact. We won't know until we get close to March 22nd. We won't have an exact figure until March 22nd, their next meeting, on what they think the terminal rate will be. We may hear people say, we think it's going to move up, or they may say, we're fine with where we are. But we do get a lot of data between now and then. There's 2 CPI reports, PCE report, a couple of retail sales, and another jobs report that will influence everybody's thoughts on these things.
Yeah.
So I think it's too early to say that a base case is moved up yet.
2 things. One, Jamie Dimon, I guess, talking to Reuters in an interview, and he said, warned against declaring victory against inflation too early and that the Fed could raise interest rates above 5%. So that's what he said. But I mean, I feel like the Fed has actually been very consistent, Mike, in that, listen, we're data dependent. We want to get back to 2%. And we're going to probably keep on raising rates. Is that fair? I mean, that's kind of been the message.
That has been the message. They shifted their message from we're going to be aggressive at raising rates. They're getting close to the terminal rate. So now the message is really starting to focus on we're going to get to what we said we were going to get to, and we're going to leave it there and keep the pressure on to bring inflation down over the course of the year. And the problem is, well, I think I said after the Tuesday speech that it's not what Powell says, it's what the markets hear.
Yeah.
And on last Wednesday, they heard something completely different from what they heard on Tuesday, even though he said the same thing.
Well, on Wednesday, they said he didn't push back enough on financial conditions being kind of an issue for the Federal Reserve, and therefore that was interpreted as dovish. On Tuesday, I'm trying to think what his exact comments were, but he said that disinflation was really going to be a big part of 2023, I think, and that the 2% we would get closer to in 2024. I believe that was the headline that the market had moved on, and I might be getting the phrasing wrong on that. But
I'm looking at Mike.
Yeah, correct me if I'm wrong.
Approximately
Right, but and that's exactly again what had moved the market. So look, those, to be fair, those are two positive headlines. He hasn't changed his course at all, but they are positive for the market that is trading this not for another, 6 weeks.
Well, the point is, though, could we be wrong? What if we're getting it wrong in terms of getting back down to that 2%? And that's where I'm going to go next. Guys, got to run. Thank you so much. Michael McKee, of course, international economics and policy correspondent here at Bloomberg. Kriti Gupta, anchor and markets correspondent here at Bloomberg as well. All right, we're going to stay with the economy, get to a story that is among the most read on the Bloomberg about how it's frequently argued that once our economy gets past this burst of inflation, interest rates will in fact fall back to their pre-pandemic lows, kind of just talking about that, and perhaps go lower in the future. What if that is wrong? This is in a new Bloomberg opinion column by Allison Schrager. She covers economics. She's a senior fellow at the Manhattan Institute, author of An Economist Walks into a Brothel and Other Unexpected Places to Understand Risk. She is with us via Zoom in New York City. Allison, I'm so glad you're here. Wanted to talk to you. Let's get to this assumption we were just talking about with Mike and Kriti. There is this assumption that Fed Jay Powell keeps saying it, we're going to get back to 2%. That's our backdrop, but it could be wrong.
Yeah, I mean, I think there are two assumptions. One, that inflation is going to go back to 2%, and two, that there is this just sort of natural interest rate that was near zero, and once we get through inflation, that's where interest rates are going to go back to. And, that might not be true either.
Well, talk to us about why you wrote this column and what, you cite a couple of different economists or macroeconomists, Olivier Blanchard, Ken Rogoff. Talk to us about some of the thinking about maybe why 2% isn't it. And you also write about natural interest rates.
Yeah, so I mean, I've always been struck that whenever you read any big financial institutions' reports or outlooks on the economy, for years they've been saying that interest rates are trending down because of an aging population. It's always in the IMF, it's always in the World Bank, it's always in every central bank, it's in banks, it's everywhere. And, I've always sort of never quite understood why. I've understood the economic reasoning, but it never seemed quite right to me. But everyone sort of jumped on this bandwagon because really over the last 30 years, the population did age and interest rates went down and everyone sort of just blamed it on an aging population. But really, it struck me most recently when Olivier Blanchard said, don't worry, interest rates will go back because the population's aging. And I guess I felt compelled to dig a little deeper. And it just so happened that Ken Rogoff had sent me this paper where he looked at interest rates going back 700 years and found that, well, interest rates have been trending down, not as much as we think. And actually, the last 15 years at least might not have been part of a trend. It might have been an anomaly. And also when he did sort of more regressions on a longer period of time, he didn't find that an aging population brings down interest rates at all. So in fact, the opposite might be true.
I also think about, we talk a lot about, and I'm assuming this comes on your radar as well, just these kind of changing macro ideas, whether it's the pushback against globalization, the move towards localization when it comes to manufacturing, supply chains, maybe continuing to be disrupted and being more local, and what that does for costs, the move towards climate change, alternative energy, like all of this has some costs to what we are doing. Is that part of it?
Yeah, I mean, I think it's also wishful thinking that we have a lot of big fiscal plans and they rely on us having very low costs of borrowing. So I think all these sort of conventional macro wisdoms sort of get tied up together and we get maybe a little over invested in them. But, I think that the struggle for a macroeconomist is always how much can you separate out what's cyclical and temporary and what's really structurally changing. And that's always a challenge, I think, for everyone.
I also like this thing, where you talk about the demographics in an older population, that if it ultimately is a younger is it a younger population that ultimately helps keep rates lower?
Well, we've been thinking that the argument has been for a couple decades now that an older population lowers rates. And it's partially this idea that people anticipate this long retirement, so they save a lot. So you build up a huge stock of savings and, interest rates are ultimately a function of supply and demand of savings. So the idea is that there's this huge demand for savings and that effectively lowers interest rates. Of course, it might not work out that way. Even the IMF points out that, we really haven't saved enough for retirement. And in fact, the government is probably going to have to borrow a lot to fund our retirement. I mean, just look at the State of the Union the other day, where Joe Biden was quite strident that we will never cut entitlements. And I guess the Republicans agreed with that. So, okay. If that's what we want to do, we are going to have to borrow to pay for people's retirements. And that puts more bonds on the market, which you think would increase interest rates. So I think we've just sort of been assuming that we'd have this huge stock of savings to push down rates, but maybe that's not how it's going to work.
And you also just point out, and just got about 40 seconds left here. You say we should also be concerned because interest rates are largely a function of risk in the market, not just some abstract natural rate. This is something we talk about what the markets and what the traders are saying about kind of where rates land versus what we keep hearing from Jay Powell. And that certainly plays a part in your thinking.
Yeah, the risk premium is super important. And I think risk premiums got very low because inflation had been so stable. But, if that cat's out of the bag now and, we have a more volatile inflation environment, then there's a higher risk premium, certainly on bonds that are longer term. And that will mean rates are higher for a long time, too.
Well, it's certainly something that's so relevant to the conversation right now, especially as you watch. I'm looking at yields certainly tick a little bit higher on this Thursday. Allison, thank you as always. Allison Schrager, she's senior fellow at the Manhattan Institute. She's a Bloomberg Opinion columnist. You can check her out on Twitter at Allison Schrager. She is also, as we've mentioned, an author of An Economist Walks Into a Brothel. So love her take on this. And this is, as I said, such a relevant conversation right now as we try to figure out ultimately where rates land. All right, you are listening and watching Bloomberg Business Week on this Thursday. I'm Carol Master in our Bloomberg Interactive Broker Studio, and this is Bloomberg Radio.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 2:21 on Wall Street. I'm Charlie Pellet. We check the markets all day long at Bloomberg. Treasury yield curve inversion has hit the deepest level since the 1980s. Stocks are lower across the board. We begin with the 10-year with a yield of 3.67%, but the 2-year right now, 4.49%. The S&P 500 index down 18, drop there of 0.5%. The Dow down 145, drop there of 0.4%. NASDAQ right now down 59, a decline of 0.5%. Spot gold down $7 the ounce, down by about 0.4%, $18.67 the ounce. West Texas Intermediate crude down 0.5%, $78.06 a barrel. Stocks wiping out an earlier gain. We had the S&P early in the session up by almost 1%. Again, recapping here, we've got the 10-year 3.67, that 2-year 4.50% right now. S&P down 0.5%. After earnings, PepsiCo reporting fourth quarter profit that beat expectations. PepsiCo on a down day for the rest of the market, up now by about 0.8%. I'm Charlie Pellet, and that is a Bloomberg Business Flash.
All right, Charlie, thank you so much. You're listening and watching Bloomberg Business Week on this Thursday. So what does it take for a big billionaire to see about $100 billion in counting be lost from his empire? How about a little research firm? Well, that big billionaire we're talking about is Gautam Adani, head of the Adani Group conglomerate in India. The little research firm is Nate Anderson's Hindenburg Research. Well, with more on that little research firm that came up with the big short on Adani, we've got Bloomberg Business Week editor Pat Regnier. He's actually finance editor, Pat Regnier, and Bloomberg News wealth reporter Anders Mellon. We caught up with them earlier, and Pat began by setting the stage about who is exactly Gautam Adani.
He may not be a household name in the United States, but he is absolutely a household name in India. He's probably one of the most important businessmen in modern India. Anders can talk about this a little bit, but almost anything that you might do in India, his businesses will touch your life. So he's built this enormous empire, but a lot of the growth in its value really came during the global everything rally that began with the snapback from the COVID crash. But it just kept going even through 2022. You just, like, when you do a chart, you just see it just going like hockey stick. You know, this like business,
so many, right,
yeah.
During the pandemic.
Yeah, but then also just even in 2022, as like global markets were falling, this one's still just going up, 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 and up. So you know, he's become sort of this like very visible global success story, you know, and he starts, you know, he starts coming on the radar of even people, you know, outside of India. He may not be a consumer household name, but if you're like watching as Anders does, who's wealthy, he is now beginning to, like, you know, top every league table that you can see. I mean, this was Asia's richest man, India's richest man. He was one of the richest people in the world.
Anders, come on in on it, because he was also a man who seemed to like his privacy and kind of stay out of the limelight. Talk to us a little bit more about his empire and then the allegations by Hindenburg.
Yeah, he definitely has tended to stay below the radar until recent years. And his empire really is, like Pat said, it's one that touches a lot of citizens in India every day. He owns a series of infrastructure companies that all hang together in one conglomerate. So everything from coal mines to power plants to power lines to cement production facilities and data storage centers, and he's getting into media, and he owns food companies. So it's things that touch lots of Indian citizens every day. And he sort of came onto the scene internationally for those who don't necessarily watch India that closely, really, like Pat said too, and during the COVID rally and in 2022 when things started falling, he just really went off the charts. The shares of his companies just went up, up, up. And all of a sudden he was the second richest man in the world in September of last year, which was just quite surprising to see because the rise was so incredibly it was just so incredibly baffling, especially for infrastructure companies, which don't really tend to have those kinds of rich valuations. And that piqued a lot of interest among people who said, this just doesn't make sense. It's too good to be true. These financials just can't be real. And there's been whispers and news reports in India for quite a few years about various aspects of the finances of his companies. But nothing really has happened. But that obviously changed a couple of weeks ago when Hindenburg Research put out their 100-page note, sort of aggregating a lot of what had been out there already and then dove deeper into certain aspects. And most people in India, I think it's safe to say, expected that nothing would really happen. But the shares of his companies started falling, and then they just fell and fell and fell. And the company is looking at value has been about cut in half since Hindenburg's report came out.
Anders, we as we were preparing this story, and it comes through so well in your piece, talked a lot about kind of a culture clash between corporate India and sort of it got big enough that it met the markets and the way that people operate in New York and London and other financial markets, and suddenly met this kind of brass knuckles culture of shorts. And can you just talk a little bit about sort of like how that's played out?
Yeah. So one of the unique aspects with Gautam Adani's group of companies is that it's built sort of like a traditional Indian family conglomerate, which is a series of businesses that a family, it's sort of a group of businesses that a family builds over time, and they tie together sometimes in some ways, and you can help support each other financially when needed, and you can move personnel between them. And this has a long storied history in Indian business culture. In the United States, they used to be common back in the day. They are much less so now. And one thing that people that I talked to ahead of writing this story pointed out to me was that within these conglomerates, historically, there has tended to be quite a bit of related party transactions and money being moved between different parts of the conglomerate. And sometimes that might have been done in ways that auditors would not pick up on, or that securities lawyers maybe would frown upon, because it was sort of a family affair. And that's something that some people that I talk to stress, that here you have a certain culture of doing business, a certain way of doing business that has worked extremely well for the country over a really long time, that is now clashing with how things are done in the financial centers of capital like New York and London, where the culture is very different. Most companies tend to have a really broad shareholder base and not be controlled by a family. Boards tend to not be stacked by family members. Executive roles tend to not be stacked by family members. And a lot of people in India are feeling a sense of frustration, I think, because they feel like people in the West just look at this kind of corporate structure and think that there's something inherently suspicious with it, when in reality it's a slightly different way of just looking at how business is done and how priorities are set.
The other thing I just want to, Anders, we just have about a minute left here, is I think another layer that you do so well in your reporting is the connection between India, the country, India, the prime minister, and Adani, right? The relationship just seems very close.
Yes. Adani and Prime Minister Narendra Modi have known each other for 20 years, and people that know India well, they say that these two are quite close, and their goals are aligned, and they have benefited from each other. And in that vein, Adani has, especially in recent years, taking on a really strong profile of trying to link himself and his company with the future and the success of India. And that's also something that he's pushed really hard on now that the company is under attack by a New York short seller.
That last voice, Bloomberg News wealth reporter Anders Mellin, along with Bloomberg Businessweek markets and finance editor Pat Regnier. Now, this story is the cover story of Bloomberg Businessweek. We caught up with them a little bit earlier for our weekend broadcast, but really gets into what Gautam Adani, the tough year he's certainly having, and we continue to see the pressure in shares of the Adani empire overnight again, so it continues to be certainly on investors' radar. Coming up, we're going to have more on the story, including the little research company that came up with that big short on Adani. That's coming up next with our Joel Weber and Ed Ludlow. We're talking about the research firm that is run by Nate Anderson and his Hindenburg Research. You might remember Nicola when he ran after that company. So it's interesting to hear about the 400 pages plus, if you will, that he put together on Adani. Hey, I do want to mention on the markets right now, we are seeing pretty much stocks at their lows of the session, and it's coinciding with an uptick in yields, which have moved to their highs of the session. That two-year note hitting 4.5% for the first time that we've seen that since November 30th. So again, that yield curve, we're certainly seeing that inversion steepen as well. All right, you are listening to Bloomberg Business Week, watching us as well. Right now, let's get a check on world and national news. Off to D.C. and Nancy Lyons. Hey, Nance.
Thanks, Carol. Ukraine's President Volodymyr Zelensky is continuing his tour of Europe, appealing to the EU today for more support in the fight against Russia. Bloomberg's Maria Tadeo has more from Brussels.
He was very clear that Ukraine needs weapons, and they need weapons for two reasons. They expect Russia to enact some form of, quote, revenge of the country, coinciding obviously with the one-year mark of the invasion, but also they worry about the spring offensive that may be to come. And for that, he repeated, I need long-range missiles, and I will need two fighter jets. It's not clear he's coming home with that.
Bloomberg's Maria Tadeo in Brussels. Top Republican donors are trying to choke off any momentum that Donald Trump might try to build for a third run for the White House. But the Anti-Tax Club for Growth and the Donor Network, founded by billionaire Charles Koch and his late brother David, have indicated they want someone else other than Trump to run in 2024. House Republicans are stepping up their investigation into President Biden's family and its financial dealings, as we hear from Bloomberg's Nathan Hager.
The House Oversight Committee is demanding banking, travel, and other records from President Biden's son, Hunter, his younger brother, James, and James Biden's business partner. Oversight Chairman James Comer says Republicans want to know, quote, who peddled influence to generate millions of dollars for the Biden family. Hunter Biden's lawyer, Abby Lowell, says the Republicans' requests have no valid legislative purpose. There's no immediate comment from the White House. In Washington, I'm Nathan Hager, Bloomberg Radio.
What the world needs now.
Composer Burt Bacharach has died of natural causes at the age of 94. He wrote the soundtrack to the late 60s and 70s with hits like that one and others like Alfie, Raindrops Keep Falling on My Head, and Say a Little Prayer. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Nancy Lyons.
connection lost.
Headlines and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 2:40 on Wall Street. Stocks are at the lows of the session. This update brought to you by Innovation Refunds. This is your daily reminder from Innovation Refunds that 70 to 80% of small businesses are good candidates for taking the employee retention credit. Don't bother trying to navigate hundreds of pages of tax code to learn if your business qualifies for ERC assistance. Let the tax professionals at Innovation Refunds do the work and help you secure the future you want for your business. Learn more at getrefunds.com. We check the markets all day long. S&P now at 4,095, down 22 points, a drop there of 0.5%. The Dow down 169. That is a drop of 0.5%. NASDAQ right now down 75, a decline of 0.6%. 10-year yield 3.67% with a 2-year yielding 4.49%. S&P wiping out a rally that approached 1% earlier in the day as options traders keep piling into bets targeting a 6% Federal Reserve peak rate. Right now we have got, as I mentioned, the 10-year 3.67% and that 2-year 4.49%. Well, as for the overall market backdrop, Victoria Fernandez is Chief Market Strategist at Crossmark Global Investments.
We're seeing more and more equities trade above their 20-day moving averages. But again, you have to look at the trend lines, and right now they're still down. So I think that's where we see more disconnect. I just want to be cautious. I don't want to buy into something that turns into a bubble. I would rather be a little bit late to the party and be more sure of what we're seeing.
In the meantime, the Treasury yield curve inversion hits the deepest level since the 1980s. Spot gold down 0.8%, 18.60 the ounce. West Texas Intermediate crude oil down 1%, 77.68 a barrel. PepsiCo reported fourth quarter profit that beat expectations. PepsiCo shares up now by 0.7%. Disney, after earnings last night, holding on to a gain of 0.3%. ExxonMobil is creating a global trading division to compete more aggressively with the likes of BP and Shell in the high-risk, high-reward world of energy derivatives. Again, recapping, we've got stocks lower, S&P down 0.5. I'm Charlie Pellet. That Carol Masser is a Bloomberg Business Flash.
It is indeed interesting market action, Charlie. Thank you so much. Well, as we just heard from Pat Regnier of Bloomberg and Anders Mellon, his cover story is about billionaire Gautam Adani having a rough start to 2023. The Indian industrial tycoon's empire has taken a roughly $100 billion hit in a matter of days, following accusations of financial wrongdoing from an American activist short seller. We wanted to share more on that activist short seller, and that is Nate Anderson and his Hindenburg research. With more on that in a story in the upcoming new issue of Bloomberg Business Week magazine, out on newsstands, on the Bloomberg, and at Bloomberg.com/businessweek. Let's bring in Bloomberg Business Week editor Joel Weber and Bloomberg Technology co-host Ed Ludlow. Joel here here in our Bloomberg Interactive Broker studio, Ed in our 960 studio in San Francisco. All right, Joel, so we did hear from Pat and Anders. We just played that for our audience. But this story, it's an interesting one.
Yeah, so we had that main bar sort of in motion, and the other big question in all of this was more about the short. And so we reached out to Ed because, well, as Ed knows, very well, Nicola's story, which was a huge one and one that he was instrumental in our coverage of. Nate Anderson figured into that, and everything was kind of quiet, and then everybody was like, "Oh my gosh, Nate Anderson and Hindenburg suddenly became the story of the moment with this short on the Adani Group." There's still kind of shrouded in mystery, but our task to Ed was sort of figure out as much as you can figure out. So Ed, what were you able to figure out?
Yeah, I'm hesitant to call it a David and Goliath story, right? But that's kind of what it's like. Hindenburg Research is this sort of merry band.
How about I do it, and then you don't have to. So this is a great David and Goliath story, right? Go ahead.
Well, I was just going to say, it's this merry band of fewer than a dozen analysts, journalists, and we know very little about them, and yet they take on what was Asia's richest man at the time in this massive conglomerate. And, to the outside world, they're short sellers, right? They're in it to make a profit, as all short sellers are when the value of a security tied to the company they target declines. But, it's more than that. They see themselves as being this kind of really important function of a healthy financial market, which is to make investors and regulators aware of what they allege is a fraud. And then once they've done their report and the market's done its thing, they leave us in the media to cover the story and leave the market to make their own conclusion, because that is what an activist short seller is to their mind.
Well, and it's not just about unveiling, possible fraud or what have you in various situations or various companies. And again, these are allegations because the company has come out and said very differently and come out with its own, I think, 400-page report as a rebuttal.
How do you rebut 100 pages?
Exactly.
Here's 400 pages.
Take that. Having said that, tell us about the dynamics in terms of who trades on this ultimately, because people do make money off of this.
Yeah, so I think the mechanics of Hindenburg are interesting. Put the sort of loftier goals to one side. Their business model is based on making profit from a short. And actually, another part of their business model is eventually making money from whistleblower payouts. But my understanding is they've never actually been paid one. But what's so interesting here is that in the past, Hindenburg basically makes a deal with a group of passive investors or one single big passive investor and says, hey, if you take on the short position on our behalf, we will let you look at the research before we publish it. And in exchange, you give us, Hindenburg, a share of the profits. That way, Hindenburg doesn't have to kind of reach into its own pockets and is kind of a small group anyway, right? But again, this is the biggest question. And these stories are actually some of the most fascinating where you don't find the answer. What the market wants to know right now is this short position closed or is it still open? We don't know the answer to that. And the reason it's important is because if they ride the short all the way to a lower value, they'll be more profitable. But now the market's trading on uncertainty in both directions. And that's not just in equities markets, but as we've learned, in this case, all we know about the short is that it was in dollar bonds and non-India listed derivatives tied to those companies within the Adani Group. So it's a fascinating market dynamic where the market doesn't know.
So, and obviously we'll be chasing everything that we can to figure out, when and if it's open or closed or whatever. It's just ongoing mystery. What other kind of mysteries remain here, Ed?
That's your way, boss, of saying nudge, nudge, get on with it. Do some.
Yeah, we can wrap now. Yeah, get back to it.
Yeah. Look, so core to the Adani story was like, what is the goal here? India is a very different market to the ones that Hindenburg's targeted in the past. They've largely been small US-listed companies that Hindenburg's gone after. The regulatory situation in India is completely different. It's not clear what kind of action could or hypothetically will be taken against Adani. So what is it that Hindenburg's trying to achieve? The FPO, or the follow-on primary offering, was scrapped. Their activity in the bond market or debt markets has been scrapped. Is that satisfaction enough for Hindenburg? Well, it goes back to the core question in the story. Why is it that Hindenburg does what it does? And the answer you get time and again is a very lofty goal. We expose fraud because it's the right thing to do, and it's part of a healthy, functioning financial market globally.
So, all right, so these activist short sellers, researchers, they bring attention to companies that might not necessarily be on anybody's radar. At the same time, sometimes the short sellers or these activists that are doing the research, they actually become the target. And I'm thinking about Carson Block. Like, I always feel like there's a love-hate relationship with anybody who's looking to either talk down or short a name.
Yeah, so there has been a large body of academic research in this area, and there is an active DOJ investigation which looks at some short sellers, some of them well-known, such as Muddy Waters and Carson Block. What I would say is, A, they declined to comment for this story, and that investigation is one that Bloomberg has previously reported. A source has told me that Hindenburg have never been approached by US regulators or agencies, at least, with regards to that existing investigation. And again, I go back to the other part of the business model. Longer term, Hindenburg really hope that actually these agencies pay them whistleblower rewards for the work that they're doing. So it's a strange paradox that we discuss in the story, but the accusation broadly from academia through to the investigations pending is that some of these short sellers hypothetically could be engaged in market manipulation, and that's the negative side of the story that there's more to be reported on.
The positive side is if you do this right, it makes you a lot of money.
There is.
Right.
Always two sides. All right, Ed Ludlow, thank you so much. Co-host of Bloomberg Technology at Bloomberg News in our 960 studio in San Francisco. Our thanks to the editor of Bloomberg Businessweek magazine, Joel Weber. This story on Adani, the cover story this week.
company news headlines on Bloomberg Radio.
From Bloomberg World Headquarters, I'm Charlie Pellet. 2:53 right now on Wall Street. Trian Partners founding partner Nelson Peltz says his proxy battle with Walt Disney is over. The activist investor had announced in January that he would be seeking a board seat at the company to try to initiate change after earlier being rebuffed in his outreach. Peltz changed his mind after Disney CEO Bob Iger announced plans for a dramatic restructuring on last night's earnings call. Peltz announced the news in an interview today with CNBC. Disney shares are up now by 0.2%. Canopy Growth, the Canadian cannabis producer backed by Constellation Brands, will be shutting a major facility in Ontario and cutting 800 jobs as it accelerates efforts to end years of losses. And with more on the story, here's Bloomberg's Steve Rappaport.
Charlie, the company will move to an asset-light model in Canada, sourcing many of its products from outside parties. The changes mean the end of Canopy's cannabis cultivation facility in Smiths Falls, Ontario. It says headcount across the business will fall by 60%. It's a massive shakeup for a business that was once the standard bearer for Canada's pot sector after Prime Minister Justin Trudeau's government legalized the use of recreational marijuana in 2018. That same year, Constellation, the marketer of Corona Beer and Robert Mondavi wines, struck a multi-billion-dollar deal that gave it a 38% stake in the cannabis firm. Charlie?
And right now we're looking at shares of Canopy. They are plunging by 16.1%. Constellation Brands down now by 2%. And those are some of the company stories we're following at this hour. I'm Charlie Pellet. This is Bloomberg.
This is Bloomberg Business Week with Carol on Bloomberg Radio.
All right, more Business Week to come in just a moment. 2:55 on Wall Street. So let's get a check on the latest world and national news with Nancy Lyon. She's in our 99.1 newsroom in Washington, D.C. Hey, Nance.
Thanks, Carol. Well, the death toll has now topped 20,000 from the twin earthquakes that rocked Turkey and Syria this week. The first UN aid convoys arrived in Syria today. U.S. Ambassador to Turkey, Jeff Flake, says U.S. support is there as well at Turkey's request.
I should mention Turkey has responded over the years to many natural disasters around the world. I think in over 50 countries on 5 continents, and so they paid it forward. So now it's in their time of need. We're stepping up.
Ambassador Jeff Flake says the U.S. teams are going where the Turkish government needs them. Several Democrats, including Congressman Robert Garcia, are moving forward with a resolution calling for the expulsion of Republican Congressman George Santos.
We have filed an official expulsion resolution with the House Ethics Committee to get rid of George Santos. It is time for him to go.
Garcia says Santos has lied about too many things. House Speaker Kevin McCarthy has said Santos would be removed if the Ethics Committee determines he has broken the law, but not until then. A House panel investigating the weaponization of the government has been holding its first hearing today. The subcommittee was established by the new Republican majority to look into claims the Department of Justice, FBI, and other federal agencies are biased against conservatives. Congressman Jim Jordan is the panel's chair.
Americans have concerns about the double standard at the Department of Justice. Americans have concerns about the Disinformation Governance Board that the Department of Homeland Security tried to form.
Congressman Jordan says big government and big tech have colluded to shape the narrative and censor Americans. Jordan accused the department of abusing its surveillance powers. Democratic Congresswoman Stacey Plaskett says the committee is being used by Republicans to showcase conspiracy theories and advance an extreme agenda. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Nancy Lyons. Back to you, Carol.
All right, Nancy, thank you so much. You're listening and watching Bloomberg Business Week on this Thursday. Carol Masser in our Bloomberg Interactive Broker Studio. As you know, February is Black History Month. Every day this month, we are celebrating significant moments in U.S. Black history. With your installment for this Thursday, February 9th, let's bring in Bloomberg's Justin Milliner. Hi, Justin.
Hey, Carol. Thank you very much. On this day in Black history, in 1995, Dr. Bernard Harris Jr. became the first African-American man to walk in space. He accomplished the feat while on the second of 2 space shuttle missions. He was on board the Space Shuttle Discovery STS-63. Dr. Harris worked with colleagues to test spacesuit modifications that were designed to help keep astronauts warmer on spacewalks. On this mission alone, he logged 198 hours and 29 minutes in space. He completed 129 orbits and traveled over 2.9 million miles. That's a long time in space.
It's a lot.
That is a lot. And that particular mission, Discovery STS-63, is also noteworthy, Carol, because it was the first ship piloted by a woman. Her name was Eileen Collins. All in all, Dr. Harris enjoyed a storied career at NASA. He spent more than 438 hours in space, traveled over 7.2 million miles. And after his NASA career, he's continued to work as a researcher. He's now CEO of the National Math and Science Initiative, and I stay in Black History.
Sounds like he's encouraging others to get into the STEM world.
Yes,
I love
he
that.
is. 100% as a minority, too.
Yeah, I love that. What a significant accomplishment. Justin, thank you so much. Really appreciate it. Bloomberg's Justin Milliner with our latest installment of Black History Month. All right, folks, in just a minute, we're going to head over to our TV colleagues and talk about the markets because we've got stocks retreating amid recession signals from the Treasury market. You've got yields shooting up. We're seeing the Treasury yield curve inversion reaching the deepest levels since 1980, the 1980s in general. That 2-year note with a yield of 4.50, so staying above that rate. So we'll get into it, talk about some of the stocks on the move, because even with that, we've got some standout groups actually showing some gains, at least on the equity side. All right, time to head over to our TV team. Bloomberg's Countdown to the Close starts right now.
Countdown to the close. Bloomberg's comprehensive cross-platform coverage ahead of the U.S. market close starts right now.
This is the countdown to the close. About 60 minutes left to go here in the trading session on Thursday afternoon. Romaine Bostic here alongside Gina Martin-Adams. We're joined right now by our colleague Carol Masser for a global simulcast. Welcome to our audiences across Bloomberg Television, Bloomberg Radio, as well as out there streaming on YouTube. And Carol, we're looking at a market, of course, coming off what was the best start for cross-asset returns, I think, going back to 1987. But we're seeing a little bit of exhaustion now, I think, in markets, pretty much across the board. So much exhaustion that all your co-hosts apparently have just taken off here. But I'm curious as to
scared everybody away.
You scared everyone away. But I'm curious as to what you make of it. I mean, it's only been a couple days of losses here, but there does seem to be a little bit more malaise, a little bit more trepidation here.
It does. You know, it's so interesting with all of the Fed speak that we've had this week that finally it feels like, certainly I'm obsessed and focused on what's going on in the yields market. That 2-year note staying at that 450 level. We haven't seen that since November 30th. So we are seeing almost like a realization when it comes to the Treasury trade that, oh yeah, the Fed's going to keep raising rates. But the tricky part is, like, how do they do it? The Fed's in a tight spot, right? How do they keep fighting inflation, keep raising rates without really putting pressure on the economy, really sending it into a tailspin and a recession? So that is the predicament. Having said that, I'm an optimist. I always look for some outperformance, and we found that in casino names.
Casinos.
I was a little concerned that they weren't going to hold on to their gains. Check it out, though. You had casino stocks up thanks to upbeat earnings from both MGM and Wynn. Wynn, in fact, hitting a 52-week high. You've got MGM up about 6.5% right now. Wynn up more than 4%. The news from both of them signaling strong demand trends in Vegas and a faster-than-expected recovery in Macau as those pandemic restrictions have eased. Now, Las Vegas Sands also has exposure to China. Yeah. It's only up about 0.5% off its highs. Caesars, as you can see, remain also up about 0.4%. So it does show investors do look at fundamental stories and do trade on it.
They do look at fundamental stories. Of course, some of that is a macro story as well. The idea that the global economy was reopening and, more importantly, reemerging. You mentioned, of course, the 2-year yield creeping back up to 4.5%. And, well, maybe that's a big part of the reason you're seeing stocks down across the board. 0.6% on the S&P and the Dow Jones Industrial Average. The NASDAQ down a little bit more than that. And the Russell, Gina, the relative underperformer on the day, down more than 1%.
Yeah, interestingly, you're not getting that much confirmation from sectors in that overwhelmingly down day, though. And when you look at the sector performance distribution, you're not seeing, for instance, defensive sectors dramatically outperforming cyclical sectors. Instead, it seems to be a little bit of a case of just reversal of recent strength. Look at communication services, for example. Recall that gigantic gain that we got out of Meta last week, now getting reversed a little bit. We're seeing a reversal in Alphabet as well. Some of the optimism that was embedded in communication services as they were going through the bulk of their reporting season, starting to kind of diminishing a tiny bit. Consumer discretionary also still doing well. Tesla's up today, so that's not necessarily a risk-off signal.
Yeah.
It really is just a market that maybe is questioning some biases that emerge.
Taking a breather, Gina, actually?
Yeah, that's probably a better characterization than sort of, oh my gosh, it's all over. It's more, how much did we actually price in last week, and is it really worth it?
Yeah.
I do think it's sort of questioning convictions is the way that I would describe it.
Well, you just mentioned Alphabet, and I've actually been kind of astonished by the moves that we've seen over the last couple of days, particularly when it comes to Alphabet, down 5% here on the day. Remember, it dropped 7%, 7.7% yesterday, and this is, of course, a stock of its size typically doesn't have those types of outsized moves. In fact, I think it's going to be the biggest two-day drop that we've seen in those shares going back to the onset of the pandemic in March of 2020. I guess a lot of this just has to do with the fact that, well, this big ChatGPT rollout maybe wasn't ready for prime time just yet here. Nevertheless, keep an eye on that. Keep an eye on Disney as well. The shares had been higher on the day. We were, of course, Carol and I, we were on yesterday afternoon, and we saw that big surge. Those shares now in the red, sort of erasing all the gains that we saw from the day here. We talked a lot about Nelson Peltz and activist investors. Salesforce also has a lot of activist investors, at least 5 now, circling that company right now. Those shares higher by about 2.5% on the day, and we were just talking about Credit Suisse. The U.S. ADR is here down 16% here on the day. I do want to go back to the broader economic conditions here, Carol, and particularly a look at those weekly jobless claims numbers with, you know, all the asterisks and caveats that this is just a weekly number and one weekly number does not make a trend here. But a lot of people were expecting, I guess, a more pronounced trend line higher, and we didn't really get that. It did come in higher than expected, and it was higher than we saw last week, but 196,000 jobs. There are a lot of people that look at that. They look at last week's monthly jobs report and maybe next week's CPI report, and they might say, there might be finding some signs here that battle against inflation has a long way to go.
I got to say, I don't know how to make sense out of some of the strength that we continue to see in the labor market. You know, on every day we see news of some companies talking about layoffs, and here we've got this inversion.
But isn't that a good thing? I mean, it's not but isn't that kind of a good thing? I mean, there's a great story too on Bloomberg Business Week that I think Rich Miller wrote about this idea of a rolling recession, right? And that's kind of what you would want in an ideal situation. If you're going to have a recession, that's the kind that you would want in an ideal situation where you do have these sort of pockets of layoffs, these pockets of weakness, right? But overall, you never get that big aggregate, you know, fall off the cliff.
Yeah, you do wonder if companies are just reacting to the situation and how that maybe evens things out and makes it not so severe. Having said that, Megan Green actually weighing in on the inversion of the yield curve, the movement that we saw today, and talking about a recession. She is Kroll Institute Global Chief Economist. She's not so worried about the inversion, and here's what she had to say about recession. Check it out.
The chances of a recession have gone down a little bit. That being said, I think we will see it as the Fed continues to ratchet up rates and also continues to shrink its balance sheet, which most people have kind of forgotten is happening in the background. But that is a significant tightening as well. So I wouldn't worry so much about the yield curve. I would worry more about the labor market.
All right, that's, of course, Megan Green over at Kroll Institute, Global Chief Economist. I mean, Barkin came out, too, right, of the Richmond Fed. He, too, said, you know, looks like things have peaked, but nonetheless, the Fed's got to stay its course. And so, again, this goes to this point of how can the Fed, you know, Gina, engineer it really carefully so that they can keep raising rates without having the economy come undone. It's not easy.
Yeah, and I think the other thing to consider is just timing, right? I think the markets are frustrated by all this recession talk, frankly, because we've been talking about it for a year.